Futures pointing lower, but higher here in Europe.
Fairly resilient thanks to Cartier as well. We've got Bayer in there, the Monsanto roundup also helping quite a bit ahead of the exploring a settlement ahead of the Monsanto bankruptcy, I should say, and Swiss Re very much in focus as well, Guy.
Bunch of single stocks that we need to focus on as we go towards the open. Remember, we're heading into a weekend that also represents a significant risk story, so that needs to be folded into your thinking as well. But at the moment, it looks like we're going to see a fairly insipid open. We've got US futures a little softer, European futures maybe a little still price in still, so a little bit of upside there. Some single stocks maybe to think about, but it doesn't look like we are going anywhere in a hurry. After that massive move at the beginning of the week, we are definitely leveling off when it comes to the equity story. So SOX 600 up by around 0.2%. The FTSE's up by around 0.2%. The IBEX is up by around 0.3%. We're looking for the next catalyst, trying to figure out what that ultimately may be. And at the moment, it doesn't feel like we have it at the moment. The market's got a lot of different things going on, a lot of balls that are going to be in the air over this weekend as well. How much risk do you want to carry through that process? Lizzie, talk me through the sector story. What are you seeing there?
Well, we are risk on to start the day, Guy, and you've got about 18 out of 20 sectors in positive territory this morning. Healthcare leading the gains, up 0.9%. Real estate not far behind it, 0.6% up. Bottom of the basket, though, you've got tech and construction and manufacturing, both in the red. But if you look at some of the single stock names that we were talking about before, Joe flagged Bayer, those shares up 1.3%, Critty, as you were talking about as well. So want to keep an eye on throughout the rest of the day.
We should keep an eye on the fact that healthcare is the leading sector by a giant margin, actually. Looking at index contributors, Novo Nordisk at the top of that list. Sanofi, AstraZeneca, Novartis, GSK, I could go on and on. If you're a healthcare name, it is likely you're in the top contributors to the gains this morning. You can see that right on our screen in terms of volume as well. Bayer is also higher by 1.6%. That Monsanto story is actually a positive for the company. So there is a kind of double whammy, or double tailwind, I should say, for the pharmaceutical sector. On the downside, though, we should mention tech not having a good day. But honestly, Guy, at the start of this really just looks like a rotation of what we've seen throughout this week.
Absolutely. In some ways, we're, I think, less with equities, but more with other asset classes. We're kind of ending up kind of where we started. Certainly that's been the story for the dollar. I'm trying to put my finger on exactly what's happening with why we're seeing this move in pharmaceutical stocks. Slightly struggling with that one. I will come back to you, but it's interesting to see that we are seeing such a significant move to the upside. Keep an eye on defense. We'll come back to that in a few minutes' time as well. We need to talk about what's happening with Leonardo. We spoke to the CEO a couple of days ago, talking about consolidation within that space as well, a story that's definitely worth focusing on. A few ex-divs, Adidas, Commerzbank, and E.ON, all ex-div this morning.
Absolutely. Well, as we await those comments from Donald Trump, let's get a little bit more markets analysis here. Henry Allen, macro strategist over at Deutsche Bank Research, joins us around the table. Henry, we are trying to kind of digest the geopolitics and the trade deals and maybe the Fed policy that comes off of the trade deals as well. What are you looking for in terms of the signal for your next trade?
So in terms of those next catalysts that Guy referred to, I think there are a couple of things that I think are going to be really important. One is, do we get those trade deals that the US administration have advertised? You know, Kevin Hassett was saying this week, there are potentially 20 to 25 trade deals on the table that when Trump comes back from the Middle East, that many of those could begin to move into place next week. Do we think that the UK was the first of a series of deals? And I think if so, that would add to the market optimism that actually the direction of travel is now firmly towards dialing back those tariffs. I think the other thing, and we saw this last year to some extent, is if the data continues to point away from a recession, as I think it will, then I think as the weeks and months go by, certainly over the next couple, markets and investors will become increasingly relaxed that we're not going to see that recession, and I think that can help bring us a bigger risk-on move. Just because as that data continues to come in, like retail sales yesterday, yes, it was down, but still in positive territory, doesn't look like a recession. I think that will really help things.
You know, it's fascinating, and Henry, we'll show the pictures in just a moment, but we are seeing live shots of Donald Trump getting ready to speak in Abu Dhabi as well, and I think that's just an immediate question here of, do you actually price in some of these deals? There's the trade deal story as well, but there's also the foreign direct investment story as well. So if you start to see, say, more of U.S. money coming into these various regions, but also the other way around, is that tradable, or is that simply just a number at the moment?
I think at the moment it's just a number, because I think the proof will be in the pudding, as it were. And one thing I noticed yesterday is when we had the Bloomberg Red headline come through saying about Qatar investment, the S&P didn't really react to that. So I think at this stage, it's very easy to kind of pump up these numbers. And I know governments across the world will, advertise, often use double counting and methods such as that. Often these are pre-announced deals or investment that was already going to go ahead to form some nice big round number. So I think the proof will be in what actually happens rather than what's necessary in the press release.
Henry, I take your optimism, but even if the US-China tariff relief came on Monday, you're still going to have the average tariff rate much higher than it's been since the 1940s. Is it not likely that you're going to still see some scarring? It just hasn't shown up yet in the hard data.
I think that's a risk, but I think basically what markets are hoping for is that this 90-day extension, both on the reciprocal tariffs and on the China tariffs, is actually permanent. I think that's what's being priced in, because they kind of know where this Trump put is now, that when the US 30-year Treasury yield was probing 5%, when the market was selling off in reaction to Trump's comments on firing Powell, they then had a quick reversal. And so I think tariffs we're kind of treating as this kind of exogenous variable, but actually it's endogenous to the market. And I think Trump can't wait basically to get back to kind of first term mode, which is stock market at record high. USA has never been doing better. We're heading for the golden age. I think, from his announcements we're seeing in the Middle East right now, that's where he wants to get back to.
But that's Trump and the market. But the central banks are still being very cautious.
They are, for sure, and I think they're still worried about the inflation story. But even there, the news has been pretty positive. This week alone, we've had lower than expected US CPI, third month in a row, the weakest PPI reading since the COVID pandemic. Oil prices, they've come down considerably given the fears of a recession and Trump's comments on Iran yesterday. So I think both on the inflation side, the pressures there are weakening. That offers central banks a bit more space to cut rates. So that's looking good. And on the growth side, I think it's clear that with the hard data still pretty resilient, all things considered, markets are pricing out that recession.
Where's the signal? Is it in the bond market, is it in the equity market, or is it in the dollar? Because I'm getting different signals from all of them. The dollar's back where it was at the beginning of the week. Equities have gone up. Dollar's back where it was. You've got a US 30-year that's knocking around 5% still. Which one of those do I want to pay attention to? Because I'm hearing different things from all of them, and they tell me different things about ultimately where the story is going to go.
So from my point of view as an analyst, I think the most important is the bond market, because that is the one that policymakers are most reactive to and are likely to see a shift in policy. Because, in my reading at least, what caused that 90-day extension back in April was the fact that the 30-year Treasury and long-end Treasuries were heading relentlessly higher, and that was spreading to other countries too. And indeed, for all we talk about the sensitivity of US consumers to the stock market, certainly they have more investments than, say, here in the UK. Actually, in some ways, consumers are more leveraged to the bond market because that filters through into mortgage payments. So I think the bond market is the critical one, because that will cause...
Okay, so you've got a 30-year at 5%, just shy of. What does that tell you?
I think that tells us that investors are still, even now, questioning whether the US is still as safe a haven as it once was. I think that policy uncertainty in terms of the scarring that Lizzie talked about, that policy uncertainty is lingering. They're not going to trust the US.
And the dollar's selling the same thing?
Broadly speaking, I think the problem is, and this is the same for treasuries as well, and I think what's stopping this sell-off from going further is what's the alternative? Because, a lot of people, I think, got kind of very overexcited a month ago. This is kind of the end of US exceptionalism. But actually, Europe and these other regions still have their problems. And indeed, the US still has its strengths. The IMF still think, even with the tariff reductions or the tariff downgrades to their forecast, that the US is still going to be the fastest growing economy in the G7. They've still got lower tax rates than Europe. They work longer hours on average, so the trend growth path is much faster there.
So if it's the bond market to be watching, can it force some fiscal discipline into Washington, D.C.?
I think it can, yes, because as we saw in the UK when the Liz Truss saga happened, if the bond market sells off aggressively, that is the thing that panics politicians most of all. Now, the US, fortunately for them, have kind of been fairly immune to this, given they have acted. They've got the exorbitant privilege. They're the reserve currency, so they can run deficits on a scale that, if we saw France do, say, then markets would react much quicker. But I think we've seen in history, actually, I remember, well, not I remember, but if you read about it, in the late 80s, early 90s, around Bush... Thanks, Guy. So, you had, when Bush Sr. was in power, just as Clinton was coming in, US interest rates were moving higher, the interest payments on the debt was going higher, and there was a bipartisan consensus something must be done. And I think similarly, if interest payments on the debt did move up to a level that it was constraining other spending on infrastructure, particularly on mandatory programs like Medicare, Medicaid, Social Security, then I think the political emphasis would just be forced because they don't want the bond market turmoil.
Do you want to go?
I do. I just want to very quickly mention to our global audience that we are, of course, seeing live photos of Donald Trump in Abu Dhabi right now. It looks like he's speaking to some of the folks there to greet him with a slate that's talking about investment priorities in the United States. As we, of course, get to that press conference I believe he's due to speak to properly, we will bring you those headlines as we get them and dive into those comments. But, Henry, let's come back to this question of investment spending and trade deals, et cetera. At the end of the day, we're looking at a fairly resilient consumer, not just in the United States, but here in Europe as well. We're not seeing the same cracks that I think a lot of people were expecting to show up. At what point do they show up? Where does that, I mean, Guy was talking about the signal in the markets. Where's the signal in the data where you're starting to say, actually, we have a problem, the economy's crumbling, whether it's here in Europe or the United States?
So my big focus is really going to be on the June-July data, which, given the lags of data releases, may not be apparent until sort of July, August, kind of height of the summertime. Because I think by that point, we'll be aware, are businesses delaying decisions in a meaningful way that's having an impact on GDP and activity data? And is that filtering through into the market? Because we know that the labour market can be a slow one. The labour market is not necessarily a leading indicator. It's more of a coincident indicator that will turn down at the same time as the economy does. But if I look at the high-frequency data, that's still holding up really well, actually. If you look at the weekly initial jobless claims, for instance, that's been in its range from before Liberation Day. Actually, OpenTable have daily data on restaurant bookings, a discretionary category that you'd expect to fall off quite quickly if there were signs of consumer weakness. The daily data is still holding up. If anything, it's slightly accelerating. So, again, I'm pretty optimistic that we're not seeing that kind of signs of a downturn. In Europe as well, actually, I was impressed that the flash PMIs from last month, actually we'll get the next batch of flash PMIs for May next week, those were still, on aggregate, in expansionary territory. So again, there were kind of this fears the economy was going to immediately fall off a cliff. The only advanced economy that's obviously showing signs of contraction is Canada, but they were hit with 25% tariffs and do 3/4 of their trade with the United States. Apart from that, actually, the US, Euro area, Japan, those other advanced economies showing, all things considered, impressive resilience.
I'll leave it there. We've got a lot going on. There's many catalysts that could change all of this. Henry, thanks for running us through some of the details. Henry Allen, macro strategist at Deutsche Bank Research. Quick look at the Core 6. I'm not talking about fish. Let's talk about what is happening here. Fairly mixed picture, but you are, as we've seen, seeing some quite significant strength going through in the pharma space this morning. LVMH is a little softer. Issue piece on the terminal this morning talking about the fact that the CAC 40 has an LVMH problem. Ferrari is up, ASML is down, Schneider's down, Nestle is up. I'm struggling to get a clear sense, other than the fact that we have a strong bid into the pharma sector this morning. The European equities are giving us a clear signal. This as we continue to watch what is happening out of Abu Dhabi and the signals that are coming through there. Also, maybe not that clear. Anyway, President Trump is currently, as you can see, kind of speaking to a gaggle, being addressed by some of the officials in Abu Dhabi. As soon as we get the press conference, we will get to that, Chrissy.
Absolutely, and I think it's crucial as well because, I mean, 24 hours ago, we were hearing him talk in Doha as well about simply just not only the tariff story and the trade deals they're trying to get out of and the direct investment they're trying to get out of into the United States, but also a series of other kind of tariff stories, the geopolitics, of course, raging in the background. We should mention that at the same time, there were meant to be slated talks in Turkey. Looks like they're now low-level conversations, but they are still the very first conversations happening directly between Russia and Ukraine. So, of course, we're standing by for headlines on that as well. In the meantime, let's go right back to the equity story and get our individual stocks on the move with Joe Easton. Joe.
So we have got a decent move at the open in Richmond following those numbers earlier. Now pretty much in line with expectations in terms of the top line. The company was actually commenting around my screen's just given up on me there. There we go, we're back. Richmond up 3.9%. The company saying that they have seen a bit of an improvement in the watch sales, but outside of China remains the focus in terms of where they're seeing the improvement. China still weak, sales down around 15%, but nonetheless US, there we go at the bottom there, down 13% on watch sales, but the stock coming back up, potentially not as bad as expected, and a slight improvement on sentiment. Then in terms of insurers, couple of big ones out. We had Swiss Re. Now that was the investment income story. Looked a little bit better than expected, but the losses on the LA wildfires potentially hitting that one. And then Aegon, that was more life insurance, actually weakness in the life insurance business according to them today out of Amsterdam. So that one looking weak as well. Then in terms of Bayer, as Guy mentioned earlier, pharma looking strong today, and Bayer one of the best performers. This story in the Wall Street Journal about potentially closing some of those cases related to the Monsanto chemicals business, and also even potentially putting that unit into bankruptcy protection. That's been taken as a positive for that stock today. So we're seeing Bayer gaining around 3% now, continuing to come up as trading continues. Then in terms of Eutelsat, remember this one was the one that rallied hundreds of percent a few months ago following the Starlink concerns around that being pulled from Ukraine related to Doge and Musk and that coming out of Ukraine. And this stock actually soared around 300% back in March, but we're coming down slightly with the earnings a little bit weak on some of those numbers, and therefore trimming that gain today for that one over in France. Then another one here in the UK, which I found really interesting, in the Financial Times, talking about ISAs in the UK and saying that they could actually put a limit on how much cash you can put in your ISA and force people to put it more in stocks and shares, and that is seen as a positive for the wealth managers here in the UK. Again, it's a report in the FT, potentially Rachel Reeves looking at doing that. St James's Place was flagged by traders at potentially rising. We're seeing that one gaining 2.6% today. And then finally, to finish on M&A, 1&1 over in Germany. This is in telcos, a big gain for that one, up 19%. United Internet offering to buy part of the company that it doesn't own at the moment. So the stock gaining 19%, that coming through in the telecoms, finishing on a bit of M&A this morning. 1&1 up 19% in Germany today.
Okay, Joe Easton from our equities team, we thank you as always for those stocks on the move after the open. And coming up, we're going to dive into another one of them, and it is Richemont Cartier jewellery boosting earnings for the Swiss luxury group. We'll dig into that next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
I want to take you back to Abu Dhabi and what is happening with the President of the United States. Something of a walk and talk underway at the moment. Peng Xiao is currently speaking with the President of the United States, the CEO of G42, an AI company based out of the UAE. We think there's going to be some industrial CEOs joining him very shortly. We think Ellison's going to be there from Oracle. It'll be interesting to see as well whether or not we see the Etihad CEO as well. Airlines, aeroplanes, aircraft seem to have played a fairly large feature, been a fairly large feature of the landscape on this trip. But there's there's been an energy component, a healthcare component, which is I kind of think where we are now, and then I think we're going to move on to the industrial component. Just in the sense of your sort of timing, I think after that we will hear from the president, and we'll have a kind of more formal press conference at which we're expecting him to speak. So we'll come back to that in a few minutes' time as we continue to monitor what is happening in Abu Dhabi. In the meantime, let's turn to what is happening with the defense story here in Europe. The boss of Leonardo, the Italian defense company, says Europe's fragmented defense industry will eventually succeed in creating major players that can take on the primes, the rivals that we see in the United States and China. Are we going to see an Airbus of defense? Basically, is the question that many people are asking themselves in Europe. Roberto Sigliani spoke to Bloomberg exclusively from the company's headquarters in Rome.
The actual situation that has been created in Ukraine after the Russian invasion made clear that, first of all, Europe is too fragmented. So even though we have maybe 1.5 million soldiers in Europe, those are fragmented into 27 armies. We have many fighters, many tanks, many helicopters. We have so many defense platforms that in the end of the day, we're not very effective in the investment of our defense budget. The second thing that I think we should be noticed that no country can make on its own at European level to support and defend Ukraine. So clearly, that was a bell. We have to wake up. We have to create a sort of European defense space. We have to boost the collaboration among defense companies. I mean, creating giants. I mean, if you see how big are the American and Chinese defense companies, they're much bigger than the biggest European ones, including Leonardo. That means facilitating the aggregation. That means favoring the synergy. Sometimes, from the industrial point of view, this means making choices and making priorities very clear. So this is happening, and in view of the NATO alliance that I believe should remain, should be reinforced, it is very important that Europe gets stronger, and that we need to be a solid, more reliable partner in the NATO alliance as a continent, and this will make NATO stronger. And ultimately will make for the Western countries life safer in the future. So no favors, but of course the change of landscape has accelerated transformation that we should have considered maybe already a few years ago.
Do you see room that those needs will lead to real consolidation? So big M&A in the industry in Europe, or government is not yet ready for it?
Making big M&As in defense means that some government essentially steps back from national sovereignty. Maybe it's a bit too early. We have to create a culture. We have to create a mutual trust. But for sure, favoring the aggregation in joint ventures, like the one we did with Rheinmetall, or within the NATO umbrella with Baykar for drones, that is for sure a quick and effective way to favor the aggregation, to favor the synergy. I have no doubt that in the future, Europe will find a way to make real merger and acquisition or, giants. But I think we have to do those things somehow progressively, because you don't change the culture of 27 countries that are historically different and also socially different. So we have to accelerate the creation of the United States of Europe on one hand, but on the other hand, I mean, history matters. So we need to work on that.
The CEO of Leonardo speaking exclusively to Bloomberg. Quick look at defence stocks just to show you what is happening this morning, give you an idea of what the picture looks like right now. As you can see, a little bit of a bid back into that market, but as we've just been hearing, it is a market that maybe needs some consolidation. There's significant funds flowing into it right now, but will we see some consolidation? As I say, are we going to see an Airbus of defence being formed in Europe? Is that what we need to see here in Europe, Lizzie?
Well, let's switch from defence to luxury. Switzerland's Richemont reporting earnings this morning, a rise in full-year sales, even amidst the turbulent times for the wider luxury sector. And Charlie Wells is here with a breakdown of why. Charlie, what's so good for Richemont at the moment? What's giving it this resilience?
It was jewelry, Lizzie. Really, that is their largest group, and they saw a really big gain there. So that is helpful for them. And it's been difficult in the market to kind of find a narrative on luxury. I think you're getting a lot of earnings reports, a lot of kind of different stories from the likes of LVMH, really not looking good compared to this Richemont report. We had Burberry yesterday, pretty solid, but they've been struggling a lot. And I would say that this Richemont report, it kind of helps build this kind of hard v soft luxury story, which is basically in a kind of uncertain quarter, these firms that have been able to sell the likes of jewelry, things like bags that are a little bit more durable, those durable goods, those firms are doing fairly well. It's the softer luxury companies, the more kind of fashion-oriented, the clothing ones, those have been struggling, and this report helps kind of solidify that story.
Any clarity on the trade war impact?
I mean, look, we're getting some really interesting comments from their chairman today talking about kind of the pricing power that they've got. I think one of the kind of spillover effects that we've been seeing from this trade war is currency, right? With that weak dollar, that's bad for a company that is headquartered in Switzerland. But, you know, their chairman saying this morning, we can raise prices if we need. They have been raising prices. And, you know, another issue they've been dealing with related to trade has been gold, right? The surge in gold price has kind of hit into some of their margins, and they have risen prices on the back of that. And so I think it looks like this is a company that still has that pricing power.
Charlie Wells walking us through the Richemont story. We thank you so much. And of course, he was there talking about the trade war, the currency story as well. A lot of the emanating from the commentary coming out of Washington, D.C. Donald Trump is right now in the UAE, in Abu Dhabi. He is meeting with a series of CEOs and business leaders as well. We are due to get comments from him as he sits down for a business roundtable. In the moment, speaking to a series of industries where they are looking to invest both into the UAE and also garner investment into the United States as well, securing as much as $200 billion worth of deals. Of course, that is coming with some pushback in terms of the domestic politics at home. In the meantime, some comments being made from Donald Trump when it comes to Boeing as well, saying that Boeing had some, quote, headaches, but they make the best planes. Really backing, of course, one of the U.S.'s largest global exports. We, of course, are standing by from any comments and further commentary coming from not only Donald Trump, but Scott Bessent and Howard Lutnick, who are there with him at the moment. We're going to leave you with these live pictures and bring you the press conference as it comes to us. Stick with us. This is Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade. About 30 minutes into today's session, seeing green on the screen and some major outperformers in the DAX. So tuned about 0.7%. Defense story there, certainly moving that market. We should also mention there are a couple of ex-divs as well that might also be contributing to those gains. Adidas, of course, one of them as well. But like I said, green on the screen across the board, Guy, as we perhaps get a few more lines in the geopolitical space.
So the U.S. President Donald Trump has secured $200 billion in deals during his visit to the UAE. This obviously comes on top of what we've seen achieved in Qatar and in Saudi Arabia as well. The agreements include investments in AI, aircraft, oil and gas, as well as metals projects. The deals build on a pledge from Abu Dhabi to invest $1.4 trillion in the United States over the next 10 years. Let's go to Dubai now, where Jumana Basekci, Horizon's Middle East and Africa anchor, joins us from. Jumana, fill in the gaps. What's the latest now? Fold in the UAE story into the wider trip that we've had from Donald Trump and how it compares and contrasts with what we saw in Qatar and what we saw, obviously, in Riyadh in Saudi Arabia.
Yeah, also, I'm keeping a close eye on the images that we have on the screen and who is actually standing next to President Trump, because you've got Treasury officials, you've got the Treasury Secretary, Scott Bessent, also the Mubadala CEO, the CEO of the most active sovereign wealth fund in 2024. And we know that the President Trump and the administration as a whole have set their eyes on further collaboration with some of these sovereign wealth funds in the region. Yesterday, in an interview, exclusive interview with Bloomberg reporters, the QIA CEO, new CEO, I should say, pledged to invest $500 billion in the U.S. over the next 10 years. So the numbers that are coming out of these meetings have been quite huge. Just to give you some context around what has been announced in the UAE specifically, another economic pledge. Remember, this is a pledge, a commitment, not the same as deals, but the UAE are saying that they're going to invest up to $1.4 trillion in the U.S. over the next 10 years. When it comes to actual deals, though, $200 billion is the number. There are deals being signed in aviation. Once again, I think earlier on, President Trump was meeting with Etihad Airways, the CEO. They've signed about a $14 billion agreement with Boeing. So again, as you know, Guy, Boeing group president, has been accompanying President Trump on the trip. And we've heard Boeing deals in every single one of these GCC states. Also big agreements in energy cooperation between ADNOC and several major U.S. oil companies as well, that to the tune of about $60 billion. But then the major development, I would say, specifically to the UAE, has been in artificial intelligence, with the president announcing yesterday alongside the UAE president MBZ that they're building the largest AI campus in the world, a $10 mile radius for this campus, so it's expected to have about 5 gigawatt capacity. To put that into context, that actually outpaces Stargate. I was speaking about that earlier with Tom McKenzie. It is huge in terms of ambitions and what they're trying to achieve, and also just underscores how President Trump is working with these Gulf nations to help power their own AI ambitions. And for them to do that, they have to get access to some of these high-tech chips, including those chips that are made from NVIDIA and AMD. I saw a comment from one analyst earlier today suggesting that this campus could actually require up to 2.5 million chips made from NVIDIA. That is why you're seeing such a remarkable performance in some of these stocks this week, because the week has been seminal for U.S. chip makers as well. Now, that's not to say there aren't some concerns. Some perhaps more China hawks within the Trump administration are still citing some concerns about national security, whether or not these chips could end up in the hands of China. But what Trump said when he made that press statement yesterday is they have inserted some guidelines to make sure that the distribution of those chips doesn't impede U.S. national security. So I expect that's a big theme that's going to come out of this when Trump gets back home to the U.S.
Okay, so deals very much in focus. Interesting, you can see Donald Trump there flanked by Scott Bessent, and to the left of him, the Group Chief Executive Officer of Mubadala, Khaldoon Al-Mubarak, who's also the chair, by the way, of Man City. But, Jemana, politics very much still on the agenda here. The Arab League summit is coming up this weekend. What should we expect out of that, and how it changes this overall story?
Yeah, so a lot of the headlines have been around those flashy numbers, the trillions and the investments and the deals, important, but then also some significant political breakthroughs this week. We spoke about that historic meeting that took place between President Trump and the Syrian President Ahmed al-Sharia, something that was inconceivable to happen 6 months ago, and really just demonstrates how the U.S. administration is working alongside Gulf allies, specifically Saudi Arabia, to bring Syria back into the fold and to give them a chance, quote unquote, of economic prosperity. So Syria is going to be a focus for this Arab League summit that's taking place in Iraq. Lebanon as well, with the new government. President Trump also made some quite supportive comments about the Lebanese government and his desire to work with them on, again, advancing their economic plans. Yesterday in Doha, President Trump also said that they're getting close to a deal with Iran. So you've got to think that that is going to show up in the conversations. But then also, and very important, and perhaps there's been less discussion about this on this trip, but the situation in Gaza, the war is continuing. Israel are preparing to intensify their operations in the Gaza Strip. And it has been 70 days since humanitarian aid has entered into the Strip. So that is going to be a topic of conversation at the Arab League summit that's taking place this weekend. But of course, that all comes on the back of the Trump administration and President Trump shedding light on some of these regional security issues as well.
Okay, Jemana Besetchi, who's been across that US to the Middle East trip all week for us. We thank you, our Horizons Middle East and Africa anchor, who, of course, will have coverage of that Arab League summit for us on Monday. Kriti.
Yeah, this is all interrelated as well, and there's always the China question looming over it all. As Jemana there mentioned, they are seeing, of course, a major pushback domestically in the United States when it comes to what that relationship with the Middle East and China is. If you open the gates for U.S. technology to enter the Middle East, does it ultimately make its way to China as well? The EU dealing with China in a very different light. That has more to do with the direct reaction to the trade story out of the United States and whether or not China will ultimately flood the European market with its goods. Well, I caught up with Valdis Dombrovskis, of course, the Commissioner for Economy and Productivity over at the EU, talking about what he can do, what the EU can do to both prevent that and maybe encourage a little bit of self-restraint. Take a listen to what he had to say.
In this case, the question is basically, and it's probably less acute question right now, because U.S. tariffs on China are not now outrightly prohibitive, as it was 145% tariff. They're still high. It's 30% tariff. So there are still concerns about this possible trade diversion. So basically, what it means that if from the European Union side we'll suddenly see that there is a strong flood of Chinese goods coming to the EU market, we will have to protect our market. And that is a scenario which we want to avoid to prevent further fragmentation.
What does protect your economy mean then in that context? You talked about the fact that the EU may have to step up if the Chinese don't indeed show that self-restraint. What do those domino effects look like?
In this case, it means further trade protective measures, possibly from EU side and possibly from other economies, if other economies are experiencing similar difficulties. But from the EU side, we are certainly willing to protect, now I have to say to the extent possible, a global rules-based trading system, because we believe that the rules-based multilateral trading system is what, at the end of the day, is serving better everyone. So we don't want to be in a world where might is right. We really want to preserve this rules-based system, and China is actually the country which has benefited most of this rules-based system, so it should be very much also in China's interest.
Would you ever close your borders towards Chinese imports that come in? Would that ever be on the table?
We do have quite a few trade protective measures already in place concerning Chinese goods. It regards, for example, steel, where we have a number of protection measures. More recently, we have introduced anti-subsidy tariffs on Chinese battery electrical vehicles, just to give some examples. And in a sense, if it is necessary, as a EU, we are using those trade protection measures also vis-a-vis other partners, in line with WTO rules, obviously.
You mentioned the automotive space as one example, and we've seen that in terms of the overcapacity from China as well. But it's taken some time in terms of putting those measures in and really addressing the overcapacity. Some would argue perhaps too late. In terms of, in light of perhaps more goods that are coming to the EU in reaction to the tariff story in the United States, how quickly can the EU deploy that measure to a broader spectrum of goods?
There are a different type of trade protection measures, whether they are safeguards, whether they are anti-subsidy investigations, whether they are anti-dumping investigations. They all have their timelines, but I would say those indeed, those timelines are maybe not very short, but I would say they are adequate to be able to react to changing circumstances.
Valdis Dombrovskis there, the EU Economy Commissioner, talking to us not about necessarily what the United States and those conversations look like as they are ongoing, but actually their focus on the East as a ripple effect of what's happening in the States. I thought his strategy was interesting because he goes on and he talks about basically this idea that we're on the offensive, we're encouraging restraint, we're trying to tell China not to do this, but when it comes to that red line, perhaps limiting those goods in a more restrictive measure is very much on the table.
Yeah, they have to. You can't see your market being flooded by Chinese goods. That is something that the EU will not tolerate and will certainly not see it as a derivative effect of what is going on between the US and China as well. It was interesting talking to Simon Flint a little bit earlier on, talking about the kind of timeline that the EU is working with here as well when it comes to a trade deal with the United States. He was talking about kind of weeks and months, but he's basically indicating as well that the European Union is not going to be in a rush here to get a deal done.
Well, I think that's interesting that he has his poker face on when you were talking to the EU economy chief there, Kriti. But in private, what our reporters are hearing is that actually the talks are going very well, and there's a lot of stuff that the EU officials are willing to compromise on, and they're putting those proposals forward. So is it that they're just talking tough in public, but actually we might get something in weeks rather than months? To Simon's
but they're not in a rush to do it. They want to get it done properly. They want to get a deal that's done that actually works, because at the moment the deals that have been done thus far have been a little light on detail.
Exactly, and that's where the loopholes arise, which comes back to that China chips point. That's how the chips could get through the Middle East to China, and that's what the hawks are worried about in Washington.
I mean, absolutely, it's a fascinating one as well, and we'll see how the ripple effects around the world start to kind of combine with each other, because on the one hand, we're talking about this thawing relationship with China, whether it's from the EU side, whether it's from the UK side, or whether it's from the United States. But then there is these kind of domestic concerns in all three regions, but ultimately what kind of more friendliness with the Middle East means as well. And we're due to get some comments on that soon.
Absolutely. We're also due to get some comments from the President of the United States fairly soon as well. He is currently, as you can see, in Abu Dhabi. He is currently going round the room, talking to various businesses, and we can listen in to what the President has to say. Let's listen in.
Here's the good news. I've been doing this for 4 days. I leave now and get under a 42-year-old.
Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Not like you so much anymore. So I want to thank everybody. The media's been great. And we'll see you guys back in Washington, D.C. See you. Even Petersburg, nice today. Have a good time. Say it? Yes, I am.
I think that concludes the trip that we've seen for President Trump to the Middle East. It sounds like he's still speaking. Let's maybe just go back and listen in. If he's taking questions from the media, let's listen in to those questions.
I think it's time for us to just do it. I said, they all said Putin was going and Zelensky was going, and I said, if I don't go, I guarantee Putin's not going. And he didn't go, and I understand that, but we're going to get it. We're going to get it done. We got to get it done. 5,000 young people are being killed every single week on average, and we're going to get it done.
Were you surprised when Zelensky didn't show up either, sir? Were you surprised when Zelensky didn't show up either?
No, he didn't show up because he heard Putin wasn't going. So
when do you think you'll meet the president?
As soon as we can set it up. I would actually leave here and go. I do want to see my beautiful grandson, it's his son, and we'll be doing that. But I will tell you that the world is a much safer place right now, and I think in 2 or 3 weeks we could have it be a much, much safer place. We're going to handle a couple of situations that you have here. We have some very serious situations, and we're looking at Gaza, and we got to get that taken care of. A lot of people are starving. A lot of people are. There's a lot of bad things going on. Okay. Thank you all very much, and in particular, I want to thank you. Thank you. We're going to get everything straight out.
Please. Mr. President, if you don't mind, I'd love to get your signature.
Okay, I think we have now concluded the comments that the President has been making in Abu Dhabi. We'll continue to monitor the situation as it evolves, though. As we heard from the President, he will now be heading back, not via Turkey, but going back to the United States, back to Washington, D.C. He's got plenty on his plate to think about when he returns to the United States. Plenty of things happening there, both on the economic front and on the political front as well. So we leave that trip. It has been a roller coaster ride of a week. Obviously, some of the news has been made. Much of the news has been made by President Trump and has moved markets in a fairly significant way. But remember where we started the week. We started the week with that China trade deal story. That feels like such a long time ago. Let's get a sense of kind of where we are and maybe kind of how far this story has still got to run. Paul Dobson joins us now, executive editor for Asia Markets. Paul, it's been a roller coaster week. Stocks are still higher. US stocks are still higher. We saw that big bump at the beginning of the week, but the dollar and many other assets have round tripped. The dollar is now basically flat on the week. What message does that deliver as to the kind of tolerance for risk going forward from here, from the wider market?
Yeah, hi, Guy. I think from Asia's perspective, the movement in the dollar is absolutely crucial because as it's come back down again, that's meant that there's been upward appreciation pressure on, everything from the yen to the Taiwan dollar, the Korean won as well. And they've been moving in fits and bursts and quite jumpy as well. This sort of feeling among investors here that even if they're not saying explicitly that they want to do it, the US administration is still pushing for the dollar to be weaker in a sort of global, in the rounds kind of a basis, and they will be pushed to allow their currencies to strengthen. And people are trying to get ahead of that, right? And so you see corporations repatriating their money, people putting on extra hedges, a little bit of kind of like concern, and we've seen some big blow-ups in volatility as a result of that. Weaker dollar should be helpful for US markets. We've definitely, as you said, continued to see gains for stocks, although that slowed down. It's going to take quite a lot for us to get good news on the trade front from here, given how surprisingly good the China news already was. I think the other thing you've got to be very careful of and watch out for is the Treasuries market. Yes, we had a pretty big rally yesterday. Some of the cooling inflation data and some slowing economic data gave people a little bit more hope that the Fed will cut. But the Fed's been quite clear, doesn't really think that it's going to be cutting anytime particularly soon. So watch those yields pushing up again. That's something that could become more harmful across the broader economy if it keeps on going.
Well, speaking of those yields moving higher, certainly seeing plenty of that in the back end of the Japanese curve as well. 145 this morning on dollar yen. Paul, talk to us a little bit about simply this idea of currency negotiations being part of any sort of conversation between the Japanese authorities and Scott Bessent.
Yeah, Chrissy. So we had reporting midweek saying the US is not pushing for currencies to be included as part of those trade conversations. Behind closed doors, it's not being brought up. And yet, there are meetings going on the sidelines. We've heard about Japan, we've heard about Korea, having those meetings, talking with US officials where currencies have come up. And as a result, Asia is reading into this, whatever it will, is reading that the US wants to push for a weaker dollar, or it wants to push for fair value on Asian currencies. And since a lot of them are undervalued, that puts that upward pressure onto them.
Interesting as well, Paul. Yes, you've got the dollar weaker again today, but that the euro isn't such a beneficiary on the flip side of that. Why do you see it continuing?
Yeah, no, well, I think that the euro probably can continue to go higher, depending on how the economy looks. Trump has obviously said that he's not pushing for Europe to get a trade deal anytime particularly soon, and the ECB is still cutting, but you can see that the euro has at least got a bottom in and can continue to appreciate slowly over time.
Paul Dobson, Bloomberg Executive Editor for Asia Markets, walking us through the dynamics in Asia this morning. We thank you so much. I want to bring you live pictures coming out of Abu Dhabi, where Donald Trump is sitting down with business executives at his UAE Business Roundtable. Now, we don't have audio at the moment, but we do want to bring to your attention that this is happening. He's just gone through a walk and talk with various other heads of industry. We had healthcare, we had aviation, we had energy as well. I believe industry was a part of that. So aviation was a big piece of this as well. So lots to discuss in Abu Dhabi as he talks about simply getting $200 billion worth of deals. This is on top of some of the conversations he had in Doha and Riyadh as well.
Absolutely. It's been a huge week, and it's been setting the tone for the markets. You wonder whether there's a kind of hangover effect going into next week that maybe we start to see coming through. There's been lots of glitz and glamour around this whole trip. But the story's been kind of, the tone was set on Monday.
Yeah.
And it wasn't this trip. The tone was set on Monday with the deal that was done between China and that feels like days, it feels like years ago that was the narrative that we were focusing on. We're going to continue to monitor, obviously, what is being said. We're just maybe going to sort some audio out and fix that as we wait and see exactly where that is coming from, but we continue to get comments from the President of the United States in the UAE. Valerie's joining us around the table as well, so let's just bring her into this conversation too. In terms of the arc that we've been on this week, it's been an incredible week.
It's all very bullish.
In theory, well, it's all very bullish. Yeah, precisely. Everything's very bullish. We're making lots of money. Everything's great. Thank you very much. Moving on. But in terms of the arc that we've been on this week, very risk on at the beginning of the week. But we're now getting a more nuanced picture beginning to emerge between what's happening at the Treasury market, what's happening at the dollar, and what's happening with equities. Why are these markets seeing different narratives evolving? Why are they focusing on different things?
Well, at least when it comes to the equity market, I think the reason why it's the second best week of the year is definitely, you can point fingers at the China de-escalation that happened on Monday. Also, what Trump has done in the Middle East around AI that also helped fuel tech stocks as well. So the second best week of the year looking like for the S&P 500. What's leading the Treasury market is something completely different. Deficit concerns have really come front and center as the market is really watching this tax bill make its way through the House. So we saw those long-end yields come very close to 5%. We saw 10-year yields through 4.5%. And curiously enough, right after that, we get various leaks, one from the FT, one from the Washington Post, about this easing of bank capital rules that has been discussed a few times. The easing of bank capital rules that will make it easier for these U.S. banks to hold treasuries on their balance sheet. It feels like last time they leaked this was the last time 10-year yields went through 4.5%.
We're trying to figure out who the buyer of treasuries is going to be.
Yep.
Right? Who is going to be the buyer of treasuries if foreigners are moving away from the market?
If foreigners are moving away, and if we have a deficit that continues to grow. We had some analysis from a think tank that looked at this tax bill in its current form, could add 1.8 percentage points to the deficit as a percent of GDP. That is something that is definitely worrying the bond market. But, if we do get this bank capital reform, and if it's bigger than what the market currently thinks, that could definitely cap yields for now, because banks would step in to be that ultimate buyer of treasuries.
In terms of what else is happening, keep an eye on what is happening with the president. Are we able to get sound from him? I'm not entirely sure at this time. We are hearing, obviously, that he is speaking at the business roundtable. So let's take a listen to what is being said.
8 years ago, the relationship, then it was interrupted, as you know, it was sadly interrupted, and not much happened. Nothing happened, actually. But the relationship is now at a much higher level than it ever was, and it's going to only go in one direction because of the relationship. We have American companies, we have Exxon, Oracle, RTX, Qualcomm, and many others, too many to name. Disney, I see the new theme park is going to be incredible. Bob Iger was in my office the other day, and he was showing it to me. It's going to be incredible. But we're making great progress toward a $1.4 trillion that UAE has announced that it intends to spend in the United States over the next couple of years. Yesterday, the two countries also agreed to create a path for UAE to buy some of the world's most advanced AI semiconductors from American companies, a very big contract.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Happy Friday, everyone. Now, Donald Trump is wrapping up his tour of the Middle East with $200 billion worth of deals in the UAE, but China hawks raise concerns about his all-AI tie-ups with the Gulf. Now, you're looking at live pictures, of course, of the president speaking at that roundtable in the UAE. Let's listen in.
We'll soon have a very safe country. We're getting people out. We need help from the courts. The courts are trying to think that they're taking privilege that they shouldn't have. That was not what the election was all about. The election was they want people that shouldn't be there, people that are criminals in many cases. They want them out. They want them out. We're going to get them out fast. We just reached a fantastic trade deal, as you know, with the United Kingdom, which was wonderful. And we have another big one that we just reached with China. The China deal is a very big deal. It's in the process of continuing to be formed, but they wanted to make that deal very badly. And we have, at the same time, 150 countries that want to make a deal, but you're not able to see that many countries. So at a certain point over the next 2 to 3 weeks, I think Scott and Howard will be sending letters out, essentially telling people, it would be very fair, but we'll be telling people what they'll be paying to do business in the United States. So essentially be paying to be doing business in the United States. I guess you could say they could appeal it, but for the most part, I think we're going to be very fair. But it's not possible to meet the number of people that want to see us. And but this was coming to UAE was very important. Coming to Saudi Arabia and Qatar was very important to me because of personal relationships that I had, maybe more than anything else. So it's been an amazing period of time. People have said very, very, I don't know, we're developing a lot of fans, but people have said they've never seen anything like's taken place over the last 4 days in terms of investment, in terms of the kind of money coming back into the United States. And all that money, the money is a nice word, but it's really jobs. We have jobs that are at a level that we very soon will not be able to. Nobody can duplicate it. And people want to be our partner. They want to be investing in the United States. And they weren't doing that. They weren't happy with the United States for a pretty long period of time. So we've done something that I'm very proud of. We'll be heading back now. And I look forward to that. We'll go back to D.C. I just had a little announcement of a beautiful grandchild, a boy. Tiffany and Michael. So we're very excited about that. I look forward to that. I probably should have left yesterday, but I couldn't disappoint you. Your father would have been extremely upset with me, and you would have been more upset.
He would have understood, sir.
We had such a beautiful evening, and they planned it so beautifully. I said, I'm going to have to wait just a little bit. But the way we were treated by your family, the way we were treated by Qatar, Saudi Arabia, and others has just been so I'm very proud to be representing the United States of America. And thank you all for being here. And media, thank you very much. You've been very fair. Thank you very much.
Mr.
Well, that was, of course, the President of the United States joining and talking from a round table in the UAE. Now let's get straight to Jumana Barsechi, who's been covering Trump's Middle East trip. She joins us, and she joins us now from Dubai. So, Jumana, what do you make of what he's actually been saying?
Yeah, it sounds like that was a bit of a wrap, Francine, after a whirlwind trip around the GCC, visiting 3 nations, as we've been covering on the ground, Saudi Arabia, Qatar, and UAE. Some massive headline numbers coming through. And I actually observed that the numbers got bigger as he moved from country to country. Remember, the Saudi investment pledge was $600 billion. The Crown Prince Mohammed bin Salman saying they're going to raise that to $1 trillion. He got to Qatar. They pledged $1.2 trillion of investments in the U.S., and then the UAE now pledging $1.4 trillion worth of investments in the U.S. over the next 10 years. Of course, these are pledges. In terms of the deals, we did get a lot of firm commitments. In the UAE specifically, we're talking about $200 billion worth of deals, whether it's the Etihad-Boeing partnership. Remember, Boeing and aviation has been a big feature of this trip the last couple of days. Tie-ups between ADNOC and some of those major U.S. oil companies, but then also major development on the AI front, Francine, with the plans to announce this AI campus in the UAE spanning 10 miles. It's going to have a gigawatt capacity of up to 5, which would make it actually one of the most ambitious and largest AI infrastructure projects in the world, even outpacing Stargate. So really significant, but also just underscores how the Trump administration is actually working with these Gulf nations to help promote their own AI ambitions in providing them with some of the crucial high-tech chips that are necessary to power those data centers. So it's a bit of a break from the Biden administration that had imposed chip export controls. The Trump administration seems willing to loosen some of those restrictions, of course, with guardrails, but that raises a few national security concerns back home. But it does go to show that on the back of this trip, President Trump eyed an economic opportunity. He's going back to the U.S. with these commitments, with some firm commitments in terms of deals. And for the Gulf states, it was a major opportunity to showcase to the rest of the world not only their status within the region diplomatically and geopolitically, but also as growing financial capitals, as growing hubs to do business, and also showcasing all of the diversification efforts that these countries have gone and undergone over the last few years, away from oil into other sectors of the economy that open up investment opportunities.
Yeah, a lot to unpack. Jumana, thank you so much. Jumana Barsechi there. Now, the President, Donald Trump, we were listening to him just moments ago, basically saying that he will be heading back to the United States to meet a newborn grandson. In remarks there at that roundtable with many chief executives, he says, we'll see what happens with Russia and Ukraine. He also said that Russia's Putin, well, he will meet him actually as soon as they can set it up. Now, President Trump has also made some major geopolitical moves during his Middle East trip. The U.S. president says he's ready to ease sanctions on Syria. He suggested the U.S. is closer to an agreement to curb Iran's nuclear activity. So let's also bring in Rosalind Matheson, Bloomberg's EMEA news director. So, Ros, he just wrapped up his visit. Was the 3 days in the Middle East, was it about foreign policy or was it just business?
Well, arguably for Donald Trump, foreign policy is business. I mean, the lines there are very blurred, very much a contrast also with the previous administration. And so, in a way, these things intersect. Do these business deals facilitate foreign policy goals for the U.S.? Does the foreign policy feed into the kind of deals that we saw? And this is very much an administration, again, where business, foreign policy really are hand in hand. And we can see that in the deals that were done. I mean, it couldn't really have gone any better, you would argue, for the states involved, for Saudi Arabia, for Qatar, for the UAE. I mean, this was a terrific outcome either for them, in terms of just having Donald Trump there, the effusive comments that were made around the relationships, but also all these deals, pledging investment into the US, but also, as Jumana was just saying, like really getting further leeway to build out the data center business in the Middle East, to get access to chips, even if that is, raising concern in the US, that does it also open the doorway to China? And for Donald Trump, just again, a message about how he operates as a leader. He's willing to do business with countries where the US was previously a little bit cautious. He's willing to do that in a full-throated way. He's willing to do deals in countries where he himself, his family does business, and those lines are also quite blurred from time to time. And he's willing to talk to leaders, again, that the previous administration would not have necessarily. And you can see that, the Syrian meeting that he had with the president, it's all very telling about the way that Donald Trump operates.
Roz, Iran, of course, appears to be casting a doubt on a possible nuclear deal with the U.S.
That's right. There's a lot of noise and rhetoric going on either side about this, and we can see that that's been upending the oil market a little bit the last 2 days as a result. But through all of this, what we know is that Iran presented a proposal to the US. The US has now presented their own version to Iran, which Iran is obviously looking at. But there's no set date for another conversation. There's no formal understanding of when those talks will continue. There is a sense from Donald Trump, from his rhetoric this week in the region, is that he is keen to get a deal done, that he does think a deal is possible. It's very unclear, again, what that deal would look like. There are still a lot of sticking points in it. Iran's position hasn't really changed. They say, yes, we don't want to develop nuclear weapons, but we do want to have the ability to do some enrichment, certainly at a lower level. Those parameters have not changed despite all this rhetoric this week. So this is probably a slow-moving thing. It's very difficult to get to a deal beyond anything that's bare bones very quickly. So the key thing now is, do we see a date for further talks mediated by Oman, and when are they going to happen?
Roz, as always, thanks so much, Rosalind Matheson, there, our Bloomberg EMEA News Director. Now, let's also bring in Monica Defend, head of the Amundi Investment Institute, to talk markets and to talk positioning in some of the major equities that we're seeing. Monica, as always, thank you for joining us. It's been a big week, and actually the market seems, to have gone back to some of the feel-good news that we've had. Maybe it's U.S.-China, maybe it's the fact that some of the data pointed to an okay economy. What do you see being priced in on the markets right now?
Well, probably the most astonishing thing that we have seen on the market is the US dollar and how they correlated it from the equity market. Having said that, it is true that some trade deals are in progress, on, off, pause, but this policy uncertainty is certainly something that as investors we don't like. And eventually this is why we might enjoy the rally on the equity side, but overall we remain cautious on an asset allocation standpoint.
Because, Monica, you think that basically this is only temporary relief and something, ugly could come back, or some volatility, or how do you see the next couple of quarters progressing?
Well, in any case, we do see some slowdown in the U.S. economy. We've seen some companies avoiding to provide a forward guidance for the month to come, just because with uncertainty they don't know how to plan their investments. And when it goes to EPS formation, definitely the pause is positive. We lifted our projection on the S&P 500 operating earnings from 3 to 5%, and in Europe up to 2%. But again, this is subject to the pause to be maintained over time. And as of today, we don't know.
Monica, yesterday I also caught up with Jamie Dimon of JP Morgan in Paris, and this is what he said about a probability of a U.S. recession.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
Monica, you mentioned some of the parts on which the markets are a little bit complacent about. What do you think they're most complacent about?
Well, probably the market is thinking that there won't be a recession just because it will be politically unwise. And the midterm elections are eventually not that far away. So a slowdown, and by how much? Then probably where the market is less complacent is on the Fed, where we see, and on the monetary policy, including the ECB, with a dispersion of projections on the forward guidance, and this possibly might allow some space on the fixed income. For example, on the Fed, we still believe 3 cuts for this year, which is not market consensus. On the ECB, we do expect 1.5 as a terminal rate, which is not our market consensus. So probably some opportunity out there might play out, but rates will stay in a range bound.
Monica, one of my favorite podcasts actually spoke to Raphael Bostic. This is Odd Lots, and he sees 1 rate cut this year. He's also expecting, of course, the U.S. economy to slow down, but actually not fall into a recession. I mean, given what you said and some of the messaging from the Fed, what do you do with treasuries?
Well, on the Treasury, we have been setting up back a positive duration bias. Having said that, we really need to play it tactically. We think the Fed will stay in wait-and-see mode until June. And then, because we pencil in a slowdown in the U.S. economy, not a recession, we think the Fed will go ahead with 3 cuts this year.
What happens after this year? I mean, and you've said that very clearly. Like, if you get 3 cuts this year, do then they slow down? Or is there a danger that actually if they wait too long, then they have to really cut aggressively?
No, this wait-and-see data dependency and probably more policy dependency really doesn't allow the Fed to be so clear in the forward guidance, just because they are uncertain on what is going to happen. And this is reflected on the asset classes, the fixed income as well as the U.S. dollar, as I was mentioning before. And again, this probably the market was all consensual and complacent on this U.S. dollar weakness. That was, by the way, one of our long-term trends that we confirm to be in place. And investors are becoming a little bit more skeptical on a tactical window. So probably we might see some movement on the currency place.
Monica, when you look at China, what happens with China now? They seem to have a pretty good deal, certainly better than we were all led to believe. How do you play China?
Well, on China, for the time being, we stay neutral when it goes to the equity exposure, with a preference for H share to A share. But the deal is imposed in a pause mode. What I think is that on the tech sector, there is a good complementarity between the U.S. and China, and this is definitely a long-term trend that the 2 regions will be following, and that as investors we will need to consider.
Monica, what's the one thing that actually could, I don't know whether there's a play on gold or anything like that shows us the question around basically U.S. exceptionalism. Is gold something that you look at closely?
Yes, honestly, we are overweighting gold for 2 reasons. First is a good hedge and diversification tool at a time where the U.S. dollar is not working anymore. I'm not expecting really a big rise on gold prices for the end of the year. We maintain our hard target at $33.80 U.S. dollar. But at a time where you might have some uncertainty on the fiscal side, on rates, then gold might be a good asset class to invest on or to remain invested on.
And Monica, in Europe, I know there's been a lot of talk about, for example, Germany, their equities, or even some of the bonds, because of this massive defense spending package that's not expected to have an impact on the economy until next year.
Well, probably the European fixed income for a European investor, so in local currency, is even more appealing than the US market. In terms of growth perspective, definitely this is positive, but it will require some time. So honestly, when it goes to the trajectories on the GDP, we do expect this to materialize and be reflected in Germany on 2026 prints rather than now. Having said that, the situation in Europe is much more heterogeneous from a GDP standpoint, while inflation probably is a bit better than what is at play in the United States, and possibly the job for the ECB might be easier than the one of the Fed.
Monica, thank you so much. Monica Defender, head of the Investment Institute at Amundi. Now, coming up, Swiss Re profits rise despite losses from the California wildfires. I'll be speaking to the Chief Financial Officer next, and this is Bloomberg.
It's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome back, everyone. Swiss Re has reported higher first-quarter profits despite losses from California's wildfires earlier this year. Now, the Chief Financial Officer, Anders Mellström, joins us. Mr. Mellström, thank you for being with us. When you look at, the large, catastrophe losses actually in the first quarter, with the hurricane season still to come, how confident are you that you'll meet your targets going forward?
Yes, so good morning, and thanks for having me this morning. Look, I think, as you said, I think we had a very challenging first quarter with high man-made losses, but in particular with high natural catastrophes. But overall, I think we're very pleased with the robust results from the for Swiss Re with $1.3 billion US result, and it came from all business units with strong underlying. Now, looking forward, I mean, the year is still 3 quarters to come. I think overall we feel well positioned to achieve our targets for the rest of the year. So yes, thank you.
Well, I understand that, of course, the increase in natural catastrophes have also coincided with a rapid rise in global temperatures. How difficult is it to understand what the current hurricane season will bring? I think last year was the planet's hottest year on record.
So it's a fact, as you state, I mean, that we will see, due to the climate development, that we see more events, more severe events. It's always very difficult to predict a particular year. I think sometimes you see more frequency, sometimes you see more severity. I think we're prepared for that. I think we also support our clients to be prepared for that. But it is definitely a trend that we see and that our scientists see and that we model respectively to be prepared.
I was going to ask, actually, how do your models change because of this?
So the models, they take into account what we see, and to your point, we see the changes. We see more frequency in certain areas. We see higher severity in certain events. I think that's what we reflect into our models. I think that's what then also gets reflected when we have the conversations with the clients to make sure that also clients understand what's happening, and they maybe also can take actions accordingly.
I mean, we know that the tax rate this quarter was favorable at around 14%. Why was that? And should we expect it to go back to 21% for the rest of the year?
For the tax, usually you should expect a tax rate of 21%. The first quarter, I think we benefited from some transaction-related positives, particular IPTQ, but also other events that just helped for Q1. But in the long run, you should expect a tax rate of 21%.
Swiss Re also reported significant man-made losses, I believe, this quarter, $140 million. What exactly were those?
So when we think about man-made losses, this can be aviation, this can be large kind of fires in plants. I think that's what you obviously, I think, seen in Q1. I think American Airlines, to mention just one, was a significant one.
I know you've also raised your reserves in the U.S. property and casual business, and casualty business, not casual, casualty business. How do you expect that changing over the next couple of quarters?
So we took a significant action in Q3 last year to strengthen our casualty reserves. I think we feel very comfortable. I think what you've seen in Q4, but now also in Q1, is that we actually saw some reserve releases coming through. I think this shows the prudent approach that we're taking. Want to make sure that we upfront take the right approach, and then I think over time we can actually release reserves, and this is what you have seen now also in Q1.
Mr. Malmström, when you look at all of your operations, where are you expecting to grow the most? Is there a region that you think you want to invest in because there'll be more opportunities?
So in general, I think we really take a bottom line view. For us, we don't have top line targets. We have bottom line targets. We'll make sure that we are robust, we have strong underlying results. We can support our clients, which means it's important that we have a strong solvency, strong reserves. So we don't have an area that we say we want to grow more or want to grow less. We want to be well diversified and want to be global, and as I said, want to support our clients.
Thank you so much for joining us, Mr. Anders Malmström, there, the Chief Financial Officer of Swiss Re. Now, there's quite a lot going on in the markets. We checked not only equities, but some of the expectations that are coming through Fed governors. One podcast, actually, that I would urge everyone to listen to is Raphael Bostic, who spoke to Odd Lots. Now, this is the markets right now. Stocks are definitely rebounding. A little bit mixed. The dollar weakening for a second session as large market moves earlier in the week driven by the U.S.-China trade truce seem to be moderated. But in Europe, we're still seeing a big wave of green across the board. I'm looking at the 10-year Treasury yield, a little bit lower after declining some 10 basis points yesterday. Traders pricing in 2 Federal Reserve rate cuts this year. Coming up, Ukraine stands firm after Russia sends a low-level delegation for talks in Turkey to end the war. We'll hear from a high-level official in President Zelensky's team next. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump says China wants to make a deal, quote, very badly, as he addresses business leaders on the last day of his Middle East tour. Hopes fade for a ceasefire in Ukraine as President Zelensky describes the Russian team sent to peace talks as a sham. Plus, earnings in focus, Richemont sales rise on strong demand for Cartier, and Swiss Re profits are up despite losses from the California wildfires. We spoke to the chief financial officer a short while ago. Now, more on our top story, and President Trump has been speaking about the prospects of a trade deal with China during remarks in the UAE. Now, Trump says China is eager for a deal. He also said he wants to meet with Russia's Vladimir Putin as soon as possible.
We'll see what happens with Russia and Ukraine. I think 5,000 young people a week on average being killed in a war that is going nowhere. It's a shame. Should have never happened. But we have other things to do also. Plus, we have an Iran situation, which we're going to take care of. One way or the other, we're taking care of. It'll be taken care of 100%.
Now, the chief executive of the Italian defense company, Leonardo, says Europe is almost in a, quote, war economy. Roberto Cingolani also told Bloomberg he's confident that a major European defense firm will emerge that's capable of competing with Chinese and U.S. rivals. Now, he spoke exclusively to Tommy Ebhardt from the company's headquarters in Rome.
This first quarter, we had an increase of approximately more than 20% year over year. And in general, the financial figures are growing, yes. I mean, needless to say, we are almost in a war economy, and definitely the defense industries are involved, the primary industries to be involved in this race for defense and protection. Now, we should also consider that most of these investments is not necessarily in weapons. Mm-hmm. There's a lot of digital infrastructure, new technologies. So maybe in the future we will have to reconsider how we evaluate the investment in defense, in that it is not only weapons or armored systems, but will be also digital infrastructure, supercomputation, cloud, artificial intelligence, cybersecurity, space. Those things not necessarily been included so far into the true defense investment, but very likely in the future this will be the case.
We have discussed in the past several times about the future of Europe, the importance of euro. You have been working as a minister before getting the CEO job. Do you think we are somehow President Trump is making a favor to Europe, accelerating what you have been advocating for a while, the need for a cohesive defense common system?
Honestly, I don't think anybody's making favors to anybody else in this moment. There is an interconnection or an overlap of economical and financial issues and military and defense and global security issues. Sometimes the situation is a bit confused. For instance, applying tariffs made a shock to the market, but if we see in defense, the impact of tariffs is relatively small. And especially for Leonardo, having local production in US and local sell in US. On the other hand, I understand the argument that there is an imbalancement in the trading situation between Europe and the US, but this economy shouldn't be defense. On the other hand, I believe that the actual situation that has been created in Ukraine after the Russian invasion made clear that, first of all, Europe is too fragmented. So even though we have maybe 1.5 million soldiers in Europe, those are fragmented into 27 armies. We have many fighters, many tanks, many helicopters. We have so many defense platforms that in the end of the day, we're not very effective in the investment of our defense budget. The second thing that I think we should be noticed that no country can make on its own at European level to support and defend Ukraine. So clearly, that was a bell. We have to wake up. We have to create a sort of European defense space. We have to boost the collaboration among defense companies. I mean, creating giants. I mean, if you see how big are the American and Chinese defense companies, they're much bigger than the biggest European ones, including Leonardo. That means facilitating the aggregation. That means favoring the synergy. Sometimes, from the industrial point of view, this means making choices and making priorities very clear. So this is happening, and in view of the NATO alliance that I believe should stay, should remain, should be reinforced, it is very important that Europe gets stronger and that we need to be a solid, more reliable partner in the NATO alliance as a continent. And this will make NATO stronger and ultimately will make for the Western countries life safer in the future.
Now, that was the chief executive of Leonardo, Roberto Cingolani, speaking to Bloomberg's Tommaso Ebhardt, our bureau chief for all of Southern Europe. Now, hopes are also fading for a Ukraine ceasefire after Vladimir Putin sent a low-level delegation to talks in Turkey, while attention shifts to new sanctions to bring the Russian leader to the negotiating table. Well, earlier, Bloomberg's Oliver Crook spoke to the EU foreign policy chief, Kaja Kallas.
He's playing games, which shows that they are not serious about the peace. That is very clear.
Well, Oliver joins us now from the European Political Community meeting in Albania. Oli, good morning. So tell us how the Ukrainians are now approaching these talks now.
Yeah, so listen, Francine, we've just seen a number of different European leaders walk in. We just had the Danish Prime Minister walk in. We're awaiting Keir Starmer, who may pass any moment now. And really the main focus for this EPC meeting, the European Political Community meeting, which is really a brainchild of Emmanuel Macron that was launched after the invasion of Ukraine, is really a focus on European defense. And front and center here is basically the situation right now in Turkey. You're going to have the first contact between Russian and Ukrainian delegations of that level since 2022. We had that confirmed by the deputy of Ukraine's president's office a little bit earlier, who I spoke to, and I really asked him about whether or not there's any reason to be hopeful about these discussions, or is it, as Donald Trump has said in the past, that basically no motion is going to be expected until Donald Trump meets with Vladimir Putin. Have a listen to what Ihor Brusilo told me a little bit earlier today.
I believe that without Zelensky, Trump and Putin, there is no way forward. The only way forward can be is that if Zelensky meets Putin, and that's what President of Ukraine declared a couple of days ago. His readiness is absolute, and he is available anytime to go to Turkey and any other place to meet with Putin to talk about the ceasefire first, and then about all other terms and conditions of the real lasting peace.
And so now the question is, if there is no sort of progress made in Turkey, if there is no step towards a ceasefire, what will be the next steps by the Europeans? But critically, what will be the next steps by the U.S. administration? We should say Lindsey Graham, who is the author of this new potential sanction list out of the United States, was also in Turkey within those discussions. The question will be, at what point will Donald Trump determine that Vladimir Putin is actually the impediment to peace, and will at that point they be willing to move on sanctions? That seems at this point pretty far away.
Ollie, turning to where you are now in Albania, what are we actually expecting this weekend?
Yeah, so for this European political community, this is really a task force of very wide European countries. This spans not just the EU. This also involves Turkey. It involves also the Nordics. It also involves the UK. And so as we await Keir Starmer here, one of the things we're going to be expecting is this discussion around the EU and the UK, a possible defense pact that could be signed as soon as Monday. So defense is going to be front and center. There's also in tandem discussions going on between NATO defense secretaries trying to set up a proposal, because really this is how Donald Trump is running everything. It seems everybody is auditioning for Donald Trump, whether it's Zelensky, whether it's the EU, whether it's NATO. They need to come up with a proposal that is convincing to the United States in order to have continued support from the U.S. and NATO. So there are these discussions about potentially finding a way to reach 5% spend across NATO countries. We've reported on this over the last couple of days. Potentially 3.5% of that would be strict defense spending. Another 1.5% could be sort of more expansive, sort of dual use spending. So these are the kinds of discussions that we're going to have from European leaders here, again, as everybody around the world sort of sets up for this sort of audition for Donald Trump as he finishes his tour around the Gulf.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on this important meeting in Albania. Now, the EU's economy commissioner is warning that China against flooding the bloc single market with goods to avoid U.S. tariffs.
We do have quite a few trade protective measures already in place concerning Chinese goods. It regards, for example, steel, where we have a number of protection measures. More recently, we have introduced anti-subsidy tariffs on Chinese battery electrical vehicles, just to give some examples. And in a sense, if it is necessary, as a EU, we are using those trade protection measures.
Now, Richemont shares have jumped after the Swiss firm's jewelry division saw strong growth. That's as the continued popularity of its Cartier brand made the group more resilient than rivals like LVMH in softening luxury goods markets. Now let's shift focus to private markets, and private equity firms are under growing pressure to generate earnings from their portfolio companies. An extended period of muted deal-making and a slowdown in IPO is really forcing private market companies to find alternate ways to generate cash for investors. Well, we're now joined by Simona Maileare, Global Co-Head of Alternative Capital Group at UBS. Simona, as always, thank you for joining us. I'm so happy to have you in the studio and in person. I mean, it's been, tough, I guess, fundraising in this kind of environment. Are you seeing a little bit of a turn in terms of, appetite coming back?
What we're seeing on the fundraising side is that there is a polarization of money being directed to the best performer. So while in the past, LPs have been quite happy to diversify and sprinkling a bit their investment across a variety of funds, today is no longer the case. And this is driven really by the fact that distribution have missed expectations. When you look at the growth of the industry in the last 10 years, the assets under management have grown by threefold, while the distribution, the cash, has been reduced in percentage of the net asset value. So there will be winners and losers in the fundraising game, but funds which have consistent performance, a very differentiated approach to investment, will get the majority of the investment, and the others either will go into runoff or they will need to be consolidated.
Simona, do you think there are new avenues for fundraising for a lot of private funds that are tackling these difficulties? Like, what are they exploring right now?
Wealth management is clearly the channel where everybody is going towards. So we are seeing products being, while in the past it was just creating feeder funds and using wealth management platform to distribute funds, now the industry has become much more sophisticated, and we're moving to creating products which sometimes have a bit more liquidity than your traditional private equity fund to appeal to a broader investor base.
Simona, just hang on one second, because I think Oliver Cook is speaking to Keir Starmer, so let's listen in.
relation to sanctions. But for me, this is clear evidence that Putin doesn't seriously want peace. He's dragging his heels, and that's why today is a really important opportunity to work with colleagues to make sure that we are absolutely united. And President Zelensky will be here today, so we will be discussing the situation with him.
On the Brexit reset, how are the talks going? Will you have talks on the sidelines ahead of the Monday summit?
Well, in the last 2 weeks, you've seen the UK do a trade deal with India, really important for our country and our national interest. Trade deal with the US, again, important for our country and national interest. I'm positive going into Monday, and I think that this is an important moment for our country that will be measured in the benefits to working people and their living standards. But we're positive as we go into the summit on Monday. Thank you very much.
Thank you. We'll get over the thorny issues, the fishy ones?
So that was the Prime Minister, of course, of the UK, Keir Starmer, speaking to reporters there in, of course, where Oliver Cook was. Simona, I mean, there's a lot of, we'll go back to, some of the private funds and some of the fundraising they're exploring, but overall there's been a lot of trade news. We're expecting UK, EU, the summit to be on Monday. Anytime there's positive news from trade, does it actually help with fundraising? If you look at some of the things that fund managers are trying to do to lure investors, is short-term confidence a real game changer?
Yes, it definitely is. And it's not only short-term confidence as a very important effect that helps the deal environment. And what we were discussing is that the LPs are still committed to the private capital industry, but they need distribution back. And the distribution is driven by the deal environment. Now, as you know, we started 2025 hoping for the animal spirits and this sluggish deal environment to improve. We haven't seen that, but actually it has been better than expected, because when you look, for example, better than we think, in April, the M&A in the US has gone up. There have been amazing deals, big deals in the tech sector, in the software, fintech. So if we keep the deal machine going and the liquidity going up, this virtuous circle will restart again. So all these signals are very encouraging.
But are there, it's still a very small trickle of deals, right? So are some smaller private equity market players going to be in trouble?
I think the smaller, undifferentiated, with poor track record will definitely be in trouble. The industry has grown maybe too much over the last 10 years, so a bit of rationalization might happen. So one of the trends we are seeing is consolidation. So you will see larger players trying to acquire small one to maybe enter new countries or to enter new strategies as well.
What do you see on fees? Are you seeing fund managers, for example, using discounts to lure in investors?
We're seeing more creativity, early bird, more complicated structure, this for sure. But I think overall there is still liquidity that is going to go around.
And Simona, do you really see a differentiation depending on the regions, on the countries where you're looking at actually doing some of these deals?
Yes, there is definitely differentiation. So when you look at Asia, the US, and Europe, to do biggest generalization, I think in Asia they are looking at Europe now in terms of an avenue to diversify from the domestic Chinese market, where most of the capital is flown, or they're looking at India and Japan. In Europe, we're looking at some cross-border as well, but there is a lot of intra-regional activity as well. I think the US is the one that is taking a pause and look at around the world and figure out who their friends are.
So interesting. We'll have to get you back in a couple of months to see more on that. Simona, thank you so much for joining us. Simona Maileare there, Global Co-Head of the Alternative Capital Group at UBS. Now, coming up, we'll be joined by the chair of the Indonesia Chamber of Commerce, fresh from his visit to Doha, where he attended the state dinner with President Trump and the Emir of Qatar. That's next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Welcome back, everyone. Now, the conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Indonesia has offered to buy more American commodities, including oil, as it seeks to rebalance trade with the U.S. Indonesia has emerged as one of the 18 countries being prioritized for trade talks by the Trump administration. With us now, Anindya Bakri, the chair of the Indonesia Chamber of Commerce and Industry, but also chief executive of the Indonesian conglomerate Bakri and Brothers. Thank you so much for coming back on The Pulse, Mr. Bakri.
Thank you very much, Francine, for having me here.
You've just come back also from the state dinner in Qatar. We're looking at pictures that were really quite extraordinary. I mean, this is a big week in the agenda of President Trump, but also in the Middle East, where deals were signed and there seems to be a much more normalization. What do you take away from Qatar?
I think, first of all, it was a very good state dinner, but everybody came away with a positive vibe, right? You see a lot of trades being talked about, investments, you see the headlines, but most importantly, the peace and stability in the region, in the Middle East, I think will be achieved. And that's very important for the world, especially us, Indonesians. We come from Southeast Asia. Next week, we're going to have ASEAN, which is the Southeast Asian organization. So looking at that, I think people are looking forward to much better second half. And of course, going forward as well.
I imagine Indonesian business wants stability like all businesses around the world. And there was a sense in the last 5 weeks that President Trump's policies were a little bit unpredictable. Do you feel after this week in the Middle East, but also talks with China, that we have more of a stable footing, that we understand more what the future looks like in terms of business?
Yeah. So, for example, Francine, 2 weeks ago, I was in the United States. We met our counterparts, U.S. Chamber of Commerce, U.S. ASEAN Business Council, Business Roundtable, and even National Council of Wheat, Soybean, Meat, Dairy, just to understand what they think about these tariff possibilities, right? They actually feel they really want to do a deal very quick because any tariffs increase will, of course, bring inflation to them. So I think they will put a lot of pressure to the government, and I feel it when I was there. Now, from our side, you know, the total trade with the U.S. is about $40 billion. And the U.S. is the second biggest trade partner of Indonesia, the first being China, about $130 billion. The surplus of $18 billion goods can be mitigated, as you mentioned, as we can import more oil and gas derivatives from the U.S. But I think what's interesting, in 2 to 3 years, we can actually double that 40 to become $80 billion. We will import a lot of soybean, wheat, cotton, also meat, dairy, but we want to export a lot of the same things such as electronics, furniture, footwear, garment. But what's also interesting, as we are talking anyhow in the next 45 days, what we see the government is also putting critical minerals into the mix. And that's interesting because, you know, that will be a nice investments, co-investments opportunity between the two countries. And lastly, I want to say, Indonesia just launched the Sovereign Wealth Fund around 2 months ago, $900 billion AUM, so we can also co-invest somewhere in the value chain with the U.S. So a lot of things have changed and triggered from these current tariff discussions.
I mean, things have changed for the worse, or actually for the better. I understand. Again, this is an ongoing negotiation. It's interesting that critical minerals, energy, and manufacturing will be impacted.
Yeah.
But does it change your supply chains? How does it change, like the fabric of business?
Yeah. First of all, I'm speaking on behalf of the private sector.
Yeah.
Right. The government will do what is right for both governments. But what I feel is that it unlocks a lot of the possibilities for Indonesia on many fronts. So, for example, before we are exporting, the garment, electronics, furniture, and so on. Now we're talking about processing critical minerals. People understand that we have the largest nickel reserve, top 5 in terms of gold, copper, and so on in terms of bauxite and tin, right? So we can process it halfway. Other than also sending it to the east, we can also sending it to the west. The second thing also, the co-investment opportunities. We have about dividends as a country into the sovereign wealth fund, about $10 billion unlevered. Now we can also think about upstream opportunities, for example, in the U.S., while the U.S. can also invest in the downstreaming plan of Indonesia. And lastly, what I would like to also mention is that the trades can make both countries go up the value chain, but we want to be very careful because we want to be very much balanced, right? We are doing a lot of businesses with everywhere in the world, with China. We joined BRICS, for example. We are in the accession of OECD. So Indonesia now, hopefully, will be Indonesia better in the future.
I know the French president is coming, I think, at the end of May to Indonesia for a state visit.
Yes.
How does your relationship with Europe changes because of what's happening with U.S. trade?
So, for example, President Macron is coming at the end of the month, but also the Premier of China also come to Indonesia at the end of the month. So you see how Indonesia is trying to, just like how Qatar is in the Middle East, for example, Indonesia as the biggest country in ASEAN, Southeast Asia, the only one representing G20, we want to play a role, but ultimately we want to bring welfare to our people, but also to the world.
Can you do both? I mean, if you try and be in the middle, how difficult is it to have a good relationship with China if you're trying to negotiate with Donald Trump?
Actually, Francine, if you think about it, number one trading partner is China, number two, the U.S. The U.S. wants it balanced, and we support, and we want to increase it 2 or 3 times. So maybe, net, we can also benefit. But again, I'm not here to say everything is easy, right? Inflation is okay for Indonesia. We're at 2 to 3% max.
Enviable for most countries.
Yes, thank you. But, if the world is having inflation, our trading partners are having inflation, it's not good for anybody.
Yeah, thank you so much for joining us on air today. That was Anindya Bakri, the chair of the Indonesian Chamber of Commerce and Industry. Now, also don't miss the new edition of Bloomberg Weekend newsletter, where you can get deeper analysis, feature pieces, and profiles that provide unique insight into the latest news from around the world. I know this week we're really focusing on some of those trade wars, trade agreements, and trade tariffs. Now, stocks pretty much mixed. The dollar weakening a touch for a second session after some pretty large market moves that we saw earlier this week, driven by the U.S.-China trade truce that was moderated. I'm also looking at 10-year Treasury yield lower after declining some 10 basis points yesterday, as traders pricing in 2 Federal Reserve cuts this year, and then a gauge of global stocks pretty much on track for an 8th day of gains, hitting levels not seen since February when it set a record. Up next, Bloomberg Brief, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to
continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Getting cautious, the latest hedge fund filings show investor titans moving into cash and away from U.S. tech. A crypto hack, Coinbase moves to contain the fallout after a major breach of its customer data. And consumer resilience Richemont sales jump in Europe, and we'll get a read on the U.S. with the UMich survey out later today. 4 consecutive days of gains. Can we make it 5? It is an equity market that is attempting to do just that in the future session so far this morning, up nearly 0.3% for your S&P 500 futures. We outperform on the NASDAQ. We are up now nearly 19% since the lows in April. You also had some easing in the pain of the bond market yesterday. You had easier PPI data. Oil came off the boil with hopes of an Iran and U.S. nuclear deal. All of that leading into, are we pricing in something of a soft landing again? Maybe more cuts because things and inflation look more benign. We continue to rally in the bond market this morning. We're at 3.9, back under 4% for your 2-year yield. Your 10-year yield stands at 4.4. We were at 4.45 at this time yesterday morning. So definitely a more benign yield environment. Let's look underneath the hood now and get some stocks that are moving in the pre-market session. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Applied Materials, really the weak spot this morning, sliding following a miss on its bookings numbers in terms of the US. Its biggest machinery chip company listed in the US markets. We're down around 6% for that one, a tepid forecast from Applied Materials today. Then Take-Two over in video games. Again, it looks like weakness on the bookings for the year ahead. Missing some analyst expectations by around $1 billion. And we're all still waiting for Grand Theft Auto 6. Probably won't see me for about a week when that game comes out. We've been waiting around 10 years for that game, and it's not helping that stock this morning. We're down almost 4% for that one. Then finally, Nvidia, Michael Berry up to his old tricks again, taking out some put options on that stock before the stock fell. It's therefore doing pretty well, according to some 13F filings released yesterday. Let's hope he got out of that trade before the stock recovered. But Michael Berry of Big Short fame doing well. Nvidia, though, edging out very slightly in the pre-market. And as usual, take a look at the before the bell opening wrap for a wrap-up of all these stories.
So, Joe, if you disappear for a few weeks, we'll know where you went if it coincides with that release. Joe, thank you so much.
I'll be completely AWOL. You better dispute.
I love the honesty. Joe, we'll catch up with you later this hour. Bloomberg's Joe Easton there. And in just moments, Michael Sneed of BNP Paribas will be joining us. Later this hour, Jose Torres of Interactive Brokers. Now, the team over at BNP Paribas weighing in on the recent stock rally, writing, quote, "It is notable that positioning in the U.S. and European equities remains relatively light, suggesting that participation in the recent equity recovery has been muted. expect this to result in support for dips. Joining us now is Michael Sneed, head of cross-asset and macro quant strategy at BNP Paribas. Michael, great to see you this morning. And it's been a remarkable recovery. I mentioned we're up nearly 19% for the lows. If participation has been low in that, what's been driving it? And what does that say about how much juice is left in the rally?
Hi, good morning to you. Thanks for having me on. So yeah, incredible rally this week. Really off the back of the news flow really at the start of the week, reducing some of the tail risks, both the upside tail risk to inflation and some of those downside tail risks to growth. So for example, we have increased our likelihoods that we'll have a kind of our base case outlook this year that there won't be a recession in the US. We've increased that likelihood from 60% to 70%. When we think about the equity market rally, as you mentioned, Danny, the participation looks like it's been kind of reasonably low. And what I mean by that is on the quant side, we run positioning metrics that try to identify how are investors at the moment positioned across different markets. And we saw that investors pulled back on a lot of their positioning early April with the market turmoil. As we've had the stock market rally, you haven't had investors really aggressively add positions. They have increased positions, but overall positioning is still much lower than it was in equities, than it was at the beginning of the year, particularly in US and Europe. So the price move has been largely driven off the kind of change of the economic outlook. And going forward, what this suggests is that there could be some more flows to go into equities. But I think it's quite a challenging backdrop for equity investors. You've now had this dramatic rally. You probably could get some buy on dips if you were to see a dip in equities. The other question I think that a lot of investors are asking is what about diversification? Because when you look at how equities have been forming versus bond markets, you've not been getting that diversification. You didn't get it during the market turmoil earlier in April. And so a lot of discussions we're having with clients is, how can you provide some diversification?
Well, Michael, on the point of the volatility, and I'm sure this is something you closely track, it may be difficult to answer because every model has different time horizons. But when you get these types of spats of volatility, surely you have more systematic type strategies that pull back from equity because of that volatility coming in. If that is the case and we're starting to normalize, how long does it take to see some of these types of investors to dip their toes back into the market?
So it can normally take a couple of months. So as that vol comes down, it then feeds into the algorithms of how much risk can be put back on. And this is actually one of the kind of factors that could continue to support equities from here. As although the prices have rallied, if you look at, say, the way that CTAs are likely to position going forward, they're still likely to be buyers of equities.
Michael, you also put in your notes that some of the data surprises have turned negative. And this comes after a period where the data really has not started to reflect the tariffs. And we're just getting a slight view into that now. CPI from this week, you could argue, started to show the beginning phases of tariff-effective data. If that's just starting to creep in, do we have a problem? Do we have a problem of equity markets just starting to rally as the data, hard data, might soon start to reflect the consequences of tariffs?
Yeah, I think this is a theme that could really kind of disturb the kind of more positive status quo that we've had this week. So if we think about the economic outlook to the end of the year, that's certainly looking more positive this week, as I mentioned, with kind of the change of the probabilities for our base case. But if we think about the path over the coming months, we will likely have this very mixed data flow. And really what's key here is some of the kind of the lags of the information flow that the market receives. So the data that we'll be having now, as you saw kind of with the retail sales yesterday, is going to be reflecting some of the uncertainty that we had back in April. We also see on our measures, the relationship that it tends to take for the time that you get a shock to financial conditions to feed through to data can be up to 3 months. So actually there's an argument from a kind of a data science and evidence perspective that actually the softness of data that we're seeing right now is more because of the tightening of financial conditions that took place more in February, March than in April. So that suggests that we could continue to get some more headwinds to economic data coming up over the coming months, which then makes thinking about the outlook for this year a bit more challenging.
Okay, so tell me why you're adding to long duration positions then, Michael, because this has been a tricky one with 30-year yields bumping up around 5%, easing off of that. What's your take there?
So here there's really kind of two opposing dynamics. So in the short term, this negative data surprise trend that we're having, expectations that you could get data weakening in the short term because of the headwind of financial conditions, that we see as being positive for duration. On the other hand, if we think about the other kind of key theme that investors are likely now to turn to, now that tariffs are going to be kind of less of the kind of headlines driving the markets, we have the fiscal situation in the US and the upcoming discussions around the new fiscal bill. And here, what's really going to be important for the market and important for the bond market is the extent to which the US government is being seen as being kind of bond vigilant, that they're conscious that they don't want to allow the term premium to rise, they don't want to be seeing as being kind of too loose on the fiscal front. If you do continue to get signs that the administration is bond vigilant, which we think they are, then that will allow kind of term premium to compress, and that can be supportive for fixed income in the US.
No, Michael, just quickly, is it really about the level or the pace? Because even though bond yields have been moving up, it's been an orderly type of sell-off. Is that really enough to try to bully the administration and and Congress to being more prudent when it comes to fiscal policy and deficits?
I think when it comes to administration, the pace is kind of important around their kind of responsiveness. The level is important in terms of the kind of projection that the CBO has for fiscal costs, so therefore feeds back to the administration. And I think also what's key in terms of level is investors. It's looking at fixed income and seeing that there's good value. Our short-term valuation metrics do show that there is value in fixed income at the moment. But just looking at the levels historically, the yields that you're getting on 10-year, 30-year bonds are also looking relatively attractive.
All right, Michael, thanks so much for joining us this morning. Enjoy the rest of your Friday and your weekend. Michael Sneed of BNP Paribas. All right, let's get you some other top stories that are trending on the terminal this morning. Michael Burry was buying puts on NVIDIA and Chinese tech stocks in the first quarter, right before President Trump rolled out his Liberation Day tariffs. The latest filings show that Burry's Scion Asset Management liquidated almost its entire equity portfolio in the first quarter before taking the bearish wagers. And Coinbase said Thursday that it refused to pay hackers a $20 million ransom. The U.S. crypto exchange said that cyber criminals bribed its customer support agents to gain nearly constant access to sensitive user data, which includes names and birthdays, since January. The hack is expected to cost Coinbase $400 million. And Richemont posted a rise in full-year sales thanks to the popularity of the jewelry division's Cartier brand. The Swiss luxury group was more resilient than its luxury rivals. Richemont shares are up 20% this year, while LVMH has declined nearly 19%. Coming up, President Trump wraps up his Middle East trip in Abu Dhabi. We'll have more on that coming up next on your Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
At the same time, 150 countries that want to make a deal, but you're not able to see that many countries. So at a certain point over the next 2 to 3 weeks, I think Scott and Howard will be sending letters out, essentially telling people, it would be very fair, but we'll be telling people what they'll be paying to do business in the United States.
President Trump wrapping up his first overseas trip of his second term in the Middle East with a promise of incredible investment back into the U.S. Joining us now is Bloomberg's Brendan Murray. And Brendan, we heard there from the president as he starts to end his Middle East trip. What have been the takeaways of a very headline-heavy visit?
Yeah, well, the main takeaway is that the president spent the week in this region to try to get the flow of investment, of money back to the U.S. for things like factories and advanced equipment investments that some of these countries have committed to doing. The UAE is building funding an aluminum production facility. The president said so. The main thrust of his goal this week was to get the flow of money back to the U.S. He spent the first 4 months of his presidency, his second term, trying to get trade flowing, trying to renegotiate trade deals. So that would be the main takeaway from the 5 days that he spent there.
If you also look at who's been accompanying Trump on this trip, Scott Bessent was also in the Middle East as well. And Trump said this just about an hour ago, that Bessent will be sending letters to countries, that Bessent to say what they have to do, what they have to pay to do business in the U.S. Brendan, is this Scott Bessent fully in control now of American trade policy?
That's what it sounds like from what we heard from the president today. I think the main takeaway from those comments about the 150 countries is that the U.S. administration is overwhelmed with the amount of trade negotiation that it needs to do. There are a number of talks going on bilaterally with India, with Japan, with South Korea, with China, and that as the president said, there are 150 countries that want to do deals, and there just isn't the capacity to handle that. So it sounds like a lot of those countries are going to get a letter saying this is what your tariff rate is. Now, he was vague on the details. He said this is what they're going to pay to do business, but it sounds like that those reciprocal tariffs that the president announced on April 2nd, some of those countries are going to get a letter saying this is what your number is.
Will they be willing, though, to accept frameworks akin to the UK, akin to China, Brendan? Because, for example, the FT reporting this morning that Japan appears to be holding out for a better trade deal.
Yeah, exactly. I think one of the things that's coming to light as the weeks progress is that 10% floor, that 10% reciprocal tariff rate floor, isn't going away, and a lot of countries want it to go away. South Korea wants it to go away. Japan does too. There are a number of countries that have free trade agreements with the U.S. that say, look, we've got zero tariffs now, and that's the rate we want. They're going to find out. It appears very quickly that rate is not going anywhere, and that will be the minimum number that every country is going to get.
Okay, Brendan, thank you very much. That is Bloomberg's Brendan Murray. By the way, President Trump also saying at one point that when Scott Bessent speaks, markets go up. It appears that he has been paying attention to the research over at Renaissance Macro and Neil Dutta, who ran exactly that study that when Bessent speaks versus Lutnick or Navarro, markets do indeed go up. So perhaps that's part of the reason why Trump has ceded a lot of the trade talks over to Bessent. Now, let's go over to Europe because officials are gathering in Albania as hopes fade for a Ukraine ceasefire. Bloomberg caught up with the deputy head of the Ukrainian presidential office. Take a listen.
I believe that without Zelensky, Trump, and Putin,
there is no way forward. The only way forward can be is that if Zelensky meets Putin, and that's what President of Ukraine declared a couple of days ago. His readiness is absolute, and he is available anytime to go to Turkey and any other place to meet with Putin to talk about the ceasefire first, and then about all other terms and conditions of the real lasting peace.
Let's bring in Bloomberg's Oliver Crook, who is there at the European Political Community meeting in Tirana, Albania. Oliver, just how far away are we from something of a ceasefire in Ukraine?
So it sounds from everybody we've spoken to, whether it's the Ukrainians and a number of the leaders that have just walked by here, and just to remind everybody what this is the European Political Community Summit. This brings together 47 leaders from around Europe. This is a very wide group of people. This includes the UK, the Nordics, as well as Turkey. And this is a sort of meeting that was set up in the wake of the Ukraine war, really to discuss issues of defense and European competitiveness, and has sort of been turbocharged by the Trump presidency, where Europe really begins to imagine itself as a continent alone. And really the sort of main focus today is going to be on Ukraine. Zelensky will be here, and really any kind of contact and the discussions that we have in Turkey today. We should say that this is the first sort of not really high level but mid-level talks, direct contact between Ukraine and Russia. That will happen today. We've got the confirmation that those two groups will be meeting today. But when you talk to the leaders coming in here, there's really any kind of skepticism that Putin is being serious about making progress on these talks, getting towards a ceasefire. The question for European leaders really fundamentally has been, really for a number of years now, what is it that they can actually do? They've really maxed out the sanctions at this point. There is not a sense that the Europeans can do a whole lot more, and everything will really basically reside with Donald Trump. Lindsey Graham was also in Turkey yesterday. He is the sponsor of a bill before the Senate that would bring out what he called bone-crushing new sanctions on Russian oil and gas. That would be the next step if the Europeans and Zelensky are able to convince Trump, which they have not been able to convince him of yet, that Putin is actually the impediment to peace here.
Well, it seems like there is a desire to have at some point a sit down between Trump and Putin themselves. Marco Rubio talking about it after a NATO meeting in Turkey. Trump saying something similar, that nothing's going to happen until he meets the Russian leader. Oliver, is that even on the calendar, a meeting between the Russian and the American leaders?
Listen, it's not on the calendar as of now, but they've been teasing it now for a number of months. You know, even really before he was inaugurated as president, the discussions about whether Putin and Trump will meet. And listen, you know, Trump had demonstrated some willingness to show up in Turkey on Thursday if Putin were to show up. We know that Zelensky was there. But again, this is all going to be down to basically the rhythm that Putin sets and the discussion that he sets out there, because he's not going to want to be seen to basically convening under Zelensky's initiative. And we should say that really the sort of tone from Zelensky has changed dramatically since that Oval Office visit. You see it every time. Basically, every time Trump says jump, Zelensky says how high. We're going to jump even further. We're going to be there for this talks. We're going to be there for the conversations. It has yet to yield a sort of a concrete result in terms of more progress and more sort of sympathy from the Trump administrations on the Ukrainians, but they're trying their absolute hardest, and they're going to be making some more progress on that minerals deal, which we're seeing as sort of the key next step in order to gain U.S. support and potentially security guarantees for Ukraine after a ceasefire.
Hey, Oliver, just quickly, because we do have a NATO meeting happening in June. I'm glad you got the umbrella there, starting to get rainy over there. You have a NATO meeting in June. What is the setup for it? What are members there trying to do in advance of Donald Trump and others coming?
Yeah, so listen, when you think about how Donald Trump is running foreign policy in the United States right now, it feels like everyone is basically auditioning for something, whether it's Zelensky, whether it's the EU on trade, and all the sort of different trade partners, and it feels very much that way for NATO, right? Everyone is still auditioning that NATO is still a sort of legitimate force that can really bring something to the table. So what we've got right now are side meetings from the defense ministers of NATO, namely the European ones, discussing possibilities of a new sort of reinvigorated NATO, of what they can present to Donald Trump when he arrives in The Hague at the end of June. And what we've heard repeatedly from the President of the United States is that he wants to see 5% GDP spend, which of course is a huge sort of volume of spending. This is not the kind of spending we've seen out of Europe or really many countries in a very, very long time. So they're trying to find ways to basically fudge that a little bit, 3.5% on defense, maybe 1.5% on dual use. And those are the conversations happening right now in advance of that NATO meeting where Trump is expected to attend at the end of June.
All right, Oliver, we'll let you get indoors and get dry. Thank you so much for joining us. That is Bloomberg's Oliver Crook. Coming up, a major disruption expected in your commute this morning. If you are coming from New Jersey, the New Jersey Transit on the brink of a shutdown. We're going to have the details for you on the worker strike coming up next.
makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Let's take a look at the front pages this morning. The New York Times reporting on the first statewide transit strike in New Jersey. In more than 40 years, tens of thousands of commuters are expected to be affected after more than 450 engineers walked off their job in a pay dispute just after midnight.
We are going to remain open to sit, discuss, negotiate, to do whatever we can to bring this to a positive outcome, which is, again, meeting both objectives. A fair deal for them, and a deal that does not blow up our fiscal reality.
Good luck on your commute this morning if that's affecting you. And the Journal leading with Meta postponing the rollout of its flagship AI model, Behemoth. Journal sources say that the delay has prompted internal concerns. Some engineers questioned whether the model has improved enough to justify public release. Coming up, we get back to the markets. This is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But An algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Getting cautious, the latest hedge fund filings show investor titans moving into cash and away from U.S. tech. A crypto hack, Coinbase moves to contain the fallout after a major breach of its customer data. And consumer resilience, Richemont sales jump in Europe. We'll get the latest read on the U.S. consumer with you, Mitch, on deck. 4 consecutive days of gains will today make it 5. S&P 500 futures moving 0.25% higher this morning. Same goes for the NASDAQ and Russell 2000. The latest leg in this rally coming from softer PPI and lower oil prices. And does that mean we'll get cuts that are cuts because of soft landing, not because of fears of recession? You see yields move lower this morning after moving lower yesterday. We're back below 4% on your 2-year yield. Your 10-year yield moves below 4.4% this morning. That's lower by about 3 basis points. So those are your overall markets. Let's get some stocks to watch. Back with us is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So Applied Materials really the big decliner in the tech market today. We're seeing that stock down more than 6% in the pre-market as the maker of semiconductor machinery, the biggest in the US, reports a miss on its bookings guidance for the year ahead and really hitting that stock this morning. Then we got Take-Two also declining in the video game space. A lot of focus on Grand Theft Auto and when the 6th version of that will eventually come out. 13 years we've all been waiting for that game to come out. As I said earlier, you won't see me for a very long time when it does eventually get released. But that stock down 3.8% in the pre-market following that update. Then over in a bit of a niche sector, it is space tourism. We're seeing Virgin Galactic soaring. Take a look at this one. We're up 20% in the pre-market. Richard Branson founded a company saying last night that it's going to increase the price of its trips to space for space tourists, already charging around $600,000 per trip. I thought my recent holiday was expensive, but that is pushing it a little bit. We're seeing that stock, though, gaining. The company beating on expectations in their latest quarterly earnings report. Down in the small caps, but a big gain at around 20% in the pre-market this morning, Danny.
Yeah, well, luckily, I don't think the Fed is too concerned about space tourism inflation. So at least that's one we can rest easy about. Joe, thank you so much. That is Bloomberg's Joe Easton. Enjoy the rest of your weekend. All right, President Trump's Middle East trip is coming to a close. Jose Torres of Interactive Brokers weighing in on the trade momentum in the talk, saying the dynamic signals a bullish landscape where the focus is shifting in forcing to re-accelerating economic growth on the back of robust capital expenditures, lighter taxation, mild regulations, low energy costs, and incremental progress in onshoring manufacturing activities. I'm pleased to say that Jose joins us now. Jose, good morning to you. Thanks for joining in studio.
Good morning, Danny. Always a pleasure to be here.
So I don't know, this sounds pretty positive. Have we basically done a round trip? Are we back to where at the start of this year, hoping for more deregulation and tax cuts?
Well, that's where U.S. investors are right now. You know, the biggest negative of the Trump policy mix happened to be trade. And with those agreements done with the UK and the break on China, there's a lot of optimism going forward that a lot more agreements are going to be getting done soon. So now the focus is shifting to the more positive aspects, a more traditional GOP playbook, which is lighter regulations, lower taxes, lower energy costs, and then onshoring manufacturing. That's going to be more of a slow-moving force, but we think that that's going to provide more earnings growth for corporate America in the years to come.
Can you completely write off the impact of tariffs, though, at this point? Because even if, let's say, the agreement lasts between the U.S. and China, where it's 30% is still higher than we were pre-Liberation Day.
Absolutely. And, you know, with China, there's going to be more of an adversarial posture on trade in terms of those tariff rates. And with Beijing 30% is probably going to be one of the most highest rates. Other nations are probably going to be around 10, 15, 20. We saw during Trump 1.0 that the U.S. economy did fine having an adversarial posture on cross-border commerce against Beijing. We didn't have much inflation. Economic growth in some quarters was north of 4%. So we think that as long we can maintain our rivalry with China as long as we get along with everyone else somewhat.
Well, there's this fear, and Daria Perkins of TS Lombard posting about this idea that if we had had the extreme tariffs in a recession means disinflation. But he posited the question, if we get lesser tariffs and strong growth, does that equal inflation? But it sounds like you're less concerned about inflation if you're using the playbook from Trump 1.0. Is that fair?
That is fair. I am less concerned. Goods as a percentage of the economy every year continues to decline, and we have offsetting factors. Yesterday's numbers from PPI, what a bifurcation. Core goods accelerated at the fastest rate in 27 months. But the headline PPI dropped at the fastest rate in 60 months, back to April 2020, the depths of COVID. And that just goes to show you have the countering effects of services, food, and energy really blunting the goods cost. And the President Trump and the administration has known this from day one, and that's why they've been talking about drill, baby, drill, trying to really ramp up oil production, even though under the Biden administration we had terrific production numbers, but really that mantra has helped to keep oil prices subdued.
What we're hearing from Fed speakers. Raphael Bostic was on the Odd Lots podcast. They just released it this morning. I was just looking over some of the things he said. He called it a period of tremendous transition, that we have to push against inflation pressures from tariffs, and that uncertainty is unlikely to resolve itself quickly. This is a Fed that's still trying to defend against inflationary pressures. Do they have the wrong posture currently, given what you're talking about?
I think that they're a little too hawkish. I think they should be lighter. The CPI is at 2.3%. The headline PC is somewhere around there as well. You're right near the 2% target. We haven't seen that labor market weakness. As soon as you see that, however, I think they're going to turn so quickly like they did last year in, you saw that June, July, weaker payroll numbers, September, bam, you got a double quarter, half a point hike, aggressive move downward. Our prediction markets expect that too. They expect few rate cuts into year end, about 3, also heightened economic growth. And since we've had this progress on trade, expecting lower recession risk.
So if it's lower recession risk, inflation isn't a problem. Could we get back to the world where we're talking about soft landing cuts again, that they're cutting because inflation looks more benign and rates are too restrictive given that? And the thing that had really juiced markets before, it kind of sounds like we might be heading down that path again, given what you're saying.
I think inflation is going to stay a little above target. I think we're going to stay around 2.5. We might get to 3, but I think we're going to stay below 3. I don't think that that's a where the Fed's going to come out and want to hike with the CPI, let's say at 2.8%, 2.9, 2.7, but it's still a very constructive environment for stocks. We saw in 2023 and 2024, these were years with high inflation, and stocks did great in excess of 20%. So if you have a little bit of higher inflation, that compounds over time quite rapidly, and you have a central bank that's not particularly apprehensive, then you can run higher in stocks despite these elevated valuations.
Did you make anything of Fed Chair Powell saying yesterday that they were reconsidering the language on average inflation targeting? So in other words, in COVID, they let it kind of move around 2%, but they were reconsidering that framework. Did you make anything of that?
Yeah, for a while now, especially since COVID and going back to the 2008 great financial crisis, there's been a move away from, for example, the CPI to the PC and trying to modernize inflation measuring and where the Fed should be. So, the monetary policy is constantly evolving, same as the economy. So, we got to be ready to hear and see what changes are coming through.
Well, we're going to get University of Michigan's survey, and that has really been brushed off as something that is political. But the Fed cares about you, Mitch, and Bank of America laying it out yesterday, also saying it doesn't really matter why it's moving, even if it is political, if inflation expectations are going higher, or if just general feelings about the economy are moving lower. It's something that the Fed has to pay attention to, even if it's driven by Democrats and independents, for example. How much value do you put in some of these survey measures?
A lot less recently, and for so long, these consumer sentiment and confidence figures have been a leading indicator of the economy. Once they've started to decline, consumer spending has dropped, and then we've gone into a slowdown. But since COVID and with and it goes to your question earlier about how things have changed so dramatically. Consumers see the stickers when they go out shopping, and that really moves inflation expectations in their mind. But we look at market-based inflation expectations in the Treasury market. There's a wider gap between what people think inflation is going to be and what fixed income investors actually think. And actually, interestingly enough, I was with one of your colleagues, Jonathan Levin, in Miami. We were actually talking about this discrepancy between where consumers think inflation is going to be and where the Treasury market implies it. Inflation expectations have been in the Treasury market have been increasing slightly, but not as much as those consumer expectations. And final point here: consumer sentiment has been bad, but also the Conference Board's consumer confidence figures have also been bad. And I know on the street there's been varying opinions on which one is more political or not.
All right, Jose, really wonderful to have you in this morning. We're going to get that University of Michigan sentiment survey out at 10 a.m. Eastern. Please enjoy the rest of your Friday and your weekend. That is Jose Torres of Interactive Brokers. Let's get you some other top stories now that are trending on the terminal this morning. President Trump said that he would meet Russian President Vladimir Putin as soon as possible as he tries to facilitate a peace agreement in Ukraine. Trump had said he would consider attending an in-person meeting in Turkey this week between the Russian and Ukrainian leaders, but the meeting never materialized after Moscow sent a delegation of lower-level officials. The U.S. Treasury is warning Hong Kong banks against funding Iran oil trades. Bloomberg sources say a delegation from the Treasury made the warning last month. This month, the department sanctioned 9 non-bank entities in the city alleged to be involved in such trades. Now, elsewhere, Charter is said to be in talks to combine with its rival Cox Communications. Again, that is Charter said to be in talks to combine with its rival Cox Communications. Okay, coming up, hedge funds piling into cash and trimming tech. We're going to look at the latest 13F filings. That's coming up next on your Bloomberg Brief.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
You're watching Bloomberg Brief, and I'm Danny Berger in New York. Now, hedge funds have boosted positions in healthcare stocks in the first quarter while cutting exposure to tech. Some went even further. Michael Burry bought puts on NVIDIA ahead of the start of President Trump's trade war with China and Liberation Day. Let's get through the details on the 13F filings. Joining us now is Bloomberg's Charlie Wells. Charlie, you've been digging through these filings. What have been your big takeaways?
I love 13F Day, and Bloomberg has been digging through 736 of these first quarter hedge fund filings, and it's been really striking to see what we've seen. So basically, the biggest ad of all of these hedge funds was Pfizer, which is a little surprising. You know, their share price has been down about 20% so far this year, and this could theoretically be maybe a bet on a recovery, right? They've been kind of slumping in that post-COVID period. It could also be a kind of positive sentiment around their pipeline. They've been really trying to get into that obesity drug space. We know they had a fail on a pill they were trying to develop, but there's a chance that maybe there's a little bit of M&A on that front. So that was the biggest ad. One of the biggest cuts, interestingly, was AT&T. And now we know AT&T, their share price is up about 15% this year. They've been aggressively trying to add market share, trying to add customers. This could potentially maybe be a view that, you know, there's not a lot of room to run. And then, of course, we know in that first quarter, there was that significant hit to tech, and we saw trims on NVIDIA and Uber as well.
It's always a little bit tricky because these are somewhat backward looking, but even so, everyone wants to know what the big players did. Burry and Berkshire Hathaway made some headlines, Charlie. What are they doing?
Bearish moves here. And so Michael Burry's Cyan Asset Management, they bought puts on NVIDIA and also some Chinese stocks. So that shows a little bit of bearishness there. But also, Cyan Asset Management liquidated its entire listed equity portfolio as well. So again, bearishness on that front. And if you look at Warren Buffett's Berkshire Hathaway, they made no significant ads. So that's a little bit striking as far as what they didn't do. But everyone always pays attention to Berkshire and Apple, and they made no change to that Apple front. So that's striking too, because that is their largest holding, and it's closely watched.
All right, Charlie, thank you very much. That is Bloomberg's Charlie Wells. By the way, I just want to bring you some breaking news over EU fines on antitrust and Microsoft. It does appear that Microsoft is on track to dodge EU antitrust fines in its Team probe. Microsoft apparently is going to be offering unbundled Teams, and that's going to be tested by the EU, market tested rather. Positive feedback could pave the way for the EU settlement without fines. So this is the European Commission saying on Friday it's starting a so-called market test of Microsoft's proposal to sell Teams separately, allowing them to dodge a hefty fine if the EU does improve. Let's get more on a different tech stock that we are watching this morning. Coinbase has disclosed a hack that is expected to cost the crypto exchange $400 million. Hackers gained access to customer data that includes names, date of birth, addresses, and government-issued ID numbers. Shares are rebounding, you can see there in the pre-market, after dropping yesterday on the news in the last session. Joining us for more is Bloomberg's Tom McKenzie. And Tom, $400 million of a loss, that's not really that much. It's a drop in the bucket compared to some other hacks, but why is this notable for Coinbase?
Yeah, look, 400 million, as you say, is not insignificant as a number, but compared to previous hacks, we had about $2.2 billion in terms of crypto-related hacks just in 2024 in total. It isn't a huge number, but it's the impact in terms of the brand around Coinbase, which, as you know, Danny, has been that poster child in terms of pushing crypto into the mainstream, being the first publicly listed crypto exchange, of course, lobbying to get crypto-friendly lawmakers into Washington, D.C., into positions of power, recently added, of course, to the S&P 500 as well in the last 3 days. And also, and this is crucial, the custodian of $122 billion US, almost the entirety of that, the custodian of much of that is held and looked after by Coinbase as part of their prime offering for those ETF exchanges, for those institutional investors. Now, none of that was affected. That was not impacted. The prime part of the unit and the business was not impacted by this hack. But details were passed on to these hackers, were gained by these hackers, as you say, from their customers, including at least one high-profile, high-net-worth individual that Bloomberg is not naming. And essentially what they were doing, these hackers, was bribing customer representatives in India to pass on information, again, including IDs, including names, addresses, and then trying to use that, the hackers, trying to use that to pressure and trying to get access to other financial institutions, to try and get access to their banks and their details. Coinbase is saying they're going to be reimbursing any customers affected, and they're also offering a $20 million bounty that would lead to the arrest and detention of these hackers. They're reimbursing their customers, but clearly this is a big dent to the reputation of Coinbase.
Tom, to that point, because you talked about how at the start of this year, there was so much enthusiasm for crypto for companies like Coinbase spending on lobbying. There was even a New York Times story yesterday pushing back against maybe some of those efforts with the SEC apparently investigating whether they misstated their user numbers. Just how different of an environment is this for the Coinbases of the world, for crypto in general, versus where we thought we would be at this time when we had the election of Donald Trump?
Yeah, that's a really interesting question because you had those changes at the top of the Securities Exchange Commission, of course, as the crypto lobby had pushed for, as the crypto industry had lobbied for. Those changes have been put in place, so it's a more crypto-friendly environment. Of course, President Trump has done his bit as well to tout the crypto industry and making certain moves there to try and support the industry and make the US that home, that global hub of the crypto industry. So those changes are real, and we can expect those to continue. And of course, Bitcoin itself is still at around that $100,000 level, so a level that many skeptics would have poured scorn on just a few months ago. That's where we are in terms of the price gains coming through. But the anonymity of those users, the fact that this is all done, of course, on the blockchain, that has always created a problem in terms of how they deal with hacking and how they deal with cyber risks. And Coinbase is just the latest reminder. Again, 2.2 billion last year in total, according to some analysis.
Tom, thank you so much for excellent reporting. That is Bloomberg's Tom McKenzie. Now, elsewhere, Richemont shares rising in the European trading session. That's after the Swiss luxury group posted a jump in full-year sales thanks to its popular Cartier brand. Here to unpack the quarter for luxury and retail is Bloomberg opinion columnist Andrea Felstead. Andrea, I got to say, I'm surprised that some of this is still doing so well. I thought that the love bracelets were overdone, that Van Cleef, there are too many fakes out there to really be popular. What do you make of the really strong set of results from Richemont?
That's definitely a risk, but so far the jewellery is still selling well. Cartier has enjoyed a real boom, not just in jewellery, but in watches too. That's helped, but I think there is definitely a risk of overexposure.
Is all luxury created equally right now, Andrea? Because I was looking at the share prices earlier. Richemont has had a great year, up 20%. LVMH is down nearly 20%. What distinguishes the difference between what luxury is thriving and what is not in this current environment?
It depends on your brand. If you've got a strong brand, as we mentioned, Cartier and Van Cleef, and it helps what sector you're in. Jewellery has been really strong over the past year, partly because it hasn't raised prices as much as handbags. So jewellery looks a better value than a handbag. And also, when we think about LVMH, we think about Louis Vuitton, Dior, all of its fashion and leather goods brands, but it's also exposed to drinks through Moet Hennessy, and drinks are really having a tough time at the moment.
Well, having a tough time, speaking of having a tough time, U.S. retailers, Andrea, if that's one end, luxury, you have Walmart on the other end, who yesterday warned that they're not going to be able to absorb price hikes due to tariffs forever, that at some point they're going to have to pass that on to the consumer. Is there a real risk at this moment that retailers that Walmart almost kind of gives them the clear, that they're all going to be able to start to rise prices if one of the biggest retailers in the U.S. is beginning to do that?
Definitely. Walmart is probably best placed of anybody to deal with tariffs. It's huge, so it's got great clout with suppliers. It's also traditionally very cost conscious. It controls its own costs, and giving good value to customers is in its DNA. So if Walmart is saying it's got to pass these on, it's going to be 10 times more difficult for everybody else.
Andrea, thank you so much for joining us this morning. That is Bloomberg opinion columnist Andrea Felstead. Coming up, we're going to wrap up your week with more economic data on deck. We'll have your trading diary for you next on your Bloomberg Brief.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Let's get you set up for your trading day on this Friday. U.S. housing starts. That will come in at 8:30 a.m. Eastern time. Then we'll have the latest University of Michigan sentiment survey that comes out at 10 a.m. And then some Fed speak. San Francisco Fed President Mary Daly will be speaking at 9:30 p.m. Now, some individual movers in the pre-market. Applied Materials extending post-earnings decline, giving a tepid forecast. Chinese sales slipping. Vistra, those shares up 5 1/3%, agreeing to buy 7 natural gas-fired power plants for nearly $2 billion to feed the growing demand for electricity from AI. And Estee Lauder up more than 5% after filings from Michael Burry's Scion showed that it doubled its position in the stock market. Just want to flag the most recent note from Bank of America's Michael Hartnett coming out this morning saying that EM is in the beginnings of a major bull market and it will be the best performing thing this year, saying that a softer dollar and a recovery from China will be fueling emerging markets. All right, that is it for your Bloomberg Brief on this Friday. Surveillance is ahead.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Certainly by the fall, I think we will start to see the impact of slower growth.
Stagflation is an increasingly bigger concern.
Chances are, with what we know, lower inventories, fewer selections, and higher prices.
Dislocation between the soft data weakening and the hard data kind of muddling along.
There's a big gap between confidence, sentiment, and the results.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Heading into the weekend, wrapping up a week of deal making.
The China deal is a very big deal. They wanted to make that deal very badly. And we have, at the same time, 150 countries that want to make a deal. At a certain point over the next 2 to 3 weeks, we'll be telling people what they'll be paying to do business in the United States. I think we're going to be very fair, but it's not possible to meet the number of people that want to see us.
Soothing words from President Trump happy to send equities towards a week of gains. The president returning to Washington as House Republicans close in on a tax deal, leaving the Fed firmly on the sidelines as President Bostic sees only one rate cut this year, despite softer than expected reads on inflation.
So are we looking at the right kind of downside surprise where, once again, bad news is good news as long as it's not too bad? And what we can see is people pricing the Fed back in the game, even though they're saying, look, we're not in the game. We're actually waiting and seeing. But other people want to see them cutting rates. What I was struck by is that we've got PPI yesterday, a data point that previously has been dismissed, that initially didn't have much of a reaction in markets. And as the day went on, people coalesced around a narrative that it was the right kind of disinflationary shock that would overwhelm any kind of implications from the tariffs.
And just like that, bond yields down 10 basis points. I'm looking at two other data points. One data point, Walmart. The other data point, the Port of LA director on this program. Walmart's saying we can just about hold on before we pass on higher costs to the consumer. The Port of LA director coming on the program and saying even though tariffs are down to 30%, he doesn't think it changes the situation on the ground that radically. That's a situation to watch.
And Bloomberg Economics agrees, thinks that actually it materially shifts the economics in the U.S. exporting goods from China. So you start to frame out, okay, there are people saying, actually, we're seeing tariff rates at many multiples of what they were at the start of the year, and that's going to have ramifications for pricing. And then you have other people saying, well, the softness elsewhere, in particular with airline fares, in particular with gasoline prices, in particular with eggs, will offset anything else that might come down the pike.
Do you know what I thought when I woke up this morning?
What did you think?
This is nice, it's quiet. It's like the quietest morning we've had all week.
You know, you are going to eat those words. I hope that you don't.
I hope
I will just say, it is Friday. You're not allowed to say that until 8:56. But
Our next guest is alongside us saying, steady on, steady on. I hope it remains quiet. I'm sure you all do too. Equity futures right now in the S&P up by 0.2%. Coming up shortly, we'll catch up with George Concalves of MUFG with stocks on a 4-day winning streak, looking to make it day 5. Edward Fishman of Columbia University as Ukraine ceasefire prospects dim, and Andrew Honhorst of Citi pushing back his Fed rate cut forecast. We begin this hour with our top story. President Donald Trump wrapping up his tour of the Middle East. Joining us now from Abu Dhabi is Anne-Marie. AMH, let's get to it. What a week. What a week for the President of the United States.
Absolutely. Tons of deals the president was able to secure between Riyadh, Doha, and yesterday here in Abu Dhabi. And amongst all the fanfare, Jonathan, between horses and sword dancing, even they've done everything to roll out the red carpet and make the president feel at home. You had Mohammed bin Salman, the crown prince, at one point driving the president in a golf cart. So he definitely felt at home here in the Gulf on this tour. When it comes to the deals, the highlight had to really be AI. Yesterday, I was struck by this image as Commerce Secretary Howard Lutnick signed on to this document for an advanced AI partnership between Washington and Abu Dhabi. They're planning to build the biggest AI data center outside the United States, right here in Abu Dhabi. Standing between President Trump and Sheikh Mohammed bin Zayed was no other than NVIDIA's Jensen Huang. You can see that this is now going to be a place where those advanced high-tech chips can get into the region. For an individual that runs NVIDIA, this was a huge win for the week, something very different in terms of the path that was going down when it comes to the Biden administration. But for these capitals like Riyadh and Abu Dhabi, they need to make sure that that technology does not get into the hands of Beijing, to make sure, Jonathan and Lisa, they are staying on side of what Washington would like to see coming out of the region.
Anne-Marie, I'm sure that you have enjoyed the hair-flipping dance, the sword dancing, as well as the camels that have been paraded in. It has been quite a spectacle. I am curious what the reception will be back at home when President Trump arrives in Washington, D.C., about this idea that the Middle East is the new power broker, and that in some ways the gravity of power making is shifting away from Europe toward Riyadh, toward Abu Dhabi.
Well, the president departs pretty soon. He's going to be welcomed with a ton of headaches in Washington, D.C., as, you know, really the balance is hanging on whether or not his one big, beautiful bill can get passed. One of the biggest sticking points right now, and I know you guys will be speaking to Congressman Lawler of Westchester, someone that's in the thick of this fight, is where the SALT deduction cap is going to go. Can it rise above $30,000? This is something that is really critical to Republicans from high tax states like New York. But the problem this president has is that he has a majority, but they're very slim, and there's a bunch of different competing factions right now. It's going to be a working weekend for the House of Representatives, for Speaker Johnson. I'm sure the president will be putting on his speaker hat, making those phone calls. We should note there's one piece of good news for the president as he touches down in America later today. He told reporters he has a new grandson, so I think he's looking forward to meeting his new grandson, and then probably a bunch of headaches dealing with Congress.
Congratulations to the family. Anne-Marie, thank you. AMH, over in the Middle East, the president coming back to a bit of a fight over this tax bill.
It was supposed to be done. It was supposed to be wrapping up so they could get it through by Memorial Day and then passed by Independence Day. And right now, they are embroiled in a battle over everything and anything because a big, beautiful bill comes with a big, beautiful headache that a lot of them are grappling with.
Tyler Kendall joining us from Washington in about 10 minutes' time for an update on that. Look out for that conversation. Here's the view from Wall Street this morning. George Goncalves of MUFG writing the following: we still believe that the damage has been done after the tariff shock. We do not think that a risk rebound has changed the medium-term macro outlook. George joins us for more. George, good morning.
Good morning.
You've said repeatedly, and I keep seeing it in your research, this line here, the longer they need to wait, the more they need to do. What convinces you of that?
Look, I think we're in a different place than we were in 2022, 23, when all these sentiment surveys were a head fake. And this time, you know, obviously we're further along in the business cycle, and we have much more tighter financial conditions, at least from the Fed side of view, from the market side of view. You know, we would be having a different conversation if stocks had not rebounded, right? We would have been like still in the doldrums, like, oh, this is painful, equities are lower, spreads are wider. They've all snapped back, and I think that is giving kind of a false sense of confidence that we've kind of passed the worst of it. I think we haven't seen it in the numbers, and that soft data does eventually translate into harder data, because I don't see how corporates and consumers are going to just flip their behaviors.
Matt Lazzetti, Deutsche Bank. Financial conditions have unwound the tariff shock. We're near the easiest level since early 2022, prior to when the Fed began aggressively tightening. How much does that smooth the landing?
I don't think enough, because it's fickle, and the markets come and go. We can have, 6 weeks ago, we were down 15, 20%, and now we're back to flat. Let's see how it goes in the next couple of weeks. We don't want to hang our hat on just the financial conditions tightening aspect, but the Fed is passively tightening. The longer they wait, with inflation coming down, like they're hanging their hat on inflation expectations. And they know very well that inflation expectations are really driven by near-term inflation. So if inflation keeps trending, they really have no excuse but to ease. But we also changed our view. We moved it back from June to July. But we're consolidating. I think the longer the Fed waits, the more they're going to have to do.
I remember as long ago as yesterday, people were talking about tariffs possibly being inflationary and that PPI didn't matter because it's never really mattered, and that basically it's a fickle measure, that actually the revisions were upward when you look at core PPI for the previous month. Real question mark also about what it means going forward. Yeah. Are we now on this idea that disinflation has taken hold and will offset any kind of pressure from tariffs?
I wouldn't go as far as disinflation, but I think it just kind of strengthens that kind of argument that we're going to have mixed data throughout this period. We're not going to really know where we stand. But it does argue that a lot of it was pulled forward in Q1, and that kind of pricing pressures. Now the question is, did people actually get the inventory they want? Is there going to be fire sale of inventories that people don't need in the second half of the year? I think it just creates a lot of noise.
So not to be overly existential about this, but everyone comes on and tells us that they can't rely on the data, that it's backward looking. Don't trade on it. We're not going to trade on it. And then everybody trades on it and basically creates some sort of narrative that then permeates the markets for a full day or maybe two. Who is trading right now?
I would say it's active traders. I think that a lot of the investors that we speak to are hugging their benchmarks, especially in the fixed income space. You're actually paid to kind of wait because yields are high enough, and now like spreads have tightened, so credit's a whole other story. But in high quality, short duration assets, you're paid to wait.
Are they prepared to ignore bad data?
I don't think so, and that's where it really presents an interesting proposition. The bond market, especially the rates market, has had a big sell-off, enough of a sell-off. And now we've kind of retraced the last day and a half, but we've been exploring the upper limits of higher rates. We'll look back one day and say, hey, those might have been like the near-term highs, and I think that investors should be averaging in. Like typically, what we see is people say, oh, treasuries are a hedge to their portfolio, but instead they chase the treasury market and they end up buying 2-year notes when they're at 3.5% instead of buying them north of 4.
They become momentum traders.
Part of it for sure.
In a moment, we'll talk about the tax bill, and we'll get your thoughts on a more deeper level in a moment on that. But I want to understand from your perspective, when you say things like people might regret not buying at these levels, I'm paraphrasing here, even in the face of the tax bill that's coming in Washington, D.C.
Well, so that's going to be interesting, right? So I think that's what I think we mentioned it last time as well when I was on the show. We've really bifurcated the bond market into many different pieces. We have short-term treasuries and long-term treasuries. The long-term treasuries are a different story. I think that's where the sort of fiscal impasse, if it gets drawn out, I think that's where most of the term premium will reside. But even then, at some point, there's going to be value in the 30-year.
You're going to stick with us, George. We'll get his thoughts on the tax bill in just a moment. George Concavos there of MUFG. That has been the big focal point, I think, for fixed income this week. Never mind the data. It's that tug of war between the disinflationary data, CPI, PPI, and a prospect of a major tax bill coming together in Washington.
That puts fiscal deficits of something like 6.4% on the table, so 333 is not exactly what we're looking at right now, and people are getting really nervous. And when do the bond vigilantes start to rear their heads and say, no mas?
Not right now. 486 on 30s, 10s, back down to 440. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Republican infighting in the House is threatening President Trump's one big, beautiful bill, as you were just speaking about. The biggest issue, the SALT cap. A group of lawmakers from high-tax states, including New York and New Jersey, vowed to vote no on the package unless the cap is raised or abolished. Lawmakers have said they'll continue to negotiate throughout the weekend. Meanwhile, Meta is delaying the rollout of its flagship AI model called Behemoth. That's according to the Wall Street Journal, which reported Meta engineers are having trouble improving the capabilities of the large language model. The report says Behemoth's release has now been postponed to late 2025. And New Jersey Transit train engineers went on strike at 12:01 a.m. this morning, leaving tens of thousands of people looking for other ways to get to work this morning. The walkout comes after the latest round of negotiations failed to produce an agreement. It is New Jersey's first transit strike in more than 40 years. That's your Bloomberg Brief. John?
Yahara, thank you. So road traffic's going to be fun today, right?
Oh, I think a lot of people are going to just stay home. I'm just going to suggest
Oh, so it's going to be quieter?
It's going to be a work from home day.
Oh, okay, I'll take that.
I mean, if
stay in New Jersey.
Stay there. No, but I mean, come on, wouldn't you? I mean, if you were going to face off with terrible traffic, I can't get in.
I would do the same thing.
I'm
happy to make that argument for them right now.
I mean, for me to drive in and it's going to be stuck in traffic for 2 hours. So enjoy your time. Have a great snack.
I'm with you. Don't flood Midtown. It's basically what Bramo's trying to tell you. Up next on the program, the salt bottleneck.
The tripling of the deduction to $30,000 covers 98% of my district. Now, would I have liked a higher number? Sure. But it's not what you want, it's what you need.
We'll get into that compromise. Coming together down in Washington, D.C. with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning.
headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
4-day winning streak on the S&P 500. This could be day 5. Equities up by 0.2%. This from Chris Harvey of Wells Fargo this morning. An opportune time to revisit the AI picks and shovels trade. An easing of trade tensions coupled with liberalized chip export rules have sent the S&P 500 Infotech up 8% this week. He believes the rally has legs. It has legs this morning. The Nasdaq 100 up by 0.2%. Under surveillance this morning, the salt bottleneck.
Salt right now is roughly, it's about 215 billion. We want to stay within that piece. Now, that may mean we need to adjust the dials. The tripling of the deduction to $30,000 covers 98% of my district. Now, would I have liked a higher number? Sure. But it's not what you want, it's what you need.
Here's the latest this morning. Republican infighting over salt remaining a key holdup in the passage of the president's tax bill. Joining us now from Washington is Tyler Kendall. Tyler, does Congresswoman Malliotakis have some company in the salt caucus?
Yeah, hey, John, good morning. At this point, she really doesn't. While she says that her constituents would be fine with lifting that salt cap from $10,000 to $30,000, the rest of these lawmakers from these high-tax states like New York, New Jersey, and California say that number needs to get bumped even higher. The thing is, it appears they can't agree on what that level would be, as well as how that would be accompanied by income limits, phase-outs, or an expiration date. So there's still a lot that really does need to happen here, and it's becoming a tug-of-war between these moderates that you see on your screen there, but then also those fiscal hawks who say that any increase to the salt cap ends up being too much. And at the moment, they're holding some pretty big cards in their hands. They're threatening to tank a budget committee vote set for today over these concerns about what lifting the salt cap could mean for a loss in revenue. And for context, this vote today, it was supposed to be routine. This is basically what lawmakers have to do to bundle up all the different parts of this bill, put it into one piece of legislation, and then get it out the door. But as of now, that might not happen, as members of the House Freedom Caucus say that they need to see some bigger cost savings. Now, to be fair, their concerns, of course, John, aren't all about salt. They're also demanding some changes when it comes to the planned work requirements on Medicaid. They are trying to pressure House leadership to move up the work requirements from being phased in by 2029 to as soon as next year in some cases. But really, John, it all just highlights one of the biggest issues with doing this as one big, beautiful bill, because Republicans get to fast-track this through reconciliation. They're not negotiating with Democrats, but they do have to negotiate with themselves.
Tyler, how much is this becoming a proxy debate for the heart and soul of the Republican Party? And I say this, and it sounds quite dramatic, but the moderates are painting themselves as the reason why there is a majority for Republicans in Congress. And the conservatives are saying, we are the party of Trump, and we have to keep our budget in order. How much is that the reason why this is getting increasingly messy?
Right, there is definitely a push and pull here between the factions of the Republican Party as they really try to coalesce around an issue ahead of the midterms. And I know it seems like we're far away, but here in Washington, we really do start the countdown to the next election as soon as the last one ends. And reconciliation is really going to be a centerpiece for it. And it's clear that Republicans want to get cash into consumers' pockets as quickly as possible. But they're also, of course, dealing with a few different threads here when it comes to that some of these tax cuts are going to expire before President Trump, or right as President Trump leads office, and then contending also with what that could mean to their political messaging around planned cuts to Medicaid and also the Supplemental Nutrition Assistance Program. So at the end of the day, though, the uniting factor really could be President Trump, but of course he has said before that he does have perhaps a warm spot when it comes to lifting that SALT cap as a fellow New Yorker himself. At the end of the day, Lisa, we're waiting to see when he's going to start making those calls, because really the White House needs to get this part of their agenda done.
Tyler, thank you. The latest down in Washington, D.C. with Tyler Kendall, still with us here in New York. George Concalves of MUFG. George, we go back to the post-election question. Will this bond market constrain the ambitions of Republicans in Washington?
So I do think that this sort of impasse infighting is kind of capturing the essence of this fiscal concern that the bond market has. And like, yeah, like obviously there's factions within the Republican Party that are arguing their side. But we started off the year, let's remember, with two things. One, tariffs were going to lower the dollar. Strengthen the dollar. I'm sorry, strengthen the dollar. And that Bessent's plans and these kind of arguments that we're going to be more fiscal consolidation, that rates were going to head lower. And that kind of two-prong approach would actually be beneficial for the economy. We got the opposite, right? And then in addition to that, you know, in the heat of the moment during the post-Liberation Day, when we're seeing all that volatility in markets, we were also starting to get word that the Doge cuts aren't real. They're not going to really come through. And so the bond market was picking up on two things. That A, we're going to go back to being fiscally irresponsible. And so this really does, I think it's been in the background while we're dealing with the tariff sort of shock and now this rebound. I think the bond market is clearly going to be the arbiter.
You mentioned the currency. Let's sit on that just for a moment. Fiscal stimulus leads to a stronger currency. Fiscal irresponsibility leads to a weaker one. What does this tax package mean? Is it stimulus or is it irresponsible? And what does it mean for foreign exchange?
Look, that's a great question, great point. I think that what happened in the last month or so with foreign investors really rethinking their holdings of treasuries, de-risking, going down the curve, looking for dollar hedges for the very first time in quite some time. I mean, it started to be borne out in the data. And I think argues for a defensive posture from our overseas investors, that they look up and say, each time the U.S. gets into this sort of situation, needs more stimulus, and they just print more money, more treasuries.
So why aren't we seeing it more? I mean, we did see it from hot second and 30-year yields, but why aren't we seeing it more in a sustained kind of weakening of the dollar, given the fact that everyone comes on the show and says a lot of investors are getting really hesitant on buying U.S. assets, but they're still sitting on their hands. They're still kind of checking it out, and they still kind of like U.S. assets.
Well, I mean, U.S. assets is a broad category of many things. When it comes to the building blocks and the foundation of the banking system and liquidity, treasuries are tantamount. And so I do think it's definitely shown up in there. I mean, the Fed has cut rates. The Fed, there's still rate cuts in there, although they've come out, but still long-term rates have risen. So I think that it is being captured through term premium. If it wasn't, the curve is steeper. So I think it is being captured. And there's people go to even a further, more lengthy kind of theoretical that even credit maybe is looking better than treasuries. That we're now at this point where we're comparing sovereigns to actual individual companies. Like when you get that far, maybe we've gone too far, but I think the conversation is being made.
So why did you say in the prior segment that you think that this is a real entry point for long-term bonds if there is this existential concern that could potentially push term premia well above what we've seen in recent history?
Because look, no one knows exact timing, right? And the point is everything will come to pass. And the argument that I'm making is more about dollar cost averaging. I don't know exactly when the right time is, but what I do know, what I feel pretty confident not know, is that we cannot afford rates above 5%. It will start to impact the economy and other parts. And then you get that negative feedback loop into other asset classes and a shift from other assets back to treasuries. And so it's kind of that kind of song and dance that the higher rates stay, the more likely something else will happen.
A lot of people have moved on from April 2nd. Big time. You've seen that in financial markets. You haven't. You say things like the damage is done, you're going to see it in the economic data. You also think about international investors and the attitudes to U.S. assets. Just build on that a little bit more. Do you think there is some scarring there? That this isn't quite as repairable as some people think it is?
I think, look, there's obviously always a place for treasuries, but I do think that there has been some damage done. And Now there's actual viable alternatives. And this is the irony. The Fed is dragging their feet to cut rates, in my opinion. The Fed cuts rates, it would actually get investors to buy treasuries because they're going to rally, right? We're going to get that. You're going to get better funding costs for overseas investors that do FX hedges. They'll buy treasuries. The longer they wait, the longer they kind of push these foreign investors to stay in their local markets because like European rates are attractive. Japanese rates are, yen rates are the highest I've seen in my career. Like, I mean, we're talking about like, why would you come to the U.S.? Like, you're going to stay home. So this is a completely different global bond market that we've been experiencing for the last 20 years. So I do think it has left some scarring.
There was a phrase we used earlier this week, Lisa. It was the great repatriation. That maybe some of these domestic investors would just invest money closer to home and bring it back.
Which is the reason why Jim Zelter said that the tail risk right now in markets is that potential for a Liz Truss moment, and that would actually inject some discipline on the fiscal perspective. Right now, it is unclear because this bill still is in sausage-making territory. At the same time, it does seem like the political momentum just is not there to make serious substantive cuts.
George, it's good to see you, as always, sir. George Concalves there of MUFG. Lots to look forward to, including a fight between Republicans over the tax bill, and this tax bill could be absolutely massive. We said repeatedly through this week, just like that, Monday morning, trade truce between the US and China, bang. Market seems to move on to the tax bill.
Yeah, although moving on to the tax bill is also something of a headache because it's very difficult to understand exactly what's going to be in the tax bill. And one thing that we haven't really analyzed enough is what the ramifications are going to be for states, local governments, which actually have been accountable for the greatest proportion of all the hiring. So there are some pretty vast economic consequences from this that really haven't been gamed out in a market moving kind of way in real time.
And to George's point, don't move on too quickly.
Yeah.
Might see some damage from those tariffs in the economic data in the weeks and months to come. Certainly haven't seen it in a big way just yet. Equity futures on the S&P up by 0.25%. Up next, Edward Fishman of Columbia University as Ukraine ceasefire prospects continue to dim.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Four-day winning streak on the S&P 500, higher every single trading day this week. Equity futures up again this morning by 0.25% as we head towards a really solid week of gains. The S&P 500 higher by 4.5%. With 3 hours until the cash open, let's get you some morning movers this morning. We can get those with Danny Berger. Hey, Danny.
Hey, John. We got a few things moving after the 13F filings yesterday. These are always backward-looking from the hedge funds, but a lot of attention placed on Michael Burry's Scion Asset Management and what they did, because they basically got rid of all of their equity holdings, took out puts on NVIDIA, except for one stock. And that one stock is the one you're looking at, Estee Lauder. Those shares are up 5.2% because not only did they hold on to Estee Lauder, they also doubled the position. So investors taking a note from Michael Burry's book. Elsewhere, Applied Materials, the largest U.S. maker of chip-making equipment, reporting earnings yesterday, a very lackluster forecast for the current quarter. Really just underscores the adjustments the companies have had to try to make in order to comply with the chip restrictions coming from China. The CEO there talking about uncertainty, not talking about any extra demand coming from the Middle East, so those shares dropping 5.7%. Finally, rounding things off this morning with Take-Two Interactive, a video game maker that I swear really just trades on whether or not they're going to release GTA 6 Grand Theft Auto. Everybody's been waiting for this, but they've delayed it yet again until May 26th of next year. So they gave a forecast that has a loss for this year because it doesn't capture GTA 6. That disappointed investors. Those shares down 3%, John.
Disappointed gamers as well. Danny, thank you. Appreciate the update, including me.
Yeah,
huge gamer.
Yeah, Grand Theft
Massive.
Auto. I see you
up all night playing games.
I know. It's really.
I don't go to bed at 7 and wake up at 2 something.
No, you need
I'm playing games all night.
You need to kick the Grand Theft Auto habit, John. We really need to have a discussion.
It's a bad habit. I need therapy. And I'll rate down this morning. President Trump wrapping up a week of deal-making in the Middle East, securing $600 billion in Saudi investments, $200 billion in deals with the UAE, and more than $243 billion from Qatar. What should we call this? Investment commitments or deals? What is this?
It feels like investment commitments. We don't really have a sense of what the contours are, and there's some pretty glaring questions around what this actually means in terms of how they will build out their chip sources, exactly what the protections will be around said chips. The bigger picture, though, is the Middle East as a new power broker, and really the dynamic is shifting away from Europe, and that is coming amid some dissent in Congress. And there's some people who are saying, should we be doing this? Is this a reliable partner in the same way that Europe had been? And this is going to be the geopolitical fight for a long time that I think is really fascinating.
The diplomat Jensen Huang says yes. I think that NVIDIA and the chip makers are very happy with progress that's been made this week. The rally we've seen in some of these names has been phenomenal.
Absolutely. This could potentially offset the lack of business they get from China. This is exactly what they wanted, because the belief is in the technology sector, the more people who have access to it, the more we can advance, and this is better for humanity. Now, there are some security concerns when you talk about strategic decoupling from China. What does this mean about strategically decoupling from entities that could potentially be maybe adversaries? Again, who's an ally? Who's an adversary? This ultimately goes to the crux of that question.
The president wheels up in the Middle East. He's going to return to this fight. Republican infighting over raising the SALT cap, threatening the president's tax bill. A 2-hour meeting in House Speaker Mike Johnson's office yesterday, failing to address concerns. Lawmakers planning to negotiate throughout the weekend.
This should have been easy. Maybe. I mean, that's what they said, but I didn't ever really see how it could have been easy, but they said it could have been easy. To me, it really highlights the increasing schism between the conservatives and the moderate Republicans, and how everybody has their agenda and they're all going to try to pack it in, and how difficult it's going to be to get something across the finish line that doesn't blow out the deficit in a way that causes the bond market to say, hold on a second. And we saw a glimpse of that yesterday. So this, to me, could be the big market moving event for the next couple of weeks as we figure out what the sausage looks like, how it gets remade, how it gets chopped up, how it gets cooked, and then how it gets delivered.
And what it means for fixed income. and how fixed income investors will respond to that, and what the Federal Reserve's going to do as well. Atlanta Fed President Raphael Bostic's seen just one rate cut this year. He's told the Bloomberg podcast Odd Lots with Tracy Alloway and Joe Weisenthal that uncertainty is unlikely to resolve quickly, adding that he expects the U.S. economy to slow but not fall into a recession.
What was really interesting about some of his comments was that he talked about how the truce does change materially the economic outlook on some level. Again, I just wonder how they are even following a framework when the data isn't capturing real-time changes in policy and is backward-looking in terms of the economic ramifications. And that's the reason why a lot of what they're going to talk about is, you know, could be, we aren't sure, but, you know, inflation, check it out. And I do think the comments from Fed Chair Jay Powell, which I'm sure we'll get into later this show, really did underscore how much they're emphasizing inflation.
Given doubt, they've all got the same notes, wait and see. We're going to wait and see, and that's what they've been saying over the last several weeks. Let's turn to geopolitics. Hopes for a Ukraine ceasefire fading as both the US and Russia send low-level delegations to talks in Turkey. This as leaders gather for the European Political Community Summit over in Albania. Bloomberg's Ollie Crook joins us now for more. Ollie, welcome to the program. You've been speaking to European leaders. We just heard from the President of the United States on Air Force One saying that Putin and I may meet. We have to meet. What are European leaders saying?
Yeah, I think there's a lot of skepticism about Putin's commitment to any sort of deal and any sort of talks between Ukraine and Russia. And I just spoke to actually the deputy head of Zelensky's office, who actually just came from Turkey, arrived here in Albania. I spoke to him a few hours ago, and his point was that basically if you want to make any progress here, it's got to be Zelensky, Trump, and Putin having those discussions, really getting around a table and starting to hash those out, because these sort of low-level meetings, the interpretation from many European leaders is this is just part of the more slow-walking the discussions around any kind of ceasefire, any kind of peace talks, and that Putin basically is not serious and that he's playing games. And that's quoting directly from a number of the leaders we've spoken to over the last few days. We should also say that another person that was in Turkey besides Marco Rubio was Lindsey Graham, who is the author of this new potential sanction list on Russia, these so-called bone-crushing sanctions that are designed to potentially clamp down on Russian oil and gas that would have a severe impact, really targeting them in ways that have not been seen before. The real question for European leaders and for Ukraine is, can they convince Donald Trump that Putin is the obstacle to peace? We have not arrived at that point, but we can tell in the way that Zelensky has been treating discussions and treating the Trump administration since that awful Oval Office meeting. Basically, whenever Trump says jump, he says how high and jumps twice as high. And that has been the technique to try to convince the U.S. administration that they're serious about peace and that Putin is the problem.
Certainly seen evidence of that this week. Ollie, appreciate the updates, sir. Ollie Crook there on the ground in Albania. Joining us around a table here in New York, Edward Fishman, professor at Columbia University and the author of the book Choke Points, American Power in the Age of Economic Warfare. Eddie, it's good to see you, sir.
Good to see you too, John.
Do we know what both sides want? Do we know what Ukraine wants? Do we know what the Russians want?
I think there's still major divides between the Ukrainians and the Russians. And I think the issue right now is that Putin believes that time is on his side. The reason he's kicking the can down the road, the reason he's kind of saying, oh, well, I'll show up in Turkey, no, I won't show up in Turkey, is he thinks that if he can just push this out, get to a big Russian summer offensive, they can take even more territory, be in an even stronger position. It's worth recalling that at the very beginning of this special military operation, Putin said that his goals were to demilitarize and denazify Ukraine. What that means is they want Ukraine to have no military, and they want Zelensky to get out of Kiev. That is a maximalist objective, and one that doesn't feel very commensurate with the idea of a peace deal.
Which raises the question what the larger context here is, what President Trump's nodes of leverage really are, and why Russia is inclined to push back and continue with this sort of geopolitical reordering where Russia is aligned more with China, with Iran, and pushing against sort of the American hegemony.
You know, the thing that's interesting, Lisa, and the thing that's confusing to me is just to see how different Donald Trump's approach has been toward Russia than to other countries like China and Iran. With respect to China and Iran, with both countries, he's trying to get a deal. With China, he's trying to get a trade deal. With Iran, he's trying to get a nuclear deal. And yet, while he's doing that, he's imposing major tariffs on China and big sanctions on Iran. With Russia, since January 20th, since Inauguration Day, there have been a grand total of 0 sanctions packages against Russia by the United States. And that is just a massive change from what we've seen over the last 3 years, where every month, even sometimes every week, there would be more escalation on Russia's economy. So I think it doesn't, you know, Putin isn't crazy to think that, wait a second, there's something different about my relationship with Trump than the way Trump even relates to Xi Jinping. And so it's worth it for me to kind of hang tight and really just play for time.
Is there a geopolitical strategy that President Trump could be following by not imposing sanctions, by taking the tone that he's taken to try to engender some sort of agreement that could bring a halt to this war?
Look, I think that I understand if he wants to sort of preserve his, position as an honest broker, and that maybe he thought that the Biden administration had leaned too heavily toward Kiev. So I do understand that to a certain extent. But, we're now several months into the administration. There's been several attempts at diplomacy. It seems like the U.S. has actually offered some significant concessions to Russia, right? There are reports that they offered to recognize Crimea, which I would remind folks, not even Xi Jinping has recognized Russia's annexation of Crimea. And yet, Putin doesn't seem to be taking this seriously. And I think when I heard Trump say recently that Putin might be tapping him along, I think myself, as well as many other people who look at this issue, are hoping that Trump may be kind of seeing the light on Putin right now.
Let's talk options. What are the options available to the Trump administration, sanctions-wise?
Sure. So, look, I think one of the biggest myths out there is that Russia is the most sanctioned economy in the world. They're not even close. I mean, we talk about secondary sanctions, which would be sanctions on buyers of Russian oil, like sanctioning Chinese refineries or Emirati oil traders. That would be great. But let's talk about low-hanging fruit. Rosneft, the biggest oil company in Russia, is not under sanctions. Gazprom, the biggest gas company in Russia, is not under sanctions. These are primary sanctions. So, I mean, there are very basic things that we could do. And it's worth reminding folks that the reason this is the case is that Joe Biden was too cautious, frankly, in terms of attacking Russia's oil sector. And I'm hoping that Trump, with support from people like Lindsey Graham and Senate and House Republicans and Democrats for that matter too, who want to do this, will actually kind of get the chutzpah to actually take these kind of steps.
Where would that leave the Europeans?
The Europeans support this. I mean, the thing that's interesting is the Europeans have not been the big obstacle to energy sanctions on Russia. The issue the Europeans had, going back to even when I was working on this issue post-Crimea in 2014, 2015, the Europeans had been worried about sanctioning Russian gas, not Russian oil. But then Putin, in the summer of 2022, cut off the gas to Europe. He basically used gas supplies as a sanction against Europe. And so that ship has sailed by now. The Europeans are on pace right now. They just certified a couple weeks ago that they're going to be totally independent of Russian gas by 2027. So right now, the question is really about oil, and it's really whether the Trump administration, with backing from Congress, is willing to actually attack Russian oil.
How related is that to the trip that President Trump is still on in the Middle East, making friends with everybody in the Middle East and really shifting the balance of power to that region, possibly at the expense of Europe?
Yeah, so look, I think that if you're going to be, empathetic with Biden, and the reason that Biden didn't want to do a frontal assault on Russian oil, the concern in 2022 was, you had massively tight oil market, right? You had oil prices that were above $100 a barrel. You had, really significant demand growth with the rebounding from COVID. Right now, you've got Brent around 60, right? And you've got symptoms that the market is going to be oversupplied this year. You've got OPEC that's increasing production, looking like they're playing for market share. You've got non-OPEC supply that's growing. So right now, the market conditions, partly because of the diplomacy with the Middle East, are very favorable to start bringing some Russian oil off the market. And by the way, if we get an Iran deal, which is also looking more likely, that gives even more leeway to take 1, 2, even 3 million barrels of Russian oil off the market this year.
Not even the Democrats are empathetic with Biden right now. You notice that?
Well, yeah.
Enemy number one in the party.
Well, I think that there is a scapegoating, and there is some mass revelation of what was seen and not seen by the public in terms of his deterioration. And I think that a lot of people are saying he didn't step down soon enough to allow Kamala Harris a fair shake, and even just some sort of primary that could have been valid.
But that's the argument, at least at the moment. We'll have more to say on that in the weeks and months to come, I'm sure. Eddie, it's good to see you, sir.
Yeah, nice to see you.
Thank you. Thank you very much. Edward Fishman there of Columbia University with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Charter Communications is in advanced talks to combine with Cox in a deal that would unite two of the biggest U.S. cable providers. Sources telling Bloomberg the deal would be a cash and stock transaction that would value Cox Communications at more than $30 billion. An announcement could be made within days. And France and Spain and Greece are pushing for mandatory age restrictions for users of social networks, including Facebook and X. According to a document seen by Bloomberg, the digital services ministers from the three countries are coordinating on the proposal ahead of a meeting with their European Union counterparts. And the PGA Championship is underway at Quail Hollow. After the first round, Jonathan Vegas is in the lead at 7 under par. Meanwhile, Rory McIlroy and Xander Schauffele both struggled and will need a bounce-back performance today in order to make it to the weekend. That's your Bloomberg Brief. John?
Yahara, thank you. Terrible start from Rory just yesterday. Let's hope that changes. Up next on the program, putting rate cuts on the back burner.
Fed looks to be in a pretty good spot in terms of keeping rates steady.
Maybe the discussion is that maybe even 2 cuts from the Fed is pricing in too many cuts.
The Fed will take it very ezy here.
As long as the Fed can wait, they will.
Up next, Andrew Honhorst of Citi, live from New York. You're watching Bloomberg TV.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities firmer here going into the weekend, down by 1/3 of 1% on the S&P 500. On the Nasdaq, we look like this, up by 0.3. On the Russell, up by 0.8. Under surveillance this morning, putting rate cuts on the back burner.
Fed looks to be in a pretty good spot in terms of keeping rates steady.
We're just pushing cuts further out in the year. We see the Fed cutting only twice this year.
Maybe even 2 cuts from the Fed is pricing in too many cuts.
The risk to the downside in growth, I think, is real and present danger. The Fed will take it very ezy here.
As long as the Fed can wait, they will.
The Fed is going to be criticized for waiting. They have to wait.
It's the latest this morning. Traders pushing back rate cut bets as the Fed commits to a wait-and-see approach to policy. Andrew Honhorst of Citi writing, wait-and-see is the right strategy. The Fed can now more comfortably stay patient. And we're pushing for the next rate cut to come in July and not in June, as previously thought. Andrew joins us now for more. Andrew, good morning.
Good morning.
Question is, why go from June to July? Why July? Why the summer?
Well, I think it's just going to take
the Fed seeing something in the data that makes them worried about what's going on with activity, what's going on with the labor market. If you look at the soft data, the survey data, it's been misleading in the past, but I think it's sending the right signal now. I think the hard data are going to turn. When the hard data turn, we'll have the Fed cutting. When exactly that happens, I don't know. But it could be July, it could be September, one of these upcoming meetings. I think
your best guess at the moment is July, which implies the weakening comes before July, quite clearly, which means you expect to see it in the next couple of months. What gives you that belief that's going to happen?
So I think we're going to start to see things in the job market, and that's really what's going to be important for the Fed. Of course, dual mandate, you have to worry about inflation, have to worry about employment. We're seeing a low hiring rate in the job market. We know now from surveys, from anecdotes, that firms are pulling back further, if anything, on their hiring. We know we're going to have some government job cuts. We know that unemployment picked up last summer. So you kind of put all those things together, I think there's a good chance that we see that unemployment rate starting to move up again.
Why do you dismiss all the people who say that the jobless claims have been low? They haven't really ticked up that much. You've seen some of the credit card data highlight that people keep spending pretty much in a significant amount to the way that they did before. Why is that not a leading indicator for you at a time where there are very few kind of linchpins to truth along the way?
Yeah, I mean, I'm not dismissive of the fact that the job market has been pretty stable for the last 6 months plus, and 4.2% unemployment rate is not a bad unemployment rate to be at. I think the issue is that it's been stable, but it's been stable in a kind of fragile, uncomfortable way with this low hiring rate, with a low layoff rate. So you're not likely to lose your job, but if you do, it's hard to get hired again. And again, we have these factors that are probably going to be putting people into unemployment, harder for them to get hired again, and then you start to see that unemployment rate moving higher.
How do you gauge how much scarring there has been done based on the fact that we are at a higher tariff rate than we were at the beginning of the year, albeit much lower than it was, say, on April 2nd? Do you sort of communicate that the scarring is not that much less now than it was before the announcement that there was going to be a 90-day pause?
It's all a question about what's the point of comparison. I mean, to your point, if we compare this to when we had 145% tariffs versus China, there was effectively a trade embargo with respect to China. And then we were worried about really acute effects. Could you actually see less traffic at the ports, less jobs at the ports for that reason, less trucking jobs? Now it looks like probably that's not going to happen. So you kind of take out that extreme, acute downside risk, but you still have the uncertainty around tariffs. We're still uncertain about how this is all going to turn out, and that we think is leading firms to pull back on their hiring decisions.
The prospect of higher prices, Walmart basically saying we're close to passing on higher costs. The Federal Reserve needs to sit there in July and be convinced that any kind of inflation is not going to be persistent. Is that enough time?
You know, you can't wait until you have total certainty. I think that's a very general point that is important to make here. If you wait until you see all the data, by definition, you've acted too late. So the Federal Reserve is going to need to make a decision about where they think that trend in inflation is going.
Can I jump in? Yeah. Isn't that what they're communicating to us?
That is what they're communicating.
So you just don't believe them?
I don't believe them. No, I don't think that you can wait until you have perfect clarity on the economy, because, John, you never have perfect clarity on the economy. You'd be waiting forever. They're not going to wait forever. They're going to look at that balance of risk. Look at the last two inflation reports. We have core PCE in the month of March, 0.03% month on month. In the month of April, we think it's going to be 0.13% month on month. So these are two really soft inflation readings. They follow two really strong inflation readings in January and February, but that cooling in services inflation, I think, should be giving them a lot of confidence.
It is a question I wish that interviewers would hammer Fed officials on. The difference between inflation being short-lived and more persistent. How do you know? And how long does it take to find out? How do you know?
Well, I think you have to make a judgment based on where that inflation is coming from and what the underlying drivers of inflation are. And this is why the current scenario is so different from what we experienced after COVID. After COVID, we had a negative supply shock to the economy. Supply was constrained, but we had a positive demand shock at the same time. We had lots of fiscal stimulus coming in. People could go out and spend. Now we're in a different scenario where you're getting the negative supply shock, but there's no positive demand shock happening. Wage growth is cooling. House prices have cooled. So you don't have that same inflationary backdrop.
Is there also the lack of belief in Fed Chair Jay Powell when he laid out in his speech yesterday that maybe the Fed would look back to their previous framework where they truly were targeting 2% inflation, not a range, not an average over a period of time, talking about how higher real interest rates may reflect the possibility that inflation could be more volatile going forward, that we could be in a period of supply shocks? Do you just dismiss that as something that they're not going to follow through with, emphasizing inflation even at the expense of the economy?
So I think they do need to think seriously about how you operate monetary policy in a world where you have these larger, more persistent supply shocks. That is a real issue that they have to contend with. Now, having said that, that doesn't just mean that you keep policy rates at restrictive levels at all time. You assess the current situation. And again, I think we're in a situation here where we have, yes, a negative supply shock. That's going to reduce growth, that's going to raise inflation, but we don't have that demand shock to make inflation persistent, and that's what they should be paying attention to.
Do you think that they will take an average of PPI and CPI, look at that core PCE metric that you've just said is probably going to come in lower, and just extrapolate that out? Do you think that they're going to, even without some sort of pain in the labor market?
Yeah, I mean, you can't just extrapolate that out forever. I mean, you need to look at what are the details of that inflation reading? Where is inflation really going here? I think they're looking at shelter inflation that's slowing. They're looking at non-shelter services and wage growth that feeds into that have slowed. I think that should all be reassuring. The question is, what happens with goods? We're probably going to see some goods inflation because of those tariff rates. But that's where, getting back to John's question, that's where you say if the inflation is confined to goods, then we should be less concerned about it. That looks more like a one-time move in the price level. That's what Governor Waller has said. I think he's about the only Fed official that's come out and said that.
Do you think they're close to making a mistake?
I think they could be. I think they do have time here. They do have the luxury of a labor market that's been stable, but you can't wait for total clarity. You'll never have total clarity.
The problem is, as you know, these mistakes are often born out of the conditioning from the previous experience. And that's why we had to wait last time around, because their experience was actually don't tighten policy too soon, which meant they waited and then inflation ripped away from them. They made a mistake. This time around, they're going to wait for different reasons, and they could make a different kind of mistake because they could have moved sooner the opposite way.
It could lead to a much faster deterioration in the economy, which is the reason why George Concalves earlier was saying that they're going to be late and then they're going to move a lot faster. This is what a lot of people think. Right now in markets, we're baking in 2 rate cuts for the remainder of the year because their cuts are going to come on the heels of good data, of disinflation, not necessarily that pain in the economy that some people were worried about.
Andrew, it's good to see you, sir. Thanks for dropping by. Andrew Honhorst, the city does not believe Fed officials when they speak. That's my takeaway. That's my takeaway.
In fairness, as we've said before, maybe he is conditioned by what we have experienced in the past as well. So,
true.
There is that.
If you fully understood all of that, and I hope you did. Up next on the programme, we'll catch up with Lisa Shannon of Morgan Stanley, Maya McGuinness of the Committee for a Responsible Federal Budget, Congressman Michael Lawler on a big fight brewing in Washington over the SALT deduction, and Kelsey Barrow of JP Morgan Asset Management. Live from New York, the second hour of Bloomberg Surveillance. Up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Every asset class is higher today than it was on Liberation Day, except for treasuries.
It's a good idea to take a little bit of money off the table.
The market takes a pause here.
I'm still comfortable being in risk assets.
It's not going to be a smooth ride.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Your scores look like this. On a 4-day winning streak on the S&P 500, looking to make it day 5. Equity futures on the S&P positive by 0.2%. On the Nasdaq 100 up by 0.2 also. A rip-roaring rally for big tech going into the weekend, and we'll build on that in just a moment. Also need to look for just a sprinkle of economic data going into the weekend. Mitch, consumer sentiment. How relevant is the soft data now after the trade truce over the weekend?
You know, this is going to be a real question because people are going to come out and say the University of Michigan sentiment survey is really messy, nobody looks at it, and then it will come out and it will show some kind of either increase in inflation expectations or big decrease, and the whole market will trade on it. I mean, right now we're talking about a market with limited inputs, and so each one of them, even though people want to dismiss them, are taking on a life of their own, and I think that that was the message from yesterday's PPI print that suddenly has become the new narrative, even though people said it was backward-looking and was going to be dismissed by the market.
The message from Walmart is that these consumers might be right to worry because in the coming months you might be seeing some higher prices.
The fact that Walmart said that gives the open door, gives the green light to other retailers to do the same thing. So this isn't just a Walmart story. This is the biggest retailer with the greatest ability to absorb some of these costs, both in their margins as well as pushing some of their suppliers to do the same and absorb the costs. If they cannot really offset some of these price increases, well, what does that say for other retailers? What does it say for mom and pop stores that don't have those same levers?
Which is why the Federal Reserve, many of these officials are just going to sit this out and wait. Wait and see is on repeat at the moment. The Atlanta Fed President Raphael Bostic catching up with Tracy Alloway and Joe Weisenthal saying he only sees one cut this year. One. And I think some people see zero. None.
Well, some of the people on the Federal Reserve and some people in the market, you've also seen the likes of Deutsche Bank move back to December, some of the first rate cut. I do wonder, though, how many Andrew Hollenhorsts there are out there who say, we're conditioned by our experiences as well. And the Fed has said a lot of things that they've walked back. So, you know, when circumstances change, so do they. So we're going to watch the circumstances and they will follow.
Andrew does not believe what they're telling him. Doesn't believe it at all. He thinks this data weakens between now and the July meeting, and they reduce interest rates by July. I have to say, look, for them to cut rates by July, you'd have to see a real weakening in the labour market data between now and then.
And that's the reason why people are watching not just what happens with trade deals that still have to get resolved. It's not as though this is the all clear, but also what happens with the budget. How much of a tailwind this is and how much of a headwind this is, whether it has to do with rates and the bond vigilantes or where it comes from budget cuts, in particular to states, either through the Medicaid cuts or elsewhere, that could potentially lead to layoffs and potentially a tightening in financial conditions.
There's always something to worry about. This market is worrying less this week. Equity futures up again, up by 0.3%. Coming up this hour, Lisa Shannon of Morgan Stanley as stocks head towards a solid week of gains. Congressman Mike Lawler calling for even stronger SALT relief, and Kelsey Barrow of JP Morgan Asset Management on the biggest risk to the bond market. We begin with our top story. The president wrapping up his Middle East trip, securing $200 billion in UAE deals. Joining us now from Abu Dhabi is Anne-Marie. Anne-Marie, a week full of deals.
A week full of deals, and when it comes to the Emiratis, $200 billion, Jonathan, is the start. This story started in March. I reported about Sheikh Tahnoon having this meeting with the president in the Oval Office, and they were talking about trying to get as much as $1.4 trillion in investments with American companies. Yesterday, we heard on this final leg of the president's tour, $200 billion. We're looking at aircraft deals, Etihad looking to buy 28 Boeing jets, oil and gas, traditional deals between Washington and the Gulf, ExxonMobil, Occidental teaming up with ADNOC, the Abu Dhabi National Oil Company. But then there was the star of not just the event, but I would say almost the trip. Jensen Huang has been on every single leg of this trip with the president, from Riyadh to Doha and then in Abu Dhabi, standing between President Trump and Sheikh Mohammed bin Zayed as Howard Lutnick signs this AI partnership between the United States and Abu Dhabi, looking to build the biggest U.S. data center outside of the United States, right here in Abu Dhabi. It would be with U.S. companies, and of course, it'll be using advanced technological semiconductors from the likes of NVIDIA. Now, you have to see the Gulf is erupting in excitement about this, taking traditional oil and gas economies and looking into the future. We should caution a note, though. There are individuals, even within Trump's own administration, senior officials, wanting to make sure there are enough guardrails around these data centers that this technology, Jonathan and Lisa, does not get into the hands of Beijing.
Anne-Marie, great work this week. Safe trip back. I am surprised that this became a bigger week, not for the energy sector, but for the tech sector. To see these moves in chip stocks this week, to see these moves in tech more broadly, amazing.
The whipsaw of a bear market into a bull market with suddenly the biggest laggards becoming the biggest leaders as everybody flocks back to this idea of tech dominance in the United States really is head spinning. What I'm wondering is how long this can persist and whether it remains isolated in the tech sector or whether it really does broaden out to the rest of the U.S. universe.
An 8% rally on tech on the S&P 500 so far this week. Here's the word on Wall Street. Lisa Shannon of Morgan Stanley writing this. With equities having round-tripped back towards first quarter ending levels, markets are anxious to move on from tariffs and attempts to anticipate Fed policy. Lisa joins us now for more. Lisa, good morning.
Good morning.
How many times have we asked this question? Was it all just a bad dream? Can we just move on?
So, look, I think investors right now are weary and want to move on. They want to look through it. But I do think that things have fundamentally changed from the NASDAQ peak back on December 16th. I think the first thing that that has changed is it's really clear that top-line growth among the Mag 7 is decelerating. And growth investors typically don't like to see deceleration. The second thing is we're seeing this arms war with regard to CapEx spending continuing. If we, our latest update on looking at free cash flow yields shows Mag 7 free cash flow yields shrinking by about 11%. Typically, these stocks don't tend to do particularly well when their free cash flow yield is coming down. And look, we can pretend that the DeepSeek news doesn't mean anything, but we fundamentally think it was the wake-up call around global engineering, global innovation, and the fact that none of us know how the movie ends here on Gen AI, who the winners are going to be, how it's going to evolve, whether or not large language models very quickly become commoditized, and the next phase of the build-out is actually much lower data center intensity, much lower energy intensity, because it's very application-based. So nobody knows nothing, and I think right now this is a market where we've had a lot of positioning, technical positioning, where people felt, hey, I was caught off guard. This was a massive surprise. The effective China tariff rate is much lower than I penciled. I got to plow back in. You've got, some of the private wealth money and retail money coming in from the sidelines. But I think we're going to stall out here. I think it's just hard to justify the numbers. You round-tripped back to January 1st. on market levels, and yet your earnings per share are down 6%.
So you'd fade this move?
I'm fading.
What would you rotate out of, and what would you rotate into?
Yeah, so, we're continuing to, recommend that folks take some profits in now the new leaders again, in tech, and really focus on the beneficiaries of deregulation. And so we see that as, financials, we see it as energy, we see it as, some of the healthcare names. I know for viewers out there, that's going to sound like a big value style bias, but quite frankly, it is. While we're not saying you've got to be overweight value, we do think you want value in this market because you want some risk premium. I mean, there are risks out there, and you want to get paid to be in this market.
What risks do you want a premium to be paid for? And this sounds sort of existential, but it goes to the heart of the question of, is it inflation, or is it recession, or is it both?
I think it's a little bit of both. I think we're somewhat less freaked out about inflation than perhaps we would have been if the tariff rates would have held. I think what we're worried about is that we're no longer in a forecastable policy backdrop, right? As much as we all want a hand wring about the Fed, for the last 15 years, Fed policy has been reasonably stable and reasonably well telegraphed. And there haven't been massive surprises. I think when we shift to a fiscal policy backdrop with this administration, as we've seen, it's very easy to experience both negative and positive surprises on policy. And that's what I want to get paid for, is that at any point, things can take a U-turn based on the headlines.
How much do the rest of the universe that you didn't mention, big tech that you're selling on the margins, or some of the financials and other value stocks that you're looking at that aren't exactly value, as you pointed out, how much do you think that it really will require Fed cuts to get the rest of the universe involved in some sort of positive momentum?
I think the rate cuts are absolutely, required for small cap, mid cap. I think that universe has suffered profoundly, from the higher cost of capital. By and large, the S&P 500, which is predominantly large and mega cap companies, have been pretty isolated. They have very healthy balance sheets, and for the most part, they haven't been inhibited by rates where they are, which is why we have multiples where they are.
Well, it raises this question, especially as the fiscal debate heats up in Washington, D.C., and you alluded to this, and there's a question about, as we find out how much the deficit's going to increase, how much bond markets are going to freak out, to use your sophisticated parlance. But there is this question of at what level, in a 30-year, in a 10-year yield, it becomes prohibitive for stocks to really move higher from here, and it really injects some damage.
Yeah, I mean, look, I think for most of the last, 6 to 12 months, that, 450 on the 10-year, 4.5% on the 10-year, was kind of this stall out threshold. The market seems to be battling with it a little bit this week. But look, I think if we back up, if we get big deficit numbers coming out of this tax bill, and that 10-year moves into that 475 range, I don't see how the market, how equity valuations hold here. The math just stops making sense.
Lisa, it's good to see you, as always. Thanks for dropping by. Lisa Shelley at Morgan Stanley. Lisa, we're at about 475. 450, we bought that. We're back down to 440 on 10s.
Yeah, and this came along with the help of PPI data that really fed this idea of disinflation, and it came along with this idea that maybe there would be pushback to this bill. What's going to drive this market at any given day is as fickle as pretty much anything else. So, pick your data point, pick your narrative, and probably you can get some people to go along with you.
If the outlook for growth improves, you'd expect higher yields at the long end. The problem is those dislocations, and you talked about the speed of the move. If you get that fast dislocation in fixed income, where you start to worry about where the buyers are going to come from, that's when people get nervous.
And if you start to worry about true dysfunction in the market, suddenly, if you see things breaking, that further erodes some of the credibility of the U.S. markets, and that just leads to this additional question of what kind of risk premium you need on certain risk assets, and that's, I think, the bigger concern for a lot of people.
Certainly not seeing that this morning. Yield to lower across the curve, we're down by 2 or 3 basis points. The 10-year 440. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. President Trump saying he will set tariff rates for a number of U.S. trading partners over the next 2 to 3 weeks. He says Treasury Secretary Bessent and Commerce Secretary Lutnick will begin sending letters to about 150 nations that the administration doesn't have time to meet with, but he says want to make a deal. Meanwhile, Ukraine and Russian officials are meeting in Istanbul today to discuss an end to their war. But neither Russian President Vladimir Putin or Ukraine's Zelensky will be present. President Trump said just yesterday he doesn't think there will be a resolution to the war until he meets with Putin. And the Justice Department is conducting a criminal antitrust probe into how companies responded to mass concert cancellations during the pandemic. Sources telling Bloomberg the investigation is focused on whether companies Live Nation and AEG Presents illegally colluded on refund policies for canceled concerts. Live Nation has denied any wrongdoing. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, fighting for a compromise.
The tripling of the deduction to $30,000 covers 98% of my district. Now, would I have liked a higher number? Sure. But it's not what you want, it's what you need.
Up next, Maya McGuinness of the Committee for a Responsible Federal Budget. Live from New York City, this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Looking for a fifth day of gains on the S&P 500 heading into the weekend. Equities up by 0.25%. The run on the Nasdaq, what a run. What a move for technology stocks through this week so far. Up by 0.3% this morning on the Nasdaq 100. Under surveillance this morning, fighting for a compromise.
Salt right now is roughly, it's about 215 billion. We want to stay within that piece. Now, that may mean we need to adjust the dials. The tripling of the deduction to $30,000 covers 98% of my district. Now, would I have liked a higher number? Sure. But it's not what you want, it's what you need.
Here's the latest this morning. Lawmakers saying negotiations over President Trump's tax bill will continue throughout the weekend as Republicans spar over the SALT deduction. Joining us again from Washington is Tyler Kendall. Tyler, just how far apart are these two sides heading into the weekend?
Yeah, hey, John. Well, far enough that it does appear that House Speaker Mike Johnson's deadline to get the entire House reconciliation package done by Memorial Day could now be in jeopardy. Because while you do have some of those Congress members, like Nicole Maliotakis, they're saying that her constituents would support lifting this cap from $10,000 to $30,000. Ultimately, those other members from those high tax blue states say that's not going to be enough. And when it comes down to it, they're really the ones that are in this tug of war with fiscal hawks who say a $30,000 cap is already way too high. And it's those fiscal hawks who today, John, really do have a big point of leverage. They're threatening to sink an entire budget committee vote over their concerns about what all this means for a loss in revenue. And for context, the vote today, this is supposed to be routine. It's a procedural vote to basically bundle up all the different pieces of this legislation into one package and then move it along as quickly as possible. And to be sure and fair, these fiscal hawks, their only concern isn't just SALT, but also when it comes to the spending cuts, they're trying to pressure House leadership into moving forward when those work requirements on Medicaid could kick in. Right now, they're supposed to phase in by 2029. They'd like to see, in some cases, that move up to as soon as next year. And John, that really gets into the heart of one of the biggest disagreements here, which is that some of these members say there's too much of a front-loading of tax policy in this bill and too much of a delaying when it comes to those savings.
Tyler, just quickly here, how many Congress members who you speak to go to a Bloomberg terminal and press USGG 10-year index GP? And I'm talking about the 10-year yield, and just understand exactly what it is at any given time in response to some of these budget proposals.
Well, I certainly will start asking them that question because that is a good one. But at this point, you know, of course, we have been talking about how all of this is going to have that longer term impact here. And I think you'll recall when Ray Dalio was here in March on Capitol Hill warning about the trajectory of the budget and what it means to basically take on what's going to be some pretty big deficit spending. And originally, lawmakers were really open to that argument. But then really this started to snowball as they tried to get all of these priorities into this one package. And at the end of the day, we're talking about disagreements in the House. But just wait until this gets over to the Senate. I've spoken to a few different lawmakers who say they're not going to vote for this package as it stands.
Tyler, thank you. I reckon Congressman French Hill knows his Bloomberg tickers, don't you? I think he's got them down.
He's a banker, tried and true, community banker. He knows those rates, and he's watching them very closely.
Joining us now to extend the conversation, Maya McGuinness of the Committee for a Responsible Federal Budget. Maya, welcome back to the programme. You've seen the policies on the table so far. The debate and negotiations continue into the weekend. Can you just put a number, a price of the policies on the table at the moment?
Oh, well, if they're talking about bumping up the SALT cap even higher than it already would be at 30,000, we are talking about massive amounts. Potentially $900 billion is what it would cost to bring it up to the 63,000 per individual that they're looking for, which, to put it in perspective, that is more than all of the new tax cuts in this bill. The no tax on tips and auto loans and overtime, all of those things. So this request to bring it above 30,000, which I will make the case is already higher than it should be, is an expensive one, and it could really cause the bill to fall apart.
Maya, you think it will cause the bill to fall apart. How much momentum is there, based on your conversations with people on the Hill, to really get the budget under control, given some of the deficit projections that have the fiscal deficit going to something like 6.4% as a result of the current proposal?
That is the really central question here, because all of the members who are trying to pass this do want to extend the tax cuts, and they do want to make good on the president's promises. At the same time, there is a large group that has been talking about fiscal responsibility for a long time. They were kind of under the impression that this would be a bill that would do both, extend the tax cuts and make the fiscal situation better. That is clearly not the case, though. And now that they're seeing the numbers, that a bill like this would add over $3 trillion to the debt. It would bring up deficits by more than $600 billion in the early years. Like, this doesn't hold together. And so the people who care about the fiscal situation, many of them talk about it, but the ones who worry about it are really, really having heartburn. And I am not sure they will be able to support this bill. From where I sit, worrying about budget deficits, they shouldn't. They shouldn't be looking at anything that would actually make the fiscal situation worse. Instead, they should be focusing on bringing the deficits down, which this would not do, no matter what the talking points are.
Maya, you've been worried about the deficit for a long time, and a lot of people have too, but you run an entity that really focuses on the fiscal deficit and how deep it's gotten over the past number of years. How different is this moment and this proposal in that trajectory in terms of worsening the deficit picture at a time when there's some people who are saying deficits can be fine as long as they bring in enough revenues to offset them?
Yeah, well, you asked the right question about the 10-year. Markets are starting to worry. The amount of debt that we are issuing really, as Ray Dalio and others are saying, could exceed what the appetite for lending us money is. And that would be a huge problem, because if interest rates go up, even a little bit, because we already have so much debt, those interest payments that we owe for it start to snowball. And that's where you get into a very serious situation. I think markets have wanted tax cuts and markets want fiscal responsibility. And the issue is nobody is willing to get behind the kind of savings, spending cuts that would allow those both to happen at once. So tax cuts are going to worsen the situation. Even if they generate some growth, which they will, it will not be enough to offset the huge amount of borrowing that comes with this bill. And nobody seems to be willing to put in place the kinds of spending cuts that will be required. Remember, the spending cuts that the House is talking about at $2 trillion is out of a pool of total spending over that same period of $86 trillion. So we are not talking about anybody who's willing to really put the savings in place that could bring the deficit down. That's made worse by adding to it with the big tax cuts.
Maya, can you think of a proposal that would be both responsible and palatable for House Republicans?
Well, first, I think they should focus just on TCJA, extending the tax cuts, not putting in a whole grab bag of new ones, particularly tax cuts that expire after 4 years. I mean, this is a bill where a lot of the tax cuts are put in place in the early years for 4 years, and a lot of the savers don't start until after this presidential term would be over. So it's very backloaded in the savings. So I'd get rid of those, and I would talk about that separately. I would say there's no room in the budget to do any of those new tax cuts until we put in place a debt deal. But secondly, they just need to look at a lot more savings, or they need to look at other ways to broaden the tax base. Ways and Means oversees $50 trillion. There are so many different areas of the budget that we can be talking about beyond just the things that the savings that they've put in place. I would look at broadening the tax base, where the tax expenditures run through it. It's spending programs through the tax base. And that loses about $20 trillion over the next 10 years. So I'd go back to the drawing board. Incremental reforms are not going to make this structurally responsible.
Maya, appreciate your time, as always. We'll be speaking soon, no doubt. Maya McGuinness of the Committee for a Responsible Federal Budget. This conversation will continue as well. In just a moment, we'll catch up with the Congressman, Mike Lawler, who's pushing for a much, much bigger number.
Yeah, he represents Westchester and parts of New York that have been disproportionately affected by that cap on the SALT tax deduction. He wants to see it go up further than that $30,000 level. How much he gets that is going to be a big question, especially given what kinds of cuts would be required to offset that in order to make Maya McGuinness feel a little bit more comfortable.
The Treasury Secretary, Scott Bessent, though, wins some common ground with Maya. He has said repeatedly, consistently, that it's very important to extend TCJA, because if you don't, you're talking about a major tax hike that could trip over this economy.
Yeah, and you do that, and suddenly the revenue side of the picture goes down, and that doesn't help the deficit at all either. I mean, this is a two-sided picture, and everyone just has to keep that in mind as they look at this.
Maya said, look to the bond market. We'll look to the bond market. Yields are down by 4 basis points now. We've just broken 440 on a 10-year. No drama here just yet, 439. Up next, Congressman Mike Lawler calling for even stronger SALT relief. From New York, you're watching Bloomberg TV. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We're looking for a fifth day of gains on the S&P 500 this morning. On the S&P, we're higher by 1/3%. A trade truce between the US and China, a lighter touch on AI chip exports, helping to drive a big week for tech stocks. We'll get to a few of them later in the program. The Nasdaq 100 up by 0.4%. Really interesting 24 hours in the bond market. All of a sudden, yields down from 450 to 440. On a 10-year, we break that level. We're down 4 this morning to 439.42. Some disinflationary data, a tug of war between that and the prospect of a rather large tax bill coming together in Washington.
Yeah, for hot second crisis over, and now people are focusing on PPI. Does that change when we get language from the tax bill? And there's been a real push-pull. Are the bond vigilantes still alive, or aren't they? Because ultimately, they seem to come and go, depending on the day.
That's the long end of the curve. Front end of the curve anchored around this view the Fed's not going to cut rates anytime soon, reinforced by the communication from Fed officials themselves this week.
Wait and see, and this ability to do so at a time where the economy is still chugging along with retail sales not completely breaking down, although they were softer than many people expected.
The 10-year this morning's down by 3 basis points. The 2-year lower by 2 basis points to 3.94. That's equities and bonds. We need to get you some movers in the pre-market, so let's get to that. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. We got some deals to work through. First of all, Charter Communications announcing that it would be merging with Cox, putting the two U.S. cable behemoths together. This would create, again, one of the largest offerings at a time that they're really competing with streamers, with wireless providers. The deal, they say, will help them compete more efficiently, build out more infrastructure, put bundles together. Cox, for its part, is a privately held company, but Charter Communications is public. Those shares up 9.4%. Some other deal news, this time among U.S. generators. Vistra will be buying 7 natural gas-fired power plants. We've seen a lot of deals like this year, and it really just underscores that these energy companies are trying to beef up their fossil fuel offerings, making a bet that that's what it will be required to power AI. Again, despite the fact that we had DeepSeek, seemingly that it would lessen power generation or power demand, that has not yet happened. They are doubling down. Finally, I have Virgin Galactic. Look, I had to put this one up here. I know it's a small company, only $140 million market cap, but shares are up 17% this morning because late yesterday, the company said that it would be increasing ticket prices for its space tourism flight. It didn't say by how much. Current price is around $600,000 for a seat, so they're going to go higher. And John, maybe the good news is I don't think anyone has space ticket flights in their inflation basket.
There's your inflation right there, Danny. Thank you. Thank goodness for that. Danny Berger. Not a vacation any of us are going on anytime soon, right?
Well, I just think that single-handedly changes CPI. I think we all should think about that. You aren't going to go to Mars?
No.
If you could?
No chance.
Come on.
No interest.
Play with the Martians?
Zero. I'd be very scared.
I'm taking 9 months to get there, and then
Speaking of airfares were down, right?
Yeah. That was one of the big inputs. Airfares on the heels potentially of gasoline, but also lower demand, which goes to the heart of just how strong is this consumer.
Interesting. A serious conversation in there somewhere. Good news. On a radar this morning, President Trump wrapping up his Middle East trip, securing $200 billion in deals during a visit to the United Arab Emirates. Trump also clinching $600 billion from Saudi Arabia and more than $243 billion from Qatar. NVIDIA this week is up by close to 16%. 16% move on NVIDIA this week.
Anne-Marie highlighted it well. The other person who was very much front and focus was Jensen Huang, who is enjoying the sword dancing and the camel parades and the hair-flipping dance performances. And there was a sense that he was really being paraded through as the example, as the acme of American exceptionalism, and that suddenly he'd be able to offset any decline in chip sales to China with chip sales to the Middle East. The big question remains, as Anne-Marie was talking about, just what ends up happening when you do start to parse through how secure these chips are from the diffusion concerns or getting over to places like China, despite some of the strategic decoupling that we've heard about from Scott Bessent.
Jensen feels like the man of the moment, doesn't he? Doesn't attend the inauguration, went to China instead. All of a sudden, he's a feature of the conversation over in the Middle East, and it's Tim Cook of Apple that gets called out for all the wrong reasons.
Yeah, well, you know, I keep thinking about Dan Ives, and he's saying, you know, this sort of superstar rock star comes out in his leather jacket, and he's the future of a lot of the hopes and dreams of the artificial intelligence, of the algorithmic learning models. And President Trump has had sort of an off-again, on-again relationship with him. Now it seems to be very much on at the expense, frankly, of Tim Cook, who maybe is getting shafted with some of the goals of where they can move their production.
It's a big piece of the bull case for the equity market. Big rally in NVIDIA this week, big rally for tech stocks more broadly. Need to talk about foreign policy elsewhere. Russia and Ukraine beginning their first direct peace talks in over 3 years. Negotiators meeting in Istanbul. However, Secretary of State Marco Rubio downplaying expectations, saying progress is unlikely without a meeting between President Trump and the Russian leader, Vladimir Putin.
Yeah, and it's also unlikely without Russian President Vladimir Putin meeting with Volodymyr Zelensky of Ukraine. If they don't talk directly, if it is a low-level committee that comes to the table, it's hard to see whether they can get any kind of actual resolution. Just thinking back to what Eddie Fishman said, how much is there any will at all on the Russian side to get to a resolution, given the fact that they've taken a real maximalist approach and haven't really removed that or really backed away from that, even with some of the concessions that President Trump has made?
2 months ago, I think it was seen in the White House, and you could just see this based on the commentary, that Zelensky was the biggest obstacle to peace. That was the belief. I think Ollie did a pretty good job of articulating how things have changed over the past 2 months, and that Zelensky's doing his utmost to convince the White House that the biggest obstacle to peace is the Russian leader. The fact that we didn't get that high-level delegation attending talks in Turkey, does that do enough to convince the president that maybe he needs to go further and put on the big sanctions effort that the likes of Senator Lindsey Graham is trying to push?
And that's really going to be the ultimate question. And what happens if that's not the case? If it is the case, what does that do to this nexus that's being created of Russia, China, and Iran that has been one of the competitive features in the multipolar world that we keep hearing about?
This can change fast. The president, once again, wheels up for the Middle East, pushing again for a conversation potentially with the Russian leader and acknowledging without that conversation, it's unlikely we see any break to all the fighting we've seen over the last several years. I want to turn to this story, an important one for the tri-state area. New Jersey, transit engineers going on strike, disrupting travel for tens of thousands of commuters. It's the first rail strike in more than 40 years for the agency. The union representing engineers arguing for higher wages.
Yeah, 450 workers walked off the job. They are looking for higher wages. And there is the local feature of this. Are people going to take cabs? Are they going to drive? Are they going to work from home? Because why would they want to brave the roads in this type of circumstance? And then there's a bigger issue, and this goes to what we've been talking about this morning about states and their budgets and the budget constraints, particularly in blue states, particularly with some of the federal cutbacks. And I have to say, what Governor Phil Murphy of New Jersey said, I think, is important, that New Jersey Transit is facing a sobering fiscal reality. This maybe is a microcosm of some of the fights to come at a time where a lot of these municipalities are really strapped after having expanded their payrolls quite substantially over the past few years.
It's getting more expensive to drive into New York. If they want higher wages, it gets more expensive to get the train into New York, the bus, whatever you take, gets harder and harder, and it becomes more costlier.
Yeah, but at the same time, I recommend it. There are some good restaurants. There's some good theater. I'm just saying.
Is this a commercial for New Jersey to stay home or for New York to come into the city?
I don't know. I'm confused.
Which one is it?
Well, I'm born and bred New Yorker, so it is what it is. But I also do respect the fact that it's not congested. Look, I'm caring about the people who don't want to have that commute because it sounds miserable.
All right. Yeah. So work from home. So you push against Jamie Dimon.
No.
Is that what's happening here? Not trying to start fights. All right, let's go.
Let's get an update.
Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Today here, well, we start with a roller coaster week for Coinbase. The company was added to the S&P 500 earlier this week. Now it's facing a hacking and an SEC probe. The crypto exchange said hackers bribed its foreign employees to steal customer data and demanded a $20 million ransom, which it refused to pay. Coinbase is also cooperating with an SEC probe into whether it misstated its user numbers. Meanwhile, Richemont shares are rallying and Swiss trading up 7.3%. The luxury retailer posted a rise in full-year sales thanks to the popularity of its Cartier brand. Richemont's share price has posted a double-digit increase this year, while French rival LVMH has posted a double-digit drop in the same period. And the San Francisco 49ers have reached a deal to sell a roughly 6% stake in the team at a valuation of about $8.5 billion. That breaks the record for a sports franchise that was set in December by the Philadelphia Eagles. The buyers include 3 private investors in Silicon Valley Venture Capital. The deal will require approval at the NFL owner meeting. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on this program, Congressman Michael Lawler calling for even stronger SALT relief. That conversation just around the corner from New York. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Equity futures looking at a 5th day of gains on the S&P 500, up for 4 days through Thursday, up again this morning, up a third of 1% on the S&P, on the Nasdaq, up by 0.3, on the Russell, up by 0.2. 1.6. Turning from markets to the nation's capital, infighting between House Republicans threatening to delay a much-anticipated tax bill. The key issue, SALT cap increases. One man at the center of all of that, among others, Congressman Mike Lawler of New York. The congressman joins us now from Capitol Hill for more. Congressman, welcome back to Bloomberg Surveillance, sir. It's good to see you again.
Thanks for having me.
Let's talk about progress made this week. Speaker Johnson keeps saying we're getting closer and closer. What's your assessment of how much progress we've made so far this week?
Well, finally this week, we had the opportunity to sit down and go through real numbers and start to have a negotiation. And I think that was long overdue. We had been pushing for months to have that conversation with the Ways and Means Chairman, with the Speaker. So we finally began that process. And obviously, this is something that's going to have to be negotiated over the weekend to get to, hopefully, an agreement when it comes to the issue of SALT.
We understand the proposal, a tripling of the deduction to $30,000. Could you give us a sense on how far apart you are right now?
Well, there's a number of issues. Number one, the marriage penalty and eliminating that for those filing jointly. Number two, there is real concern about reverting to a $10,000 cap, which none of us support. That is a real challenge. Number three, the fact is these income limits are a problem. 400,000, while it may sound like a lot in some areas, in an area like mine, that's, a cop and a teacher who are married and, have a combined income. So the fact is we have high property taxes coupled with high income taxes, and you'll blow right past the $30,000 cap without a problem. You look at my district, 3 of the 4 counties that I represent are in the top 16 highest property tax counties in America. And so there's a real issue here in terms of the numbers. And so we're working through it. I've read The Art of the Deal. I'm not going to negotiate in public. But the fact is that, we need to make some significant concessions to get to a number.
Congressman, what would you like to see cut to offset some of the increases to the SALT tax deduction? Because ultimately, the SALT cap, because that's a real concern right now for markets, is how much does that alone increase the deficit?
Well, a few things. Number one, any cap is a savings, okay? Because the fact is that the cap on SALT expires at the end of the year. So we are actually giving them a pay-for by agreeing to a cap. That's number one, and people should recognize that as part of these negotiations. Number two, there's a number of levers that can be dealt with here in terms of savings versus adjustments within the tax code. That's what we're talking about. We're waiting to hear back from the Speaker and then be able to make a honest determination as to what we can get to.
There's also this issue, Congressman, that as this debate has raged on, there's been an argument that you have pioneered saying that moderates make the majority for Republicans and that you need to be able to punch above your weight because without you, they wouldn't have the position that they actually have. How much is this sort of setting the stage for what's to come? How much do you see this as a theme that we're going to hear about quite a bit as we head to the midterms?
Well, listen, we have a 220-seat majority, and 3 of us won districts that Kamala Harris won. You lose the 3 of us and you're in the minority very quickly. Look, I think the reality of this is math. And I certainly respect all of my colleagues. They're all here to represent their districts, as am I. And my district has different needs than some of my colleagues who are in safer seats, who are in more Republican seats. That's just a reality of life. And so to me, this is about compromise. None of us are going to get everything we want in this bill or any bill. But all of us have to find a way to work together to keep the majority and make sure that we're delivering for the American people and our districts. And that's what I'm doing in fighting for this issue, fighting to protect Medicaid. I have one of the highest, a district with one of the highest number of recipients of Medicaid. There are people who rely on these critical programs, and I'm doing everything I can throughout this process to protect that, including blocking any changes to FMAP, per capita caps, block grants, dish cuts. We've been able to do that throughout this process and make sure that those who rely on these programs receive the benefits that they need, while making sure that we eliminate waste, fraud, and abuse, prevent illegal immigrants from receiving Medicaid benefits, make sure that able-bodied adults without dependents are working or going to school, and making sure that those who are no longer eligible are not continuing to receive benefits. Those are common sense reforms that the vast majority of the American people support.
Congressman, you mentioned the out of the deal. Let's talk about the author of the out of the deal. The president's on his way back to Washington. Do you have plans to speak to him? And do you have a decent sense of what his position is?
I will be reaching out to connect with him for sure. I think he obviously had a very successful trip in the Middle East, brought back significant investment into the United States in agreements with Saudi Arabia, the UAE, and Qatar. And that obviously bodes well for the American economy as we move forward. So this was a great trip for the president as chair of the Middle East and North Africa subcommittee. Certainly, I'm looking forward to getting a readout of more details on what occurred on the trip. But I think it was a big win for the president, and so he comes back, obviously on the precipice of getting one big beautiful bill passed. And so we have a little bit of work to do still, but I think it's been a very good week for the president.
I know you've been up all night. I just wanted to squeeze in one more question that I think is relevant to a lot of our audience. You've co-sponsored the Trust in Congress Act to ban stock trading in Congress. Can I just say, Congressman, we all find it absolutely ridiculous that people in Congress have looser regulations and restrictions to trade stocks than we do as financial journalists. Congressman, can we actually do something about that sometime soon?
Look, I am in full support. The fact is, you're here to serve. If you want to make money, leave. This to me is a very common sense reform to make sure that members of Congress or their spouses, we've seen some spouses who are prolific traders, in recent years. The fact is, they should not be benefiting from inside knowledge or information gleaned from meetings they have, committee hearings they hold, or legislation that is pending. And it's just a reality of life that anyone in this position is provided with more information than the average person.
Yep.
And therefore, it is imperative to make sure that members of Congress or their spouses are not benefiting from that information, and all of their assets should be put in a blind trust, period.
If they're that good at trading, they should start a hedge fund. Congressman, appreciate your time, sir. Gonna have a busy weekend, I'm sure. Let's hopefully catch up again soon. Congressman Mike Lawler there on the effort. Lisa, down in Washington, D.C.
Yeah, many efforts, including that to potentially get some trading regulations in place. I do think that the effort, when it comes to the tax bill, is going to be absolutely incremental, and it's going to be incremental for a lot of people in the market.
Kelsey Barrow of J.P. Morgan's with us. He's got this to say: the biggest risk to the bond market in the near term is the budget trajectory and the reconciliation negotiations. Kelsey, your thoughts on what's taking place down in Washington?
Yeah, so the market is laser focused on these negotiations. And it's not just, we were hearing about the fight within the Republican Party on the SALT deductions, but there are a multitude of groups that have issues that need to be addressed to move this forward. And as you rightly mentioned, Lisa, adding to the SALT deductions is another thing that is a cost that increases the deficit. Regardless of the counting around it, it's something that is giving a tax break to people. And so from a bond market perspective, everybody wants to know about what are going to be the pay-fors that we're going to be looking at. And I am encouraged by the fact that if I look at the price action today over the past few days, we have been able to stabilize below the 450 level, which was our range going into it. 375 to 450 was our range for 10s. We have been able to stabilize there, but the bond market is certainly on edge on this topic.
So there's this sort of push-pull right now because a lot of people have come on the show and said if they're worried about recession, they're worried about some sort of negative growth shock, that they're going into treasuries, that they think they're getting paid for it, even though they understand some of these existential worries. How do you negotiate that for your own bond portfolio, understand what that risk premium is for fiscal concerns?
The term premium has to be higher. But I will say that I do think a lot of this is already priced. When I look at the 30-year yield nearing 5%, I do think that a lot of those concerns are somewhat already priced into the market. And when I really think about, you know, where is fair value for Treasury yields, and you build out a model, once you adjust for the path of growth and inflation, the level of debt supply and deficits really isn't a driver, at least historically, for the level of Treasury yields. So in other words, we've had times where yields are higher when we had budget surpluses, and we've had time where Treasury yields are lower where we've had budget deficits. So ultimately, when you think about the budget reconciliation, it's not just the deficit itself, but is there a growth and inflation impulse that's going to impact the economy and impact the Fed's reaction function.
And that's the reason why people say this is slightly different, because we increase the deficit during a time of expansion, not necessarily contraction. So that's different than usual. Is there any budget that could come out of Washington that would make you say, I am not buying unless we get above 5% on that 30-year?
I mean, that's a pretty difficult question. I honestly think that there is still quite a lot uncertain in terms of what we're going to get out of the budget. I mean, sure, yeah. Hypothetically, there is a situation where the plan is just so reckless that you know, the bond market has to come in and really police the market, right? But you know, kind of turning to what we expect and what is out there right now, I think what we have is a scenario where yields are already quite high. They're compensating you for an expansion in the deficit. And I think what has changed, because bonds, we do feel, continue to have a place in your portfolio. Now, what has changed is the narrative around why bonds fit. So a week ago, when we were in a scenario where there was high tension between U.S. and China, effective tariff rate of 20%, recession was the base case, people saw bonds as an attractive hedge in their portfolio for a hard landing where the Fed is cutting aggressively. Now we're in an environment where, well, maybe the Fed isn't cutting, they're on hold, yields are more range-bound, and the place of bonds in your portfolio is returning to really where it was at the start of the year, which is high income, clipping coupon. Credit fundamentals still seem actually quite healthy. When we stress test our companies for a 10% tariff regime, 20% tariff regime, we're still ending up in a place where investment grade corporates have low single digit earnings and revenues. So back to a world, at least for the short term, where bonds are providing that income stability, clipping coupon again.
The debate continues. Is it fiscal stimulus or fiscal recklessness?
I think we'll have to just wait and see, and I'm not going to answer that question because who knows?
Cassie Barrow of JP Morgan. Cassie, thank you. Appreciate it. Up next, Alex Altman of Barclays, Anisha Sherman of Bernstein, Kathy Boschantic of Nationwide, and Stephanie LaRoselier of Invesco from New York City. This is Bloomberg.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Certainly by the fall, I think we will start to see the impact of slower growth.
Stagflation is an increasingly bigger concern.
Chances are, with what we know, lower inventories, fewer selections, and higher prices.
Dislocation between the soft data weakening and the hard data kind of muddling along.
There's a big gap between confidence, sentiment, and the results.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
A trade truce with China and the United States of America. Lots of deals in the Middle East unleashing a big rally in this equity market. On the S&P 500, 4 days of gains. This could be day 5. Equity futures and your scores look like this. Equity futures up by 0.3% on the S&P. On the NASDAQ 100 up by 0.4. Tech on the S&P this week higher by 8%. 8% in 4 sessions. Amazing. Your day ahead looks like this. A little bit later this morning, we get another read on consumer sentiment going into the weekend. The next week is dominated by retail earnings, Target, Home Depot. But I think this weekend, take a beat. Negotiations down in Washington, D.C. on the tax bill. All of a sudden, the tax bill has taken center stage.
And we saw that briefly when the 30-year yields really bumped up against that 5% level as people parsed through just how much the tax bill would increase the deficit. It is unclear what's going to get through. It is unclear what it's going to look like. It is unclear just how much the bond vigilantes are going to look at this. But you asked a question, and I didn't answer it. Is it going to be a tailwind or a headwind? Is it going to be a stimulus, or is it going to be something of a fiscally irresponsible drag on the bond market? And that ultimately is the question people are looking to get resolved.
How it's viewed is really important. If it's viewed as fiscal stimulus, take foreign exchange. That's currency positive. If it's viewed as fiscal recklessness, foreign exchange, that's currency negative. Which one is it at the moment? Because we've been ducking and diving between one and the other. repeatedly over the last several weeks.
And I think a lot of this comes down to just how much the bond market's going to fund, because if you have yields going up that makes it more expensive to fund the fiscal expenditures, then all of a sudden it looks a little bit more reckless and less sustainable. If yields behave and they can get something through, then we are in the similar kind of paradigm as we were before. So really it goes to a question that you have asked so many times before, which is how long will the U.S. have the privilege of acting recklessly? And that, I think, is a real question that the bond market's going to have to answer.
The Congressman Mike Lawler not too concerned about that right now. He's pushing for even more. The president's going to return to Washington. I imagine the president's going to have something to say. He wants his one big, beautiful bill. Who's he going to support?
Honestly, this is going to be a real key question, and right now his focus has been on Jensen Huang and going to the camel parades and the sword dancing. Have you seen any of these spectacles? I mean, have you seen the hair flipping dances?
I don't know what I thought about some of those dances.
Oh, yeah?
Yeah, I found them a bit uncomfortable. I'm not sure how I would have responded if everyone was around me dancing in quite the same way they were dancing around the president.
Well, there was a pretty big distance, if you noticed, between them, particularly with the sword dancing. I will say, though, that there is this push-pull, and when it comes to the budget, this is the issue. Like any company, you've got two sides of a balance sheet. You have the income and you've got the expenditures. And right now, how much do you sacrifice the income side, slow growth, to really curb some of those expenditures?
I assume they're master swordsmen. The president's a good sport. I think he was entertained by it all.
I think it was fascinating. I would have enjoyed that. You know me. I would have been on a camel myself, out to camp in the desert. I would have loved it. It would have been really fun.
It's very you. This is what happens when we go to Jackson Hole together. What does Lisa do? Lisa goes hiking.
Yeah.
Goes out in the kayak.
You pull away and say, why?
Running away with bear bows and, you know.
You've got bear spray.
All of that,
yeah, it's really going to the lodge.
Not going there this summer. Equity futures on the S&P, positive by a third of 1%. Coming up this hour, Alex Altman of Barclays as stocks look for a fifth day of gains. Anisha Sherman of Bernstein on a key stretch for the consumer. And we'll catch up with Kathy Bostjankic in just a moment of Nationwide on the divergence between hard and soft data. We begin this hour with stocks heading towards a week of gains. Alex Altman of Barclays writing, not everyone is back in the ocean, but perhaps ankle deep and the water feels nice and warm. Recession has moved firmly to the back burner. Alex joins us now for more. Alex, good morning. Good to see you.
Good morning.
You weren't alone, so I'm not picking on you. But the trade truce between the US and China seemed to catch a lot of people off guard. And all of a sudden, to start this week, it's like tariffs is yesterday's news. It's all about the tax bill. What do you make of that shift?
So I think, well, as you said, we got it wrong, and we're happy, not happy, but we'll admit that, like a lot of people did. I think the bottom line is that we're now moving so quickly from narrative to narrative, and it's moving so quickly that positioning can't keep up. And I think this really is the critical theme to think about in markets at the moment is that narratives are moving, I'd say, every 2 weeks. If you think about the size of hedge funds, the size of gross balances, how much money needs to get moved around from a long-only community, there's just a scramble as risk tries to flip-flop between, say, being very defensively positioned to now being like, okay, do I want to be more cyclical positioned, or is the economy now going to be in better shape? And as we move towards this trade discussion, then it's all of a sudden the jump goes from, okay, are we going from fiscal contraction to expansion? If I look to 2026, if all of a sudden, do we actually now want to start talking about GDP being better than expected and earnings all of a sudden, okay, 290 of S&P earnings in next year, and I'll put that back on a peak multiple, 2024 redux.
That word risk, we need to define it. Lisa asked the question earlier on in the program. When we talk about risk, what kind of risks are we talking about? When you consider the hierarchy of concerns, what was it 2 weeks ago and how has it developed in the last 2 weeks?
I mean, great question. So we actually conducted a survey on this at the beginning of April, middle of April, and then we reconducted it just 3 weeks later, just to sort of gauge it. So as you would imagine, 3 weeks ago, top of concerns, tariffs, left, right, and center. And now we conducted it again this week, top of concerns, inflation and rates. So it's really just flipped again dramatically, that narrative from putting tariffs on the back burner, which I find a little bit discomforting purely because these tariffs are all on a 90-day delay. And sure, we could make the case saying, well, actually, the 14% effective tariff now effectively is a ceiling, and we can get positive on that. But we're going to have to return to that narrative. So even though the top of those concerns right now is the fiscal dynamic, I'm pretty sure in 3-4 weeks' time, which I know is an eternity in this market right now, we will be returning back to the tariff narrative once again.
You've been in macro trading a long time. At what point do people look at this sphere and they say, you know, I don't think I'm going to go in the water at all, because every time that I go in, there's going to be a shark that comes out from somewhere and try to get me, and it just sort of feels like you're going to get whipsawed one way or another. How much of an edge can you actually get?
I think it's a very good question, and by definition, a lot of macro traders are having difficulty right now getting whipsawed from that positioning extremity, moving from one to the other. But the bottom line is that we're in the business of taking risk. We're in the business of trying to make money from trading the ebb and flow of these narratives. I think what's really changed, though, and it's the only thing that's really changed, is that the cadence of that narrative shift has changed as a function of that vol profile. So all you're really doing is you're just going to shrink down the size of those bets a little bit, but you're still going to place those bets and just be mindful and attuned to where that consensus moves quickly, and you probably want to start taking your risk off the table when consensus moves too quickly, which, by the way, I think is exactly where we are right now.
Which is the reason why so many people have come on the show and said they're going to lighten up in big tech just a little bit after this rip-roaring rally, as John was mentioning, 8% just in this past week alone. This feeling that what we've seen in the Middle East just dissolves all of the concerns around some of the slowing revenue growth by some of the tech giants. Do you think that that is kind of the way to go, given some of the developments that we've seen?
I'd say you have to think about very tactically in terms of, look at a lot of these big tech, they've got very high RSIs in the mid to high 70s now, rallied 8% on the week. But you've also got to remember, we've discussed this on the show before, the liquidity mismatch between big tech and basically everything else means that ultimately, if you want to redeploy capital into equities again, that's going to be your default source, not just because these are quality businesses, and that's actually a stylistic preference that we like at the moment, which is pro-quality, which includes some of big tech, but also just because if you need to deploy billions of dollars quickly, yeah, sure, you could trade futures, but at the same time, if you want to deploy into single stocks, you're limited. You're going to end up with some of those big companies as well. So they just so happen to check the box of that 2024 redux of higher for longer, economies slowing but positive, and quality balance sheets, and you're going to shun basically S&P 493. So yes, tactically you could say it could take a pause, but we've got the NVIDIA results coming up obviously at the end of the month. We've got AMD Analyst Day. We've got updates from OpenAI. So there's still positive catalysts on the AI front, which I think people are going to get enthused about until they run into a reminder that tariffs is still a threat, I think, sometime in June.
I've heard you make this liquidity argument before. Can we just build on it with one further question? Is that your argument to play the US over Europe? Is that the argument that you're making?
So, as you remember, beginning of year, we were very much non-US over US. US exceptionalism is waning, and we sort of very much went on the record with that. We took profit on that view in the middle of March because it just moved so quickly. Now, actually, tactically, I think there is an opportunity for that to reverse. Again, we have to work off 2 to 4 week time horizons right now. That really is the operating time horizon, sadly, for the investment community within my world at the moment. So if we're thinking about next 2 to 4 weeks, then yes, absolutely. I think there is an environment where the US exceptionalism trade can just make a little comeback. That obviously has profound implications for the dollar as well, in terms of the world is almost unequivocally and universally bearish on the dollar, which actually could take a hiatus too. And that in turn has implications for where did money flow into as part of the de-dollarization trade? Well, that would be gold. So we're actually quite negative on gold here as well.
Just tactically, though, not necessarily long term, all tactically. I am curious, though, about whether Europe will be the big beneficiary of some of the loss of American exceptionalism down the road, should that be the case. Right now, it might be a tactical pause in that trade, or whether it's going to be emerging markets, whether it's going to be other places that might see a bigger gain than, say, Europe, that has some very specific challenges right now as well.
Well, Lisa, you know we've actually been pretty constructive on just trying to be more creative and looking in the rest of the world. Again, with that liquidity acknowledgement that it's going to be difficult to necessarily deploy the kind of capital that you're used to deploying in the US. But as you know, yes, there's pockets of emerging markets that we've liked all year and still do like, most notably LATAM, which is still trading very cheap, has, I think, interesting idiosyncratic tailwinds. And places like Mexico, which I've mentioned before, is just the natural beneficiary from the readjustment of global trade. In Mexico, great geographic border, lower transportation costs, very good labor costs, and still trades at a very good valuation discount.
How do you want to manage the FX risk, given what you're anticipating in foreign exchange with the US dollar?
Well, look, I'm not going to pretend to be a complete FX expert, but I do think that...
No one is these days, Alex. Don't worry about it.
Well, I think what we've seen in things like the Taiwan dollar, the Korean won, I think we've got to accept the fact that there is an adjustment in global FX going on. Let's not call it a Mar-a-Lago Accord, but let's call it something like an acknowledgement that there needs to be an adjustment process. But again, if you're trading from an FX hedge basis, some of these domestic ETFs that are effectively giving you country exposure, you're already getting the benefit from a readjustment in the currency there as well.
Alex Altman of Barclays, thank you, sir.
Thank
Good
you
to
very
see you. I know that sounds like I just threw a lot of shade at foreign exchange and people in foreign exchange. Just want to make sure people understand. When we came into the year, we thought the trade story would result in a stronger dollar. Myself included, no one expected the kind of currency weakness off the back of those policies in quite the same way we got it.
Nobody expected decade-long moves in the span of just a couple of hours, whether it was the Taiwan dollar, whether it was the euro suddenly reprising a role as something of a haven currency and then losing it again and then gaining it again as people try to figure out what the alternative was to the dollar. Suddenly, gold is taking on a whole life of its own. I mean, honestly, those bars that you bought in Costco, really working out. I think it's good. I think that you should, definitely keep them.
I don't own any gold. I wish I had done over the last several years. Gold is down by 2.3% so far this morning. Equities up nicely, up 1/3 on the S&P, adding to this week's gains. On the S&P 500, higher by more than 4% on NVIDIA. Alex mentioned NVIDIA. NVIDIA higher this week by more than 15%. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Republican infighting in the House is threatening President Trump's one big, beautiful bill. The biggest issue, the SALT cap. A group of lawmakers from high-tax states, including New York and New Jersey, vowed to vote no on the package unless the cap is raised or abolished. Lawmakers have said they'll continue to negotiate throughout the weekend. Meanwhile, New Jersey Transit train engineers went on strike at 12:01 a.m. this morning, leaving tens of thousands of people looking for other ways to get to work. The walkout comes after the latest round of negotiations failed to produce an agreement. It is New Jersey's first transit strike in more than 40 years. And Novo Nordisk CEO Lars Fjorgard Jorgensen is stepping down. His resignation comes as the drug maker struggles with growing competition for its obesity treatment, Wegovy, which has weighed on the share price. According to a company statement, Jorgensen will remain in his post for a period to support a smooth transition to new leadership. That's your Bloomberg Brief. John?
Yahara, thank you. We'll touch base with Yahara again later this hour. Up next on the programme, the Morning Calls, plus Anisha Sherman of Bernstein on a big week for the consumer. From New York City this morning, good morning to you all. You're watching Bloomberg TV.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Stocks are higher every single day this week, and this Friday, we're looking to complete the streak. 5 days of gains potentially on the cards going into the opening bell. That cash open is 1 hour and 14 minutes away, with equity futures higher by 0.4% on both the S&P and the Nasdaq 100. On the Russell this morning, small caps higher by 0.7. That's the price action. Let's get your morning calls. First up, Canaccord raising its price target on Netflix to $13.80, citing progress in developing its ad business. That stock is higher by 0.5%. Your second call from UBS, upgrading Caterpillar to neutral, highlighting better than expected progress in US-China trade talks. And finally, Tausi cutting its price target on Target to 130, pointing to soft consumer spending trends and tariff pressures. A stock is up this morning. It reports next week. Let's stick with retail. A slew of companies reporting earnings next week, including Target, as tariff uncertainty weighs on outlooks. Anisha Sherman at Bernstein joins us now for more. Anisha, welcome to the program. Already a big week for retail. I want to start with that quote that came from Walmart yesterday. We will do our best to keep our prices as low as possible, but given the magnitude of the tariffs, even at the reduced levels announced this week, we aren't able to absorb all the pressure, given the reality of narrow retail margins. Anisha, that's how they're approaching this situation. How's the rest of retail approaching this situation?
Yeah, very similarly. So when we first got the news of the tariffs, what we saw was from January through March, every supplier, retailer, brand was trying to pull forward inventory to try to get ahead of that April 2nd deadline. So we saw a surge in imports because they were trying to delay the inevitable price increase by kind of stocking up on inventory. Those stocks have now depleted, and we are now seeing the effects of the tariffs coming into imports. And so now is when we're starting to see the pricing pressure come in. We haven't seen it yet. And no brand that I talked to wanted to be first out. Nobody wanted to be the first mover on raising price, but we've now seen all the way from luxury goods brands talking about 10% price raises down to Walmart talking about pricing on discretionary goods. So up and down the premiumization tier, everybody's talking about price increases. So it gives more permission for brands to do so. And we've heard from multiple brands, including Nike, Adidas, On, as well as many of the retailers talking about inevitable price increases coming because they are now no longer the first movers and they see this pricing umbrella within which they can move up as well.
Anisha, why are they so worried about being the first mover? Why is this so different this moment compared to what we saw coming out of the pandemic?
The difference is consumer demand. So coming out of the pandemic, if you remember, people had excess savings, right? They had stimulus checks that they'd been given in 2021. And so in 2022, savings rates were still pretty high. And there was excess savings out there. People were eager to spend. They'd been locked up in their homes for 2 years. They were eager to get out there and spend money. So there was a lot of tolerance for price increases then. And there were a rollout of a number of different price increases because of freight costs and labor costs, et cetera. But the consumer absorbed that. This is a very different demand environment. The consumer is much more sensitive. Consumer sentiment has dropped since February and continued to come down. And we're worried about inflation. So this is a very different consumer macro to be raising prices into. And that's the concern, is that the price increases will result in a big drop off in volume, particularly if you are the first mover and your competitors aren't doing it.
Anisha, how much does this really cap how much these companies can increase prices? And I go back to 2001, 2021, 2022, when you were seeing 10% increases on a lot of goods across the board. How much is it going to be different in terms of the magnitude this time?
It depends a lot on the individual sector. So, for example, within apparel, footwear, handbags, many of those sectors, China is not a big production market for the big brands. It's Vietnam. And so if the Vietnam and Southeast Asia tariffs stay at plus 10%, there really isn't going to be a huge need to increase prices in the double-digit range. However, for many sectors where China is the primary market of production, so some of the hard goods, home furnishings, many of the plastic products, toys, et cetera, you do see, I mean, if your majority of production is in China and the majority of your global sales are in the US, there's really no getting out of this through supply chain shifting. So you kind of have to pass on or absorb a lot of that increase. And for many of the suppliers, you can't absorb a lot of it. As you said on the Walmart quote, they're running on pretty thin margins. So a lot of that does have to go onto the consumer.
If it doesn't, Anisha, or if it does go onto the consumer and then the consumer just buys less, how realistic is it that some of these companies, these retailers, are going to have to cut staff, are going to have to look for cost cuts elsewhere in the company?
I don't think it will be the big retailers. It really will be the suppliers of those retailers. what we're hearing from the industry is these big retailers are pushing back on their suppliers, saying, you guys need to find a way to offset a good chunk of this. We're not going to be able to pay higher prices. So you're going to have to bear the brunt of this. And those suppliers are small and mid-sized businesses, with majority of production in Asia, a lot of them majority of production in China. So they are scrambling to try to find alternative supply chains or trying to find ways in which they can offset that cost. So that's where I think we will see some of the companies both falling out of the market, bankruptcies, as well as losing staff, cutting back costs, et cetera. I don't think it will hit the big retailers first. They will squeeze their suppliers before that.
Let's build on some of that. How much dispersion do you expect in the sector in the next several months? What do the winners have in common? What do the losers have in common?
Great question. What we typically see in times of disruption like this is there is more dispersion and there's share consolidation. So the big companies that are well capitalized, that have strong balance sheets, that can get through a period of pain and lower volume emerge, and the smaller ones that kind of can't make it work and don't have a very strong balance sheet either tend to cave and completely go out of business or tend to cut back. And that is, I think, what we will see if we continue to see this pressure, especially if we see inflation ratcheting up and the consumer pulling back on volume, is we're going to see a consolidation in the market, and the bigger players will be the winners here. The other factor is, as I said, category exposure and where the tariffs land. It seems like it's disproportionately China at the moment. If that remains the case, then sectors that are not absorbed to China will come by quite easily, whereas the ones that are absorbed to China will get really squeezed, and that's where we'll see some of that consolidation and losses and jobs and things like that.
Can I ask more directly where a company like Target might fit in? Where would they fit in, looking ahead to next week?
Yeah, I mean, I think given that Walmart has now been the bellwether and saying they're going to raise prices on discretionary goods, but not on food, I think that's the way a lot of the retailers are going to go, because food is that's what gets people in the door. That's where the lower income consumer is looking for price as a signal of value. And so I think retailers that have food and non-food offerings will pass more on the non-food. That's where they're getting higher costs. And they will keep their food prices low and maybe subsidize that through the non-food pricing. That's, I think, what we'll see for some of these earnings coming up.
Just to finish on Target, are you expecting any inventory landmines, any accidents, the kind of which we saw coming out of the pandemic, where we had a big problem with Target managing their inventory? Are you expecting anything like that in a different way this time around?
Absolutely. And I don't know if this is specific to Target necessarily, but what we've seen as the China tariffs were at 145%, what we saw was that there was a lot of stockpiling of inventory in China. So there were finished goods that were sitting in ports in China, not boarding ships, because the day you board the ship is the day you get tariffed. So a lot of suppliers were kind of playing the odds and saying, let's just hold this in China and see if we get tariff relief. That tariff relief came this past week. And so we are going to see a surge in inbound inventory as all those finished goods now board ships. They're going to be in the U.S. in the next few weeks. So we are going to see a surge in inventory. So we could see some inventory landmines, as you called them, across the sector, depending on what the ordering behavior has been. But absolutely, I think that drives some promotionality. I think it helps maybe secondary market, like it would help the off-price retailers. But the primary market of brands and retailers would be hurt by this.
Interesting. Deeply thoughtful stuff, Anisha. Appreciate your time. Going into a key week for some of the retailers. Anisha Sherman there of Bernstein, looking ahead to Target and Home Depot next week. So difficult to manage your inventory over the last several months. Remember the port strikes and how much Target found it difficult dealing with that moment. Try dealing with the last couple of months as well on top of that.
This has been a moment of supply chain rethinking and supply chain shocks. And the real question is, how do companies get ahead of this? How do they plan for this? And how do they remain nimble at a time where it's probably going to be more like this going forward? I do just want to go back to the point, and you asked her the question, how much do you see winners and losers in the divergence there? And the consolidation among smaller players is going to be really notable at a time where the big players, even Target, has a real advantage over them.
Retail earnings next week, looking forward to that, looking forward to more economic data later this morning as well. Another read on consumer sentiment in America. In just a moment, we'll catch up with Kathy Bocjankic of Nationwide, and we'll speak to Stephanie LaRoselier of Invesco from New York City. This is Bloomberg. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The opening bell is 60 minutes away, and equity futures are near session highs, up by 0.4% on the S&P 500. With your morning movers this morning with Danny Berger. Hey, Danny.
Hey, John. We got some serious pressure for Applied Materials this morning. Gave earnings after the bell yesterday. It is the largest U.S. maker of chip-making equipment, ringing the alarm bell. The current quarter, the guidance was very lackluster, really underscoring how difficult of an environment this is to navigate for chip makers with restrictions coming on and coming off. The CEO saying that it is a time of uncertainty. Those shares down 4%. To the upside this morning, though, is Estee Lauder. We got 13 F filings, and that seems to really be dominating the market move here. From Michael Burry's Scion Capital, they basically got rid of all of their equity stakes. They put puts on NVIDIA. The one thing that they seemed confident on was Estee Lauder. They doubled their position, so this market, even though that's backward looking, and from March 31st, the market's still paying attention, sending shares higher by 4% in the pre-market. Wrapping things up with some deal news, we learned that Charter Communications will be merging with Cox. The deal values Cox at around $34.5 billion. This will give us the largest U.S. cable provider at a time where there is increased competition for both wireless providers and streaming service. The hope is that putting these two behemoths together will make it easier to compete, build out infrastructure, and bundle products, so those shares up nearly 4%, John.
Danny, thank you. Thanks for this morning. Thanks for this week. It's been a big week for the U.S. consumer. We had a read several times, once with retail sales, another time with Walmart earnings. You'll get another read going into the weekend, a fresh read at 10 a.m. Eastern Time with the University of Michigan Consumer Sentiment Survey just around the corner. Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, Americans hate inflation, and we've got a little bit more inflation in import prices just out from the BLS. Import prices up by 0.1%, but take out petroleum, and they're up 0.4%. And you look under the hood, and non-fuel industrial supplies and materials were up 0.8% after just a 0.1 rise the month before, and capital goods up 0.6%. Guess why that is. And then what we'll see a little bit later is when the people start crunching, we'll get the PCE forecast for the end of the month, because we've now got CPI, PPI, and the import price numbers. Housing starts also out up 1.6%. It's a rise, but it's not as much as expected. The forecast was for a 3% rise. Building permits are down 4.7%. Remember, yesterday we saw a huge drop in the National Association of Home Builders Optimism Index, and so they may be cutting back. Those bounce around, but certainly housing not in good shape these days.
Mike, do we expect that sentiment number to bounce around as well? We talked so many times about that spread between the hard data, resilient, the soft data right down here and cratering. After the truce over the weekend, does it make a difference?
Well, that'll be an interesting question to see in the Michigan numbers, to see if that registered with people enough that they will feel a little bit better about it. And so you also wonder how low can that indicator go. But we'll see what they say about their inflation expectations as well. hard to know if it's going to move a lot given how much they've gone up. Remember, 6.7% is the inflation forecast over the next year. So we're not looking at people who are thinking inflation is under control.
Mike McKee, thank you, sir. That's the number I'd throw out too. 6%? Yeah, why not?
Yeah,
Make it 10.
Is that what you would say if they called you?
They don't call anymore. Is
Well,
that all online based now?
Well, that's part of the problem. Some people say when you're online, you're angrier and have more catastrophic
punchier,
thinking.
just 20%.
Yeah, just
next 12
months. 150.
It's important, though, that this is how they feel. That's what they believe the actual numbers are, because when they go to pay for things, they're so expensive. And I remember earlier this week, you pointed out gasoline. Will lower gasoline prices begin to shape perceptions of inflation in the other direction? Because we're seeing a sizable move in gasoline.
That's one reason why President Trump is focused on it. It is a psychological indicator. It is the billboard of inflation, because literally there are billboards telling you the gas prices everywhere. And when you see them going up, oh my goodness, when I fill up my tank, it costs a lot more. And when it goes down, it's the opposite. So here comes this question of going forward. Does that offset some of the actual inflation that you're seeing elsewhere and make them more able to pay for it, meaning that it can be stickier in other places?
Will it have to anchor inflation expectations? We'll see. We get that number at 10 a.m. Eastern time, so look out for that. The Federal Reserve so far this week echoing a similar theme. They're going to sit this one out and wait and see. Kathy Bosjanskic of Nationwide Mutual Insurance writing this: we still look for the Fed to wait until September to cut rates. Expect them to go with a larger 50 basis point rate cut, followed by another 25 in October. Kathy joins us now for more. Kathy, welcome to the program. Where does that come from? What's the situation you believe that starts to evolve over the coming months that leaves them in September reducing interest rates by 50 basis points?
Yeah, good morning, John. So I think by then they're going to have some evidence of the economy slowing, and particularly the labor market. That's really going to be the reason they cut rates and go a little bit larger. They're going to wait longer because of the inflation impact, and they want to see how that plays out. Is it persistent or temporary? And then, so because they're going to wait, they're going to have to go a little bit more, is our thinking. Go 50 basis points in September, another 25 in October. Then I think they sit December out and probably all of next year, because looks like we're going to get a lot of tax cuts and stimulus for next year. But they'll have that kind of brief window of opportunity to come in and lower rates, which by their own admission they're restrictive right now.
I'm pleased you're thinking about December, because I can't get past next week. Can we focus on the next couple of weeks as well? Kathy, the data we get between now and the end of the Federal Reserve's next window for its meeting, which is in the middle of June, you had this to say in April. You expect the GDP to stall out. Does the trade truce make a difference? The tension and tug of war between the policy volatility of April, the trade truce coming into May, and what it means for the data in the next couple of months?
Yeah, great question. So there's going to be a lot of shifting in the data. So we're going to continue to get that import surge, as Lisa talked about before. All those ships that were waiting goods, they're going to still come in. That's going to depress GDP growth at the headline number. Consumer spending, I think, we're already starting to see it, the pullback right after the front loading, but inventories should start to rise. They're pretty thin right now. So there's going to be a confluence of kind of offsetting factors. It'd be hard to get a real great read, but I think really focusing on the consumer and labor market, to me, is the key, because you're going to have the tariff impacts are going to skew the data, but I really want to know, how's the labor market looking? How are employers dealing with this? Just as, again, was discussed earlier, if they're not passing fully on the higher tariff price increases, they're cutting costs. The best way to cut costs is labor, unfortunately, and that's only going to further hinder consumer spending going forward.
So, Kathy, let's build on that. Do you think that what we heard from Walmart this week, that they have to raise prices, they cannot absorb all of the increase from tariffs in their margins, does that make you think that that's actually going to foster greater layoffs in other businesses that aren't as capable and resilient and large as Walmart?
I think it's a great point, because I think it will depend on the size of the firm, right? And the different industries and how much pricing power or profit margin they have now. Are the margins really thin or not? And I think it's also a really interesting point that a lot of retailers and even automakers are waiting, because they don't want to be necessarily the first one out the door. They want to kind of size up the environment. You sort of heard that with Ford at first, and even now kind of gently suggesting prices go up for certain models. But Walmart, that's a hallmark, right? Like when you hear Walmart come out and say they're going to raise prices, that suggests others are going to follow, and we will, I think we will start to see the price impact in the data going forward.
There's the Fed Chair, Jay Powell, that wants to understand just how much people are going to pay those prices, how much they're willing to it. And then there's the other central banker, who is Doug McMillon, as he looks out and sees how much people end up passing that along and actually absorbing that. Do you have a sense, to John's good point about gasoline prices, about whether lower gas prices will make consumers more able to absorb some of those price increases and actually, frankly, be more resilient than many people expect?
Another great point, because and it's just such an unusual time right now to see crude oil prices plummeting, and it's not just because of demand, it's also supply and gasoline prices coming on. And to the point, gasoline prices is a high frequency purchase. We tend to do that every week, fill up the tank, and that can free up, certainly if you're spending less on energy, it can free you up for non-energy purchases and discretionary. That said, I think the consumer is still going to be cautious. I think there also is so much forward pulling of consumption, like all else equal. If you bought a car or a refrigerator or whatever, even non-durable items, you're not going to rush out to stock up on them just because gasoline prices are going down. I think you're still cautious, but it certainly helps on the margin, no doubt.
Kathy, appreciate the update from you. Have a great weekend. Kathy Bosantke there of Nationwide Mutual Insurance. It's going to take a lot of bad data to convince people things are bad. It's going to take a lot of good data to convince people things are good, because the data is going to be so distorted over the next several months or so, which takes me back to the Andrew Holnhorst call over at Citi. The idea that the Fed's in a position in July to cut interest rates. They're going to need to see a lot of weak data to get to July and be convinced they need to reduce interest rates.
And it has to be specifically weak data. It has to be weak data when it comes to the labor market, because that is a forward kind of driver in terms of activity. I'm just struck by all these different cycles that are kind of layered on top of each other. We've been dealing with this for a while. There's the tech sector and that cycle. There's the economic cycle. There's the geopolitical cycle. There's the trade cycle. And you kind of have to overlay all of these things and figure out what's where. And that's the reason why when people come on, they feel like, oh, yeah, there's that.
Which is why
there's that.
The market's only doing one thing at a time.
Exactly, because how can it do anything else?
Moved away from trade, it's now focused on taxes. To think about trade again, they're going to have to see some bad data related to the tariff story.
This is what anybody does when they're overwhelmed. They compartmentalize, and that's what the market is doing.
Good therapy, eh? Gets you to a better place in financial markets. Right there with you. Joining us now, not for therapy, for Market Calls, Stephanie LaRoseliere. Stephanie, welcome to the program. It's good to see you. Let's talk about whether you've heard a compelling argument to bring capital back to the United States. A truce with China, the prospect of a tax bill in Washington. Is that enough?
So we've taken to nowcasting is what we're calling it, because of the amount of uncertainty that is just in the market, in the news, in the headlines. It's really hard to make a distinction, too much in the future at this point. So when we look at what's taking place with China and the truce there, well, that's a truce. It's a 90-day pause. It's not concrete. For us, what we've seen and heard has allowed us to take down our recession fears just a little bit. We had a 50-50 sort of outlook in terms of recession versus soft landing. Now we're maybe 45% on recession, just because it's a good sign. But if we think about China, who tends, has been our biggest adversary from a trade war perspective, they're now on par with the UK. UK, by most accounts, is one of our friends, right? And so having China with the same type of tariffs as the UK feels like something is going to have to change. Doesn't feel like we're near the end of this trade war with China. So we're still paying attention. We're still navigating. It's going to be very difficult because, as you said, political headlines, geopolitical risks. Now we have, the tax bill in Washington. So much uncertainty is built into the market, just making it really difficult to really have a long-term forward-looking projection.
Do you feel like you have a higher recession probability than the market does right now, given some of the rally that we've seen in risk assets and, frankly, the loosening up in financial conditions?
So I would say that, our viewpoint right now is that if we continue to see what we've been seeing, we need more than concepts. We need actual deals. We need more than pauses for us to feel certain about stepping away from the recessionary fears. So, as long as we continue to see sort of the continuation of what we've been seeing, and it's interesting, you guys were just talking about oil, we'll see what kind of deals come out of the Middle East, and whether those are actually concrete deals that can help Americans. And that may actually, change our outlook regarding recession.
As John was saying, our focus seems to be shifting very quickly and collectively from one thing to another because we cannot view all the things at once. And when we try to, you start sounding like me. So there's this question of how much our focus is moving from international to domestic, especially with the tax bill and what's going on in Washington, D.C. How much are you concerned about the ramifications of some of these cuts on municipalities, on local governments that have frankly been some of the big drivers of hiring over the past 4 years?
Yeah, so when we look at the municipal market, we look at the credits in the muni market. The credits here have been in good shape for quite some time. We've been looking at upgrades to downgrade ratios that have been very favorable for municipal issuers, for states, for local governments. We're looking at rainy day funds. So, the states and the local governments have been through the exercise of having to deal with fiscal constraints over the years. And what they've done in response to that is increase their rainy day funds, increase their, pool of capital that will help them in the event that something takes place that is unprecedented, that they're not necessarily prepared for. So we feel good about where munis are. We think, munis are going to continue to see some volatility because of what's happening in the trade market. But really, at the end of the day, this is a problem for the muni market, but it's not an actual muni problem.
Lisa's very worried about New Jersey, aren't you?
I am.
I know you are.
I mean, honestly, this is a problem. If you can't pay people, 450 people to come to the office or come to the train or come to the bus, get people over, then, that's going to be a problem for the work from office, which is the big thing. And I mean, this is going to be for all of us.
That's why they're pushing for a big SALT deduction. Get them more relief.
Okay, look. There's a bigger discussion here about whether blue states get disproportionately affected than red states from some of the budgets. And honestly, I think
taxes are just too high in blue states. Let's put it that way.
You could have that discussion. You could say they should just lower the taxes. And then, but then you could also say that some of the economic engine of the nation and contributes to disproportionately to the overall GDP of the United States. So you could make that argument as well. There are lots of arguments out there.
Some of these southern states are doing fantastic. Florida, always this great example of what you can do with the budget, and why can New York not do the same thing? I hear that comparison all the time.
Okay, well, we should do that sometime. But I will just say these are the things that are being discussed, and I'm just saying though that states have been a huge driver of employment, and they've been a huge driver of the economy. And if they have to start pulling back, including in places like Florida, that might have a ramification for the economy and certainly bonds.
We've run out of time this time. Stephanie, appreciate your time. Stephanie LaRoselier of Invesco. Stephanie, thank you very much. We could do that next week if you want. We'll make time for it.
We don't have to.
We don't do Moonies enough.
No, we don't. Well, I actually think it's really important. I actually think that they might get more interesting, especially as these cuts come into focus.
Let's have that conversation next week. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara. Hey, Yahara.
Hi, John. President Trump saying he will set a tariff rate for a number of U.S. trading partners over the next 2 to 3 weeks. He says Treasury Secretary Bessent and Commerce Secretary Lutnick will begin sending letters to about 150 nations that the administration doesn't have time to meet with, but he says want to make a deal. Meanwhile, a roller coaster week for Coinbase. The company was added to the S&P 500 earlier this week. Now it's facing a hacking and an SEC probe. The crypto exchange said hackers bribed its foreign employees to steal customer data and demanded a $20 million ransom, which it refused to pay. Coinbase is also cooperating with an SEC probe into whether it misstated user numbers. And in sports, the Denver Nuggets and Oklahoma City Thunder are heading to Game 7 after Denver staved off elimination. The winner will face the Minnesota Timberwolves in the Western Conference Finals. And the Knicks will look to close out their series against the Boston Celtics in Game 6 tonight at Madison Square Garden. If they win, they'll make their first conference finals in 25 years, and New York will go crazy. That's your Bloomberg Brief. John?
8 p.m. Yahara, thanks for that. Have a wonderful weekend. 8 p.m. And I think the ticket prices would make me cry, so I'm not even going to look.
I think that the lowest one is some $600, I think, but I think it might be more than that.
I reckon you'd be lucky at this point to get in for $600.
Oh, you wouldn't actually get it. Somebody else has it, and it's actually...
Oh, it's gone already?
I'm sure.
So there's nothing available? All right.
I haven't actually
What's like the get-in price? It must be thousands.
Yeah, well, it's not a club I'm part of.
what do we call them, TK seats?
Yeah, exactly.
Yeah, they're like, you know, yeah. We'll have a look later. All right, up next, we'll set you up for the week ahead. We'll touch base with Tyler Kendall. Big weekend coming up in Washington, D.C. From New York, this is Bloomberg.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China is going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Nosebleeds, Celtics, Knicks, Madison Square Garden, $666.90.
So there you go. It's cheap.
Yeah.
You can buy some.
Ridiculous.
Yeah. Look, this is the issue, right?
If you want a view like where you can see thousands.
Yeah, well, I guess that people have seasons tickets, and it's for people who can afford that. And I guess that, you know, you're not going to be there, are you?
I'm not one of those guys.
Me neither.
If you've got a ticket and you want me to come with you tonight, no, we're not allowed to do that. I didn't just do that. Equity futures on it, I can't go. Equity futures on the S&P, up by 0.25% on the S&P 500.
You can donate them to a trust that has his name on it. You know, no, it doesn't work that way, but we can
I say
create a
no
new
all the
thing.
time.
Yeah, well, yeah, 8 o'clock.
On the NASDAQ, up by 0.25%. So we count you down to the opening bell. Here's your trading time for the week ahead at 10 a.m. Eastern Time. UMich sentiment is coming up before we get into the weekend. This weekend, lawmakers set to continue debating President Trump's tax bill. Tuesday, Home Depot earnings. Wednesday, earnings from Target. Thursday, PMI data, and another round of jobless claims. Before you can think about next week, we need to talk about the negotiations taking place this weekend. Tyler Kendall joins us now from Capitol Hill. Tyler, let's talk about how far these two sides are apart going into a key weekend of talks.
Yeah, hey, John. Well, far enough that they do need to work over the weekend to try to come up with some sort of compromise to advance this legislation so that they can pass it by House Speaker Mike Johnson's goal of Memorial Day out of this chamber of Congress. Now, it was interesting to hear New York Republican Congressman Mike Lawler say earlier on this program they're still negotiating beyond just what that number will be to lift the SALT cap to. They're also talking here about the marriage penalty, about income limits, about what the phase-out or expiration date will ultimately look like going forward. Will they just snap the SALT cap back to $10,000 over time? And it was particularly interesting to hear him confirm that he does have plans to reach out to President Trump to talk to him about this deal this weekend when he does arrive back to the White House after his Middle East tour. And that really shows us that these moderate Republicans from these high-tax states are going to use their leverage where they can. Now, of course, the other part of this are these other Republicans that are going to try to use their leverage, and that's those fiscal hawks who are trying to look for some more savings in this package, or at least some of those savings to be pulled up to happen sooner instead of in a few years from now, as some of them are currently written in the bill. And actually, in just a few minutes' time, 9 a.m. Eastern, a budget committee hearing is set to kick off. We're going to be watching that closely because these fiscal hawks are threatening to tank that committee markup because they are demanding to see some more cost savings.
Another weekend of key negotiations. Tyler, looking forward to your reporting. Tyler Kendall down in Washington, D.C., going into these talks over the weekend.
What does a fiscal hawk mean right now?
No idea.
I mean, how much do people want to get the budget down? How far are they willing to go? Or how willing are they to go to Medicaid, which is sort of the key cutting ground? These are some of the key questions that I just don't have any grounding in.
I think most Republicans are willing to extend TCJA.
Yes.
Because they realize they have to, because they realize if they don't, this economy could get into a little bit of trouble. It's the additional stuff, it's the stuff on top of that. And much of that stuff, pretty much all of it, was promised on the campaign trail.
Yeah, which is the reason why it's very interesting that President Trump has not been around. And now that things are getting tricky, he's going to be having a working weekend, as Anne-Marie was saying. He's going to come back to the Hill and he's going to say, okay, guys, let's get it together. And that's the reason why, to Tyler's point, it is important to see the fact that Mike Lawler is having a conversation or is going to reach out to President Trump, given that SALT cap and trying to potentially raise it, and frankly, President Trump's affiliation with the Northeast.
Waiting for that first social media post on who he backs and who he's pushing.
What do you think he's going to say? I like SALT.
I've got no idea, but I'm with you. I think that New York has a place in his heart. I think that he made a big push on the campaign trail to make New York a feature, and some of the problems that some of these high-tax states were having became a feature of the campaign in a way that was unanticipated several years ago. And I think he's going to be interested in the outcome of these negotiations for obvious reasons.
So let's make a bet. At the end of next week, what do you think we're going to be talking about? Is it going to be the earnings from the retailers? Is it going to be tariffs? Is it going to be the tax bill? What do you think is bond vigilantes? Do you think it's disinflation?
I asked you this question last week, and then I had my answer, and my answer was the drafts of the President of the United States on his social media account. And that's still my answer.
Oh, come on. That's such a cop-out.
Fate of the market is in the hands of the President of the United States.
By the way, it's not approved. We can't.
I saw that from management.
Yeah,
no stock trading, no sports tickets.
No sports tickets, no fun.
All right, that's done.
Go home and to work.
From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another Italian Open update for Bloomberg TV and radio from Tennis Channel. Coco Gauff reached her first final in Rome after coming through a 3.5-hour marathon semi-final against 8 seed Zheng Qinwen. The American fought back from 5-3 down in the deciding set before closing out the hard-fought victory. Italy's Jasmine Paolini awaits in Sunday's championship match.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes